Also soft. Watch tech names this morning on the back of that story. Watch the mining names off the back of that story. Euro Stoxx 50 futures are down by 0.8%. The FTSE's down by 0.5%, which is quite interesting. So what's going to support the FTSE? Is the FTSE going to be a place to hide out today? You've still got a lot of miners in there, still got a lot of oil stocks. The DAX is down as well by 0.8%. A fair few tech names in that market as well. It's going to be interesting to see how defence names also trade as well this morning, Tom. There is a lot going on. It is a big market open coming up.
On your stocks to watch, it is the energy companies, it is the miners, the Fresnillos of the world, the Glencores of the world, called lower on TradeGate. It is, as you mentioned, the tech names as well. We'll be watching ASML, of course. So the miners in focus, tech on question marks and a lack of commitment, at least wavering commitment from Jensen Huang around OpenAI and the investment there. In Tesla, this is an idiosyncratic story, fourth quarter net beat, but planning to distribute 95% of its profit via distributions in 2026. So watching the Italian banking space from Tesla in focus as well, Guy.
Okay, here we go. Market open Monday morning, new month. Are we going to see a new market? What kind of a market are we going to see? Let's find out. Tech is in focus. Miners in focus. Commodities are in focus. FTSE 100, therefore, in focus. Down by 0.2% at the moment. Let's see how BP, Shell trade in a world where oil is down by 5% this morning. Let's see how the big mining names trade this morning with copper, gold, silver, all of the industrial metals getting absolutely slammed through the Asian session. There we go. The 600 is now down by 0.5%. The FTSE 100 is down by 0.6%. How are other markets going to trade in Europe this morning? We're going to see how the CAC is trading this morning. In some ways, the CAC has, a bit like the FTSE, a lot of what could be under pressure today, but not everything. It's going to be interesting to see how the extra kick of a bit of tech could hurt maybe markets like the DAX this morning. We'll wait for the DAX to open in just a moment. Tom, what are we seeing in sectors and in single stocks?
Across your sectors, it is industrials right now down 1.2%. Banks also taking a knock, down a full 1%. Tech under pressure as we expected. It's basic resources, the biggest losses coming through there across the sectors. Not unexpected, of course. The miners under pressure. The basic resources sector down 2.5% on the significant sell-off around precious metals and industrial metals. As I mentioned, banks also feeling a bit of a pain point as well. But tech down 1.8%. We'll be looking at the individual names in terms of ASML and SAP, to your point, over in Germany. Glencore, in terms of individual miners on the FTSE 100, Rio Tinto, Glencore down 4%, Rio Tinto down almost 3%. So the miners are certainly feeling the impact. The industrials as well, in terms of the defence names. To your point, Guy, you'd flagged this. BAE Systems down 3%.
So it's interesting. You want a place to hide out? You hide out in toothpaste and deodorant and soap and chocolate and all those kind of good things.
Usually where I am.
Yeah, precisely. Unilever is the best performing stock this morning in terms of points. Nestle is up. Some of the luxury names are also catching a bid. British American Tobacco catching a bid. Anheuser-Busch catching a bid. Danone is also tracking higher. So these kinds of safe areas of the market are where you're certainly seeing the bid coming through in terms of the points drop. ASML, HSBC, Shell, Total, Novo Nordisk, Rio. So these are it's exactly the mix that we anticipate in terms of the downside move. But ASML is down by 3.5% this morning. So that is it's a tech story as much as anything else this morning in terms of what we're seeing hit in Europe.
And just to reiterate, ASML linked to what we've been hearing from Jensen Huang, wavering, it seems, around that commitment to OpenAI, and also a question mark about Oracle and its plans to raise potentially up to $50 billion US. And interestingly, in terms of that dynamic shift that you've seen and that you were flagging as well, Guy, Carlsberg, names like that, up 2.3%. Unilever, to your point, up close to 2%. Heineken, the beer makers, doing well as well in that safe haven tilt, it seems, in a session today. Let's get more analysis, though.
Okay, let's do that. Henry Allen, macro strategist at Deutsche Bank Research. What's going on?
That's a very good question. Well, I think in terms of the precious metal space, what we've had is this huge run-up in January, even with the pullback at the end of the month. Let's not forget, gold prices just had their best monthly performance since September 1999. It's the best month of the 21st century, even with that late pullback. So the fact that we've seen a correction that is to be expected, and actually I think it's interesting when we talk about an AI bubble, of course. Actually, if you look at the pattern in gold over recent days, you've had obviously a huge acceleration in 25, the biggest annual gain since 1979. Then into 2026, that accelerates further. You get that pattern which you normally see at the end of a bubble. I'm not saying the gold is a bubble, but normally at the end of the bubble, you then see that speeding up. So we've seen a correction back to more normal levels. But I think the fundamental catalysts behind gold do remain bullish, that at the end of the day, we still have inflation lingering above target. We still have the Fed, who, under a new chair, Kevin Walsh, look as though they're going to keep on cutting rates. And, of course, geopolitical fears are pretty heightened right now. Only last month, we've had Iran, Venezuela, Greenland, concerns around Fed independence. So I think those catalysts remain in place.
So the game hasn't changed?
Not fundamentally.
Right.
And actually, in terms of we talk about Trump put, Fed put, at the end of the day, I think those catalysts behind are continued.
Are you as certain as you once were? So a few days ago, everybody was, the AI trade's still on, gold's still on. Are we not wavering in our commitment to some of these trades this Monday morning? Are we not wavering in our attitude towards the fact that OpenAI may not get funded in the way that it once did, that the gold story out of China may not be as driven as it once was? Just at the margin, because everything in risk models is at the margin. At the margin, am I as certain as I once was?
For me, I am actually. Genuinely. Okay. If you look at the fundamentals that are still in place, I don't think, at least in terms of the last week's new information, they haven't changed. Okay. I think the big information, of course, is for the next 4 years is Kevin Walsh as chair of the Fed, but he was one of the candidates who was expected. We know that he wants to cut rates along at the same time as shrinking the balance sheet. In terms of our expectations, that hasn't changed. Sure, we've had a correction this morning, but only 2 weeks ago we were talking about Greenland. There was a huge risk-off move. S&P was down 2% when it returned. We then come back to all-time highs. So I see it very much in that framework.
This is an overreaction, what we're seeing right now in the markets.
Broadly speaking, yes. I mean, I wouldn't say overreaction, but I think this is a standard correction that you normally get on the bull trend. At the end of the day, you don't hit all-time highs day after day after day. That getting a 1 or even a 2% pullback some days does not mean that you're then going to see a 10% correction. I just see this as a perfectly normal move in that context, particularly given how rapidly some of those moves have gone, particularly in precious metals.
And to your point around AI and the AI trade, your conviction remains, despite the question marks that we're starting to see. Through the end of this week, we're getting more earnings from the likes of Amazon and Alphabet. If you start to see further downside pressure on those stocks from some of the CapEx spending, do you reassess what happens with AI through 2026?
I think if we saw meaningful changes in CapEx spending, then yes, that could cause something to reconsider. But at the end of the day, I think the thing is with the bull run that's continuing, yes, the Mag 7 say have been fairly flat over the last 3 months. What we're actually seeing is a broader rotation. But I still think that's part of the AI trade, because I think what will happen, and we saw this in the dot-com bubble when the internet got going, is yes, at first, the positive catalyst will go to tech. Over time, they will spread to other firms, other sectors, other industries.
That rotation continues.
That rotation continues because those other industries still benefit from.
But who makes money? Who makes money in that situation? Because this is the question everybody's trying to work out: is can I make money on a data center trade? Maybe further down the road, I can make money on the broadening out trade, and the whole economy is going to benefit from it. But at the moment, it's centered on I'm going to make a lot of money on the data center trade. I'm buying chips, I'm buying data centers, I'm buying sort of copper, I'm buying all the stuff that goes into it. What if that trade doesn't make money?
Well, it's possible that trade might not, but as I say, because you've got that rotation, I actually think that's going to cushion investors. And one thing I've noted, as the Mag 7's been flat over the last 3 months or so, the narrative about an AI bubble has eased. That when you're hitting these repeated all-time highs, got another all-time high, another all-time high, oh, is this bubble? Is this a bubble? That bubble chatter has gone down significantly, even though the S&P last month still hit 7,000. And I think you're going to get that healthy rotation. Let's not forget, at the end of the day, 23 and 24 was the narrowest led rally for the equity market since the late 90s in the dot-com bubble.
That sounds really smooth, because that's obviously how history works. That you get smooth rotations from kind of big bubbles into... The bubbles deflate slowly. That's not how it generally works, is it?
Well, no, but I think people are overestimating the likelihood of some huge dot-com style crash. I think for a lot of people that was the first moment in their careers. Obviously that was a pretty scarring event. S&P 500 was down 3 years in a row, But correct me if I'm wrong, I think that's the only time since World War II that the S&P has been down 3 years in a row, that is not the sort of everyday correction that you normally see, even if AI does turn out to be a bubble. I don't think it is personally, but even if it does, the idea that we're going to see this huge correction, I don't think is justified even if it does.
I want to bring it back to the commodity story and precious metals. What do you do with basic resources in this environment?
So I think the catalyst for those are still
the mining stocks, I should say.
Yeah, I still think that, the upward pressure on a lot of commodities is going to remain, particularly copper and stuff, given the need for those in semiconductors and the like. So when it comes to some of those bigger pictures around mining stocks, I mean, I'm not an equity analyst, I'm conscious, but given that the fundamental bullish backdrop in the economy remains, I don't see like an immediate correction in those stocks, to be honest.
Okay, and Europe's positioning and how you're thinking about Europe through 2026 and whether or not your view, Europe versus the US, changes fundamentally in terms of what we've seen on the back of the last 48 hours or so. How are you thinking about that regional divergence?
Well, I think the European catalyst is still quite strong, actually, because we've got the German fiscal stimulus this year. I think that's the big game changer that I still think is underestimated by a lot of people. So if you look at some of the business surveys in Germany, they've still been pretty flat, actually. We haven't seen the uptick from the stimulus, but that should really start to hit this year, whereas we offset that against this kind of increasingly sell America narrative that actually, particularly if you adjust in USD terms, so from a portfolio manager's point of view, actually some of the performance of those US assets hasn't been as good as first advertised. Even last year when the S&P was up 18%, if you adjust that in currency terms.
Although if the dollar turns around convincingly, and we've started to see, and if that becomes a sustained story, does that change the fund flows back to the US?
It would do, but I don't see a convincing turnaround in the dollar. I could believe it stabilises, but I don't think we're going to get some huge recovery because you've got that Trump uncertainty, you've got the tariff uncertainty, you've got that Fed independence uncertainty. That's still going to be swirling around for the next 3 years. That's not going to change.
Do you think... So the question over the weekend that a lot of people were asking is, what is Walsh's view on the balance sheet? The balance sheet, the US balance sheet, Fed balance sheet, has been used to support financial assets. 2008, what happened in COVID, providing a huge amount of liquidity and support. What happens if that's not there anymore? We were debating this as you sat down. Would the president tolerate a stock market that drops from this point? Would the pressure on the Fed be insurmountable? Would the pressure on the Fed be so great that it would have to step in and use the balance sheet again? Are we convinced that Walsh's kind of view that you can shrink the balance sheet is feasible at this stage? Is that something, once given, can you take it away?
Well, firstly, I don't think that shrinking the balance sheet is necessarily a bear for equity markets. Indeed, as we were saying before the programme, over 23 and 24, we did have balance sheet shrinkage, yet that coincided with a continuation of this equity bull market. So it's not as though...
There's so much money floating around at that point, still.
That is true, but then Kevin Walsh has said that alongside shrinking the balance sheet, he's also going to keep cutting rates, and that's traditionally also been a bull catalyst. So, I think we're going to get at least one more rate cut, and I'm conscious that he's actually not going to be Fed chair, assuming he's confirmed, until the June meeting, particularly if we get more labour market weakness by that point, then actually
we're going to get more labour market weakness?
It's possible. We're still doing pretty well in terms of the labour market, and people are warning about that. So, he could easily have a fresh excuse to cut rates over and above what there already is. So long as he's still in a rate-cutting pattern and not turning hawkish, which I think is going to be a very, very, very high bar at first, considering that he is Trump's appointee, who's already said, I'd like him to cut rates and stuff, then I don't think we're going to see him turning to become a hawk anytime soon. That might be a 27, 28 problem if inflation picks up, but I don't think that's going to be one for 26.
Henry, we really appreciate you turning up on a morning like this and giving us some analysis on what on earth is going on out there. We really appreciate that. Henry Allen, Deutsche Bank Research Macro Strategist, thank you very much indeed. Call 6 looks like this morning. You have weakness in the chip space, as you can see. ASML is down by 3.3%. You've got some weakness in the defence stocks. Luxury's holding up, but to the right-hand side of the screen, as you can see, that's where the market is migrating this morning. Names like Nestle are doing very well. Let's check in on the miners, see what's happening there. Jennifer Creary is with us.
That's right. Of course, it's no surprise that metals and mining stocks are reacting very strongly to those plunging precious metal prices, silver, gold, copper, really sending those shares down. Endeavour, in particular, 8.6% down. Glencore down 3.4%. All in the red this morning. We're going to flip over to perhaps one of the winners this morning, which is, of course, Pandora, up 8.8% off of the back of those plunging silver prices, coming to the benefit of that Danish jewelry maker. Next up, we're taking a look at AI, of course, tech, coming off the back of those bearish comments from NVIDIA CEO Jensen Huang, sending those shares down this morning, more than 3% for most of those stocks as well. Finally, we're ending on oil, of course, BP, Shell, plunging. That's off of the back of easing geopolitical risk. Of course, US President Donald Trump said that the US is in talks with Iran over the weekend, reiterating that he's hopeful that a deal will be agreed, sending those shares down this morning off the back of that.
Jennifer Crew, thank you very much indeed. We'll continue to bring you analysis in terms of the metal space. There's a bit of stabilisation. That's the MLive blog view right now in terms of what's happening with gold and silver. Both, of course, still selling off, but a little bit of stability. You're back above 4,600 per troy ounce for the yellow metal. We'll bring you more on that evolving story. This is Bloomberg.
It's the most fascinating time for the global economy in years, and our conversations are front and center.
We're stress testing consequential ideas, and investors around the world are scoring them in real time, helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise, with some fun along the way.
This is Bloomberg Surveillance.
Up-to-the-minute global news whenever and wherever it happens. I'm Jemana Bersachi in Davos, Switzerland, and this is Bloomberg.
Astonishing day for US technology.
Shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
The trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Only on Bloomberg.
Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Welcome back to the opening trade. We are 16, almost 17 minutes into the Monday session. European benchmark is currently down a little over 0.4%, but it's paired some of the heavier losses. And as you can see, the breakdown across the major indexes, we continue to focus on basic resources, the miners, tech, and energy as well. US futures also in negative territory. NASDAQ 100 pointing lower by more than 1%. Guy.
Okay, let's talk about what's happening in the metals. We saw a big move Friday. We've seen a big move this Monday. A lot of that's been driven out of Asia. Some signs of stabilization right now, but is that a Is that something that lasts? It's a long way. We've got a long way to go, basically. European session, American session still to go. And then we're going to get back into what happens overnight into Asia. Let's talk about all of this and kind of where we are. Martin Ritchie joins us now to give us his take on what is going on from Shanghai. Martin, just give us your take on what you've seen in the market overnight, Europe, into this morning. What are you hearing? What are you seeing?
Yeah, hi there. I'm sorry to use this cliche, but it has been another manic Monday for metals. We've seen a lot of red across the board, gold falling by more than 10% at one point, silver solidly down, copper and all the base metals tumbling. But this is obviously coming off fairly big highs just 2 days ago. And what we're seeing is, I think, some of that bullishness, some of that momentum trade really just disappearing from the Chinese side. So the talk now is really, when's it going to stop? I'm not going to proffer any predictions on that, really, because it went up so fast that there's probably still a lot of froth in this market. If we look sort of beyond the current sell-off, there are still bulls out there. I noticed Deutsche Bank coming out with a call for gold still to reach 6,000 at some point. That's it's still well up from where it is after these recent declines. So still a very sort of mixed picture out there, despite the apparently solid decline so far.
Martin, how sizable is the speculative China trade in silver and gold right now?
It's really big. I mean, I could speak definitely more to the base metals markets, but the theme is similar across all of them. That in January we saw just extraordinary levels of volumes, far above previous records for the amount of trading volume in the Shanghai Futures Exchange, which includes silver and gold futures as well. What I'm looking at sort of day to day is how those volumes are changing. We had a record day for copper during that sell-off last Friday. We've seen open interest come down a bit in copper today. That's a sign that some of that air in the market is coming out, some investors backing out of their positions. But just to give it the scale, that trading volume on Friday was almost twice as high as any record before last Thursday. So really extraordinary kind of volumes coming through.
Just a quick question. The AI trade that we're seeing this morning also having an unwind. Is that what I'm seeing in copper, or am I seeing a broad metal sell-off in copper? Can I separate the two out?
I think it would be very hard to separate the two, just because there's so many other sort of technical and fundamental factors driving copper down at the moment. But what I would say is that some of the more cautious voices on copper over the past 6 months did say, look, as soon as you see that AI equities boom start to peter out, start to fade, copper's going to get hit by that as well. So it doesn't help with this route for metals prices, copper, tin, and the other metals that are exposed to the AI infrastructure.
Martin, thank you very much indeed with the update out of Shanghai. Martin Ritchie, our metals and mining reporter. Nasdaq futures, as we mentioned, lower today as well on those concerns around the AI hype bubble, amongst some at least. It follows comments from NVIDIA CEO Jensen Huang, who said his company's investments in OpenAI may not be as big as previously expected.
Sam is closing the round, and we will absolutely be involved.
How much? Can you say how much? Can you say how much?
We will invest a great deal of money. Probably the largest investment we've ever made.
The large?
Yeah.
So is that going to be over 100 billion?
No. Nothing like that.
No, nothing like that. Let's bring in Bloomberg senior strategist Neil Campling. Neil, that comment and Jensen Huang's suggestion that there was not a firm, solid, ironclad commitment around $100 billion of investment in OpenAI seems to be the further catalyst in terms of the downside pressure coming through for some of these big tech names. What do you make of it all?
Yeah, I think let's rewind back. Look at last week. We had questions around Microsoft's CapEx spend, etc. That was the starting point, I think. And then I think what Jensen said at the weekend was just say, look, we are committed to investing in the OpenAI infrastructure play. However, we are still going to be, fiscally aware of where the investments are. So the 100 billion was such an eye-popping number, quite frankly, last year, that I think now it's just a reset in terms of expectations, because let's come back. We've discussed this before.
Yeah.
ROI, it's still important, and we still haven't yet seen proof of the returns on that investment. And so I think investors now are a lot more focused on when are we going to see the ROI? Software complex has been hit massively, but of course, when we're supposed to be getting to the proof of what AI spending is supposed to be producing, we're supposed to see it in the software complex. It is not happening.
So how easy is it going to be for Oracle to make money, to raise money?
Well, this is interesting, isn't it?
Yeah. I know, it's Sunday nights. That's kind of weird time to come out and announce
It's a really strange time. But also look at the kind of raising they're talking about. They're talking about partly equity in terms of coming to market, so there's an immediate...
Does that mean they can't... Are they signalling with that they can't raise it in credit?
Right, because of what happened with the CDS spreads last year. They blew out massively. Now, also... Big tech's supposed to be massively free cash flow generative, yeah? That's the idea that we all hear about. Now, let's look at balance sheets. Let's look at, let's say, Apple, as an example, generated over $100 billion of free cash flow in the last 12 months. Oracle's free cash flow was negative.
Yeah.
Oracle's got a leveraged balance sheet. Oracle also, in this announcement last night, what was different about this announcement for me personally? There was no sovereign wealth funds. There was no private equity that were going, we're going to join in with you.
There was no backstop.
There's no backstop. Now, that sends a worrying...
And they're worried about the credit rating, clearly, aren't they?
Absolutely. Because, again, as I say, look at the balance sheet. It is highly levered, which is quite unusual for a big tech.
Are all these commitments that we've seen being made over the last few weeks and months, are they as solid as we thought they were? If NVIDIA's calling into question its OpenAI investment, what else do I need to call into question?
Well, all of these announcements, I mean, it's very circular so far. And then, of course, last week we had all these decisions go, we're going to come to the market quickly, we're going to do an IPO this year, etc. But do you want to do that when you've got lots of questions around corporate governance, about free cash flow, about returns? I mean, there are lots of unanswered questions here. So there is definitely, I think, more and more questions around this whole circular arguments in terms of this investing.
Henry Allen at Deutsche Bank was telling us earlier that there has been a healthy move in terms of the rotation trade, essentially suggesting investors have become savvy to the fact that you can't just pile into all things Mag 7 and hope it's going to pay off, that you've had a rational response to the valuation story and to looking to other winners within the AI space. And he thinks that's been healthy and that will continue to portend upside more broadly for the space. Do you align with that view? How much do you read into that?
I think it's great. It is good, actually, that we are seeing sort of questions being asked, because otherwise it's like if we were just going up, as it were last year, we were going up on the announcements of massive commitments when you didn't see these returns. So it is definitely a healthy thing where questions are being asked. And in the broader S&P market space, let's have a look at the fact that, tech is still the driver of growth of earnings. And that isn't changing in this current quarter. And we're going to hear this week, of course, from Amazon and Alphabet. They're going to be the key catalyst as well coming forward. So let's see what they have to say. But, you still... As an equity market, you're still relying on big cap tech to drive earnings growth.
Okay. Big week coming up.
Yeah.
Not done yet. It's only Monday. It's only Monday. Neil Kaplan, thank you very much indeed. You put the Fed balance sheets, you put the AI trade, you put the metal all together. Like so many questions that investors have got to answer. And this whole idea that you can sort of diversify, that diversification gives you protection. But how related is all of this stuff? And if one goes down, do they all go down? What portfolio effect do you see?
And it's those secondary and tertiary effects that we've started to focus in on. We've barely touched on the central banks, of course, through this week as well. The BOE, the ECB, maybe that doesn't matter. Maybe it is about what's happening in AI and the metals trade that overtakes what happens with central banks and the RBA as well. There's a lot more coming up.
Geopolitics needs to be focused on as well. We're going to talk Iran. We'll do that next. Carol Nackley is going to be talking to us about the energy space, which is also being hit hard this morning. We'll do that in just a moment. This is Bloomberg.
for climate change is going down right now. It's going down. And we've tried everything to shame people and blame people and put them in their place and tell them that they're doing things wrong and that they're killing everybody. But if we keep telling them that, then we are going to kill everybody. So we got to figure this out. And we're not going to do it by blaming people who are just trying to wake up and make ends meet every day, especially when a lot of those people have the same connection to nature and the environment that we all share here. I hike and I ski and I love the environment just as much as anybody else, but so does somebody who works in an oil field. The Cabela's shopper and the REI shopper want the same things. They want clean air and they want clean water and they want to be able to recreate outdoors. So until we figure out how to get on the same page, we will continue to lose. We cannot afford to lose anymore. We need to build a winning coalition of people across the political spectrum, or we will never create the solutions that we need.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
You know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
This is the opening trade. We're 30 minutes into today's session. You know it's bad, but it's not that bad. I think if you consider what's happening in terms of question marks about AI, in terms of course, the rupture that we've seen in the metals markets with the biggest ever drop for silver on Friday, intraday, and of course pricing plummeting for gold from about 5,500 to about 4,500, currently at about 4,600, and the drop in oil prices. But still, you're seeing drops of around 0.4% across the headline. But again, I think it could have been worse if you build that into the session with all those factors. The DAX over in Germany dropping 96 points. The CAC over in France down 0.3%. And the FTSE 100, with that focus, of course, on basic resources and miners, down 0.4%. Guy.
Europe has a lot of things that are going to benefit from actually some of these trades that are that we're seeing unwinding, and we'll come to that in just a moment. And that explains maybe the mix we're seeing in terms of the internals. 257 up, 327 down. Volume's actually a little light, which is interesting considering it's the first day of the month and we're seeing all of this kind of movement in other asset classes. But let's still dig into the sort of the story on the upside. Unilever, where do you run to? You run to the safe havens of deodorant and washing powder and things like that that are going to continue to need to be required. Unilever is up by 2.26%. Who benefits from a lower silver price? Pandora, there's a stock that benefits from a lower silver price, up by nearly 9%, 8.5%. What else benefits? Richemont. The jewelers are going to benefit from this. In some ways, they obviously sort of change their pricing, but not as quickly as maybe you would suspect. So the jewelers are benefiting from a lower silver, gold, platinum, etc. price this morning. And that's where Europe maybe stands out as an area of stability this morning. There are areas of weakness. Obviously, ASML is down pretty hard on what we're seeing in the tech trade. Shell is down on a lower oil price. Fresnillo, the gold miner, is down pretty hard on the back of what we're seeing in gold and silver this morning. It was interesting, Evie Hambro always talks about the idea that you could see a sharp downdraft in precious metals prices and miners would still make money. But there's obviously a kind of ask questions, kind of later, sell first kind of mentality that comes through. And that's what you're maybe seeing this morning in Fresnillo. That stock down circa 7%, Tom.
Okay, how much of all this comes back to the Fed pick? Of course, here's what else you need to know. This morning, US President Donald Trump has selected Kevin Warsh as the next Fed chair, of course, shifting the debate from short-term rates to the Fed's balance sheet and its role in markets. Warsh has repeatedly blasted Fed officials for letting the bank's assets balloon, prompting speculation in markets that he could move quickly to have them drawn down. And the US federal government has partially shut down despite a last-ditch funding deal approved by the Senate. The funding lapse began over the weekend just after senators agreed to fund most agencies until September. The bill includes just 2 weeks of funding for the Department of Homeland Security, which oversees immigration enforcement, instead of shutting it down entirely. The bill still needs to be approved by the House of Representatives. Ukrainian President Volodymyr Zelensky says the next trilateral meetings between the US, Russia and Ukraine will be held in Abu Dhabi later this week. It comes as Vladimir Putin's forces continued to strike Ukraine. On Monday, more than a dozen people were killed. On Sunday, more than a dozen people were killed when a Russian drone struck a bus transporting workers in central Ukraine. Guy.
Okay, let's turn back to the geopolitics and talk more about that. Iran's supreme leader, Ayatollah Ali Khamenei, has warned of a, quote, regional war as tensions continue to mount over potential US strikes.
This gentleman regularly says he brought warships. The Iranian nation will deliver a firm blow to anyone who attacks or harasses it. The Americans know that if they start a war, this time it will be a regional war.
Why wouldn't he say that? Of course you can say that, but we have the biggest, most powerful ships in the world over there, very close, a couple of days, and hopefully we'll make a deal. If we don't make a deal, then we'll find out whether or not he was right.
Okay, let's go to the Gulf, let's go to Dubai, let's bring in Horizons Middle East and Africa anchor Jumana Basetchi to talk more about this. Jumana, oil prices are lower today. That would seem to signal a downplaying of that risk of regional war. Is that the right interpretation?
Yeah, that certainly appears to be the case, Guy, versus where we were on Friday, for example, when I think there was a heightened expectation, even anticipation, that something could happen over the course of the weekend. And you just heard comments there from the Supreme Leader, Khamenei, and warning the U.S. that if they do strike, then this could actually run the risk of broadening out into a regional conflict. President Trump, of course, quipped back that he would say that, but actually he's hopeful that Iran will come to the negotiation table. And so what we've seen is a change of tone, especially in the last 24 hours. The diplomatic channels are being worked, and there's a lot of mediation going through from many of the Gulf countries. So over the course of the weekend, we saw the Qatari Prime Minister, Foreign Minister, travel to Tehran. He met with Ali Larijani, who is the Secretary of the National Supreme Council in Iran, very close to to the Supreme Leader. And they talked about the possibility for reopening those diplomatic channels once again with the U.S. Equally, they've talked about Egypt and Turkey playing a mediation role and the need for Iran and U.S. to be talking once again. At this point, it is unclear exactly what terms the U.S. are pushing for. We do know, as per prior episodes of negotiations, they have pushed for zero enrichment. In this case, they would also probably look for a pursuit of or stopping the development of their ballistic missile program, which is one concern, given that President Trump seems to think that they have fully obliterated Iran's nuclear program. But of course, analysts and experts say that that isn't entirely the case. They've just set them back. But ultimately, this could be just a method of buying time, because we know that the U.S. has deployed this armada, quote unquote, to the region. The aircraft carrier, the Abraham Lincoln, is there. They've deployed F-35s, F-15s. They're really beefing up their presence in the region as perhaps a means of deterrence to the Iranian regime. But it also could be just an opportunity to buy extra time and to bring in more reinforcements, specifically on the air defense side of things. But at least now the market is interpreting it as an avenue for diplomacy once again to be brought up and perhaps re-explored. But we'll see how it all turns out.
Okay, an important update out of the region. Bloomberg Horizons Middle East and Africa anchor Jumana Basetchi in Dubai. Jumana, thank you. Let's stay on the oil market response and bring in CEO of Crystal Energy, Carol Nackley. Carol, good morning. How much of the price action today is down to Iran?
Well, quite a significant share in terms of what caused oil prices to drop down, because we saw how the market last week and the last 2 weeks have been driven by market headline news rather than by changes in market fundamentals, that is demand and supply. So as a result, whenever we had, for example, more an escalatory tone in the whatever coming from the White House or from Iran, we saw an upward pressure on prices. And when they were more like the opposite, like more softer, more linear, more diplomatic tone, we saw prices coming down as we saw today. However, the geopolitical risk premium has not completely dissipated. Everybody's watching very carefully how the situation might unfold in Iran, especially given previous experience over the last year or two, when President Trump would say something and then he would use a surprise factor. So this is what the market is still nervous about, and there is a significant geopolitical risk premium. It is less than last week, but it has not dissipated completely. Otherwise, market fundamentals, very little changes here and there. For example, the weather in the US has affected supplies, and that put upward pressure on prices. But we saw Kazakhstan disruptions because of drone attacks on infrastructure in the Black Sea and the Caspian region are being restored gradually. These are small movements here and there and temporary, and there is seasonality, but the main factor is definitely geopolitics for the time being.
What would the oil price do in the event of an attack by the US on Iran?
Well, you know, there are all sorts of scenarios, because if it was, and we saw an attack last year when the Americans attacked Iran's nuclear facilities, we saw a spike, a jump, but it was short-lived, primarily because of the market fundamentals. So we have to take into consideration, one, the scale of that attack and how long it's going to be and what are the repercussions of that attack. So are we going to have a regional war? That would be really the worst case scenario for prices, and we could expect prices to jump and maybe to stay in the high territory for a while. But if it's going to be just a short attack, very targeted, as we saw with the attack on the nuclear facilities, we might see a short-lived jump, and then the market will correct itself, because there's plenty of oil around. Everybody's expecting a surplus this year. I don't think demand is suddenly booming or growing at much faster rate than supply, and there is still spare capacity in the system. So it ought to answer your question. We have to explore all sorts of questions and scenarios, especially in terms of how will that attack be and what the repercussions are going to be and how long it's going to last, and whether Iran will deliver on its threat that it always reminds us of, closing the Strait of Hormuz, and how long will that be in place. I doubt it's going to be Armageddon, but it's not going to be a pleasant scenario. But the market will correct itself eventually, because there is plenty of oil around.
Carol, the key question seems to me is how much will US drivers pay to fill up their trucks and cars? How critical do you think the midterm elections are in terms of our outlook when it comes to oil? President Trump wants lower gasoline prices. Do you think he's going to get them?
I mean, to a certain extent, he got them since he came to the White House for his second term, when he had his last year's speech when he said that we need low oil prices, and he blamed OPEC for keeping prices high. And we saw how prices after that speech kind of hovered in the low 60s, and they remained range bound between 60 or 70. We rarely saw 70 since he came to the White House. Now, of course, the midterm elections are very important for any president, not just President Trump. And if prices stay in this range between 60 and 70, that is still acceptable, because it seems to be acceptable for the American consumers, but equally acceptable for the American producers, the shale producers. At the same time, we saw the actions in Venezuela and the gradual lifting of or easing of certain sanctions in an attempt to kind of fill some gap or reduce nervousness in the market. If there is escalation and or disruptions elsewhere, there is these additional barrels that can come to the market and can rebalance the situation. So definitely they play a role. Prices, the gasoline prices, what you pay when you fill your car, when you go to the petrol station in the US. But I think it is the 60s range seems to have been an acceptable range for the American consumers and therefore for the American president.
In terms of how quickly that could change, is it possible that you could have an attack on Iran, oil prices go up, and they come down relatively quickly and allow actually the US consumer still to feel okay going into the midterms? I'm just wondering what the sort of timelines, how quickly an event in the Middle East could be over. Is this something that would have a lasting effect? I don't know the nature of the attack, but how quickly do you think we could return to lower oil prices and get through such an event?
Well, I tell you, since the share revolution became material, and if you look at historical prices since that period, and I don't like to look only for a year or two, I just look at the trends, I can see that any geopolitical developments, even that affecting a major oil producer, has not really resulted in lasting spikes in prices. So we did not see what we used to see, for example, in the 70s and the 80s. And that's why I'm much more confident today that, yes, we should expect spikes to happen. But in terms of the duration of the crisis, I think the oil market today is much more agile and much more flexible and in terms of responding to these kind of crises than not long ago. I cannot tell you for sure whether it will be 1 day, 1 week, or 1 month, because it all depends on the scale of the attack and what will happen afterwards. What will happen with Iran? Will the Iranians drag other countries into this conflict, regional countries? Then that will be really a serious crisis. But again, even those countries have developed alternatives to get around the Straits of Hormuz. There is plenty of oil around. There is no shortage. What will happen with Russia at the same time? Are there going to be a deal that will allow Russian barrels to float more freely in the market? So there are many moving parts, but it all depends on the scale of the attack. But at the end, we cannot change the fundamental realities of the market, that today oil markets are much more flexible and agile than they were a few years ago.
How much energy, how much oil will Venezuela be putting on the markets by the end of this year, do you think, Carol?
By the end of this year, I would say in terms of the hundreds of thousands of barrels, but not really in the millions. The millions will take several years to materialize, because so far in Venezuela, we only saw the change in president and some reforms are being discussed. But even under the best case scenario, even if reforms are fully implemented and there are new contractual frameworks offered to the big players like the Exxons of this world and other oil majors, very lenient terms. I mean, history tells us that oil will not start flowing suddenly in the market. I mean, if you take Iraq, it took them many years to increase their production significantly and recover to previous peaks. So in the short term, we have to be realistic. Perhaps what can come back to the market from Venezuela is what has been sanctioned, and it was not all of Venezuelan oil that was sanctioned. So if the sanctioned barrels, if those sanctions become legitimate and are allowed to be traded freely, that could perhaps bring more barrels in terms of numbers into the market, but it will be in the thousands and the hundreds of thousands, not more than that.
Okay. Thank you. Well, as always, appreciate your insights into the energy market, the oil markets. Carol Knackley, CEO of Crystal Energy. Thanks for your time and that context. Coming up, from oil to crypto, another tough day for Bitcoin. When we come back, we're going to answer the question: how much value did the largest cryptocurrency shed in the month of January? This is Bloomberg.
Such an incredibly exciting moment with AI. It is really the most profound technology of our lifetimes, and I think it has the potential to help us rethink literally everything. The potential for economic impact, societal benefit is honestly boundless. When we think about the economic impact for Europe in particular, it's around a 1.2 trillion euro estimate of the productivity growth that can be unlocked. This platform shift that we are living through, I think, is going to create untold amounts of value for the world, but also for the businesses and for economies, which is why I'm incredibly optimistic in this moment for Europe, but also for the whole world.
How do you think about job losses or safety for some of the AI tools?
You know, I hear the anxiety and I understand the anxiety about jobs. I think that we are certainly going to live through a massive transition about how people learn to work alongside these tools. I mean, the reality is I do think there'll be some number of jobs that are displaced. I think it is a smaller number maybe than some anticipate. We estimate it's around 7%. And I think what's important is that we have programs that help those 7% transition into new fields of work. I think what is more likely is that most of us are going to learn to work alongside these tools. So we estimate about 2/3 of us. If you think about the tasks you do in your daily life, when you look at every industry, there are administrative tasks that are happening everywhere, and that's what AI is most helpful in improving.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
Bringing you up-to-the-minute political news whenever and wherever it happens. I'm Tyler Kendall in Washington, and this is Bloomberg.
Welcome back. Now, before the break, we asked you how much value did Bitcoin shed in the month of January. The answer, 11%. The move lower, marking the fourth straight monthly decline, the longest losing streak since 2018. Its latest slump comes amid broad market unrest, of course, with gold continuing to fall today after suffering its biggest plunge in more than a decade at the end of last week. Bitcoin almost back to levels we last saw since President Trump took office for the second time. Guy?
Let's talk about where we're seeing the equity market this morning. In some ways, you could argue something of a non-event. Yes, you got the miners down. Yes, you got some of the tech stocks on the move. But what you also have on the other side is some of the jewelers in Europe. I think Pandora doing well. Think Richemont doing well. Some of the more defensive names, think Nestle, think Danone doing well off the back of this trade. One seems to balance the other one out. So let's get a sense of where we are with these markets this morning. Cross-asset. Bloomberg's EMEA Equity and Macro Trends Senior Strategist, Michael Masika, joining us around the table, as is Skylar Montgomery-Koenig from our MLive team. What do you think?
I mean, I think Friday's move was more symptomatic of a market that became very, very stretched than it was a fundamental change. Like, yes, the trigger was the fact that you had the worst nomination, and this idea that maybe it means the US dollar is more credible, maybe you don't need to have as much money in gold, but I don't think we know enough about what Warsh will actually do and what his nomination going forward would actually mean for markets, and you got a really mixed reaction as well. And the fact that it was broadly risk-off rather than a discerning reaction to Warsh specifically tells me that it comes from a market that was very, very stretched, hit a level that people thought, oh, I may as well take profits if there's a negative trigger. And it doesn't necessarily have an end in sight because, A, we've only just undone the 2026 gains, so we're still up quite a lot. People could still want a profit take. And if I'm an investor looking at the drop we saw on Friday, I'm not going to want to pile in, despite the fact that all of the reasons people were buying gold around uncertainty in geopolitics, risk of higher inflation, haven't gone away.
And Michael, bringing you in at this point as well. Again, just referencing what we heard from Deutsche Bank and Henry Allen earlier, saying all the fundamentals are still there for positive upside for the equity story in 2026. What do you assess of what we've seen in the last few days and how to think about the year ahead?
So, exactly as Skylar was saying, there were some parabolic moves somewhere in the markets. That's where it was miners, where it was like gold, silver, a lot of metals, Kospi, some semiconductor trades. I mean, all those went just like too high, too fast. There was a lot of speculation. A lot was driven by retail, not so much by fundamental investors like institutions. And the reality is they need to wash out at some point. And we came to a lot of speculations, but the fundamentals have not changed.
Can I say the same thing about the AI trade? Why is that different?
Well, it is a bit different because, again, those companies, the ones that are like AI hyperscalers and everything, they still deliver. They're delivering on earnings. They're delivering on CapEx. They're delivering. I mean, we see Oracle today. They go into more CapEx, But this time, they're going to finance it through equity raise instead of debt. So this is, you know, the stretch of the balance sheet.
Why are they doing that?
Because the stretch on the balance sheet was quite high, and we know that. But that's known. That's all well known.
Yeah.
So now it's all about, is this investment going to deliver? But that we'll know further down the line.
Guy Johnson's. I feel like you're much more concerned about AI. Maybe Michael Masika is suggesting quite a cadence.
Well, you see Jensen Huang coming out going, yeah, we're not quite so sure we're going to put quite so much money into OpenAI. Yeah, he has been the cheerleader for so much of this, and as you said earlier on the show, a little bit of caution maybe coming through from Jensen.
Skylar, on the AI theme then, where do we stand on this in terms of, we have big earnings, of course, coming through from Alphabet and later this week. At the end of this week, we could be in a very different place when it comes to how much conviction we have on AI.
Yeah, absolutely. And I mean, part of the move we've seen in equities on Friday was certainly related to gold, and that, like, you have such a big downside move, it creates volatility in the market. Certainly there were some margin calls. People are worried about where their money is. But I think the more important trend, as you say, is AI, as in that's what will really impact the equity market, because that's what's driven us so far in recent years. It's really been boosted by the fact that you have earnings delivering and that coming through in the tech trade. Now, what we saw last week from tech earnings was you needed a really big beat to get upside. And I think that's what we see this week as well, because there's questions over how sustainable the trend is, whether or not you'll see winners and losers. And I think that's increasingly in the environment, as in you need to be more of a discerning stock picker. And that's actually probably positive for the equity market overall, because it means you're not having this irrational exuberance that tend to lead to a bubble popping. So we'll see how the earnings come in. I do think they need to be quite strong to see a kind of continued rally. But more generally for equities, fundamentals matter the most, and that's the growth story is still strong.
Is it fundamentals or is it the Fed balance sheet? What supported the equity market over the last few years? Has it been great work done by companies, or has it been ample liquidity provided by central banks and the balance sheet of the Fed expanding? I know it's contracted a little bit over the last couple of years. How important's that been?
A bit of both. I would say if you look at the S&P 500 and earnings growth, it's been supporting the rise in the S&P. You have some valuation expansion, yes, but at the same time, you know, if the earnings growth is being delivered the way analysts suppose it's going to be, then in that case, it's still supported by fundamental. Now, for the market on a daily basis and like on a monthly basis, the balance sheet of the Fed is very important. I mean, the liquidity is ample in the market, and it's been supporting the equity market a lot lately. But, you know, again, when positioning is high, when retail action is really strong, you get movement that we see like right now, and you get more volatility. We haven't had volatility in a while, like a real volatility.
We have volatility now. The balance sheet hasn't been adjusted lower. But so if Walsh starts taking aim at the balance sheet, do we assume that there is a Trump put?
It's always the same thing. There's you got elections coming as well.
Sure.
So you want to make sure that people are happy. So yes. I mean, I'm sure in the market there is assumption that there will be either a Fed put or a Trump put somehow, like somewhere down the line.
So you just keep buying dips. Is that the mentality?
I mean, I think it pretty much is. And also you need to think about, it's not just the U.S. that's providing liquidity, right? You've got liquidity coming out of China right now, and that's pretty beneficial, not just for local markets, but also for more broad markets. And I think there's just really a question of what will actually Walsh deliver on. And yes, we're talking about what he's done previously, but this could be a very different Fed chair than Fed governor that we had in 2008, 2009.
Okay. Skylar, thank you very much indeed. Skylar Montgomery-Koning and Michael Masika, of course, with the analysis on another big day for these markets. Here's what else to think about through the rest of this week then. Later today, AstraZeneca will start trading on the New York Stock Exchange. We'll also get manufacturing PMI out of the US. On Tuesday, it's the RBA rate decision. That's going to be interesting. There has been speculation as to whether or not the RBA will have to hike rates sooner rather than later. Singapore Air Show, which Guy will be watching closely, no doubt, and the US job openings data. So on Wednesday, we're going to get CPI and producer prices out of Europe, and then PMI out of the US. On Thursday, drum roll to the BOE rate decision and the ECB rate decision, but arguably what's happening in AI is more important, the earnings there. Guy has some details on that shortly. And on Friday, we get non-farm payrolls, hopefully, if the government reopens and it's not affected by what we are saying right now, which is a temporary shutdown, at least.
Big earnings week still coming up. You've got Disney, you've got, that's today, European earnings, you've got Publicis, AkzoNobel. Wednesday, Novo, Novartis, GSK, Infineon's out first thing as well. Lilly's out later that day. You've also got the big ones, Alphabet, Qualcomm, Arm are going to be Thursday. You've got Shell, Vestas, Siemens, Healthineers, Amazon coming up that day as well. Big day for the banks on Friday. It is a massive week coming up. We barely scratched the surface. Hope you enjoyed the show. This is Bloomberg.
Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Bringing you up-to-the-minute geoeconomic news whenever and wherever it happens. I'm Vonnie Quinn in Sao Paulo, Brazil, and this is Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
It's the most fascinating time for the global economy in years, and our conversations are front and center.
We're stress testing consequential ideas, and investors around the world are scoring them in real time, helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise, with some fun along the way.
This is Bloomberg Surveillance.
What is going to be the consequence for U.S. markets? We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Metals meltdown. Gold on track for its worst two-day drop since 1980. Silver's gains for the year are wiped out. Oracle announces plans to raise up to $50 billion to build more data center capacity as AI growth demands yet more investment. Plus, Iran's supreme leader warns of a regional war as the U.S. boosts its military presence in the Middle East. President Trump says he wants to make a deal. Well, happy Monday, everyone. There's nothing happy when you look at the markets. There's just quite a lot going on. So we look at metals, we look at miners, and of course we look at the plunge that we've seen over the last 24 hours. Now, gold seems to be extending losses after its biggest plunge in more than a decade. Again, spot gold falling as much as 10% today. Silver's year-to-date gains being wiped out. And then the sell-off has really been driven largely by this bullion-based exchange-traded funds, as well as leveraged derivatives, with the extent to which Chinese investors buy the dips playing a key role in determining the direction of the market. I also look at Bitcoin, 76,797. So we'll look at the sell-off also in Bitcoin. European markets, Matt, now a lot of them will mirror some of the losses that we've seen across the board. We can see a little bit of pressure on the CAC and the FTSE. For the conversations that matter and the insights you need, let's get started.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Well, Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, it's red across the screen as the meltdown in gold and silver sparks a domino effect in stocks. The market reversal, which began on Friday, has deepened further, with gold falling as much as 10% and silver plummeting 60% at one point. Now, the dollar, meanwhile, has strengthened, extending gains made on Friday when President Trump nominated Kevin Warsh to lead the Federal Reserve. Now, we'll get more on the market reaction with MLive strategist Van Ram in just a moment, but first, to our Bloomberg breaking news editor, Alexander Pearson. Alex, what's been the political reaction to President Trump picking Warsh, and what obstacles might the nomination face?
Good morning. Well, the reaction in Washington, D.C. has been partisan. Republicans have, for the most part, welcomed the pick, citing Warsh's credentials and experience with the Fed. Democrats have voiced a lot more skepticism, saying they are concerned he might not operate independently of the White House or President Trump when it comes to setting monetary policy. That said, there is one important exception. Senator Tom Tillis, a Republican who sits on the Senate Banking Committee, has said he will oppose the nomination so long as there is an active investigation against current Federal Reserve Chairman Jay Powell. Tillis has long been a critic of President Trump and his pressure campaign against the Fed, and this linkage could certainly cause an obstacle to be in the way of the nomination going forward, and could threaten Warsh's ability to take over as Federal Reserve Chairman in May when Powell is set to step down.
Alex, thank you so much. Bloomberg breaking news editor Alexander Pearson. Now, for more on the market reaction, let's also bring Van Ram from Bloomberg's MLive team. So, Van, we've seen these big sell-offs in metals this morning. What's driven this?
Morning, Francine. I think that what has happened in silver and gold is classic behavior of what happens when prices are driven by herds. Back in the day when silver was trading around $28, $29, not long ago, just about a year ago, we had the fundamental story of a supply squeeze, and that was supporting gold, silver through $50 an ounce. And thereafter, it became morphed from a fundamental trade to a momentum-driven trade, where it went from 50 to 75 in the space of no time at all. And from 75 onwards, it just became a speculative trade and a greed trade, and then it just exploded from $71 at the end of last year to $121 to a record. So there was so much money left on the table, and and then investors came across an age-old problem. When there's too much money left on the table, there's always a tendency to to grab it first, and that's what happened, and that's what we have seen since in the past couple of days. Now, this all brings back memories of what happened in 78, 79. I wasn't watching the markets there, but what I can tell you is that at that point, it went from $4 an ounce to $32 an ounce in the space of just 1 year. And the drawdown thereafter was immense, 78%. What we have seen in the past couple of days is just about 30%. So there is much more to go if that episode plays out likewise.
Can you talk us through the slump in Bitcoin? What's that due to, Van?
Well, it kind of predates what's happening with silver, but I think, Bitcoin has fallen from a record to around, it's trying to find support around 75,000. There's no clear evidence that it is finding that support. But what is being tested here, Francine, is the idea that it is digital gold. It's the idea that it is a store of wealth, that it is an inflation hedge. All those theories are being put to the test, and there is no clear sign, as I was saying, that there is some support coming. So, and all these both these trades, silver and gold on the one hand and Bitcoin on the other hand, all suggest that, this retail crowd, many of them, the Reddit crowd, as I call them, they're piled into all these things as speculative trades, and now they are learning a very age-old lesson that you can't beat markets for too long.
Van, thanks so much. Van Ram there from Bloomberg MLive team. Now, for more on this, we're joined by Christian Miller-Gleesman, head of asset allocation research at Goldman Sachs. Christian, what a day to come on.
I know.
It feels like one day it's, everyone's happy and everything's fine, gold to the moon, and then is this profit-taking, or is this is there anything fundamentally that's changed?
Well, I mean, I've just come back from Asia, where we had our macro conference, busiest ever, 4,000 people, and everybody was bullish. And I think there was a lot of consensus where investors were obviously constructive on risk assets, but a few specific trades stood out: bullish EM, bullish gold, bearish dollar. And at the margin, that creates the risk of setbacks, especially if there's extreme positioning. And what we've seen in the metals space in particular is a lot of speculative positioning building up in the last few weeks, which creates this short gamma dynamic. You can squeeze up very quickly on the way up, but also fall very much on the way down.
Christian, what exactly is gold? Because I was led to believe that actually it's a lot of central bank buying, and this is a way of getting away of U.S. Dollar assets or U.S. assets in general. I mean, if this is speculation from China or day traders, and it's a different kind of asset.
Exactly right. I think for most of the last year, I think gold was driven, the marginal investor was central banks. And central banks are slow, they're steady, and it's like a big tanker that essentially like moved gold, and that made it somewhat more interesting for investors, for asset allocators, because the big challenge of gold is, if you look since 1950, it's actually been a relatively low Sharpe ratio asset. Most of the time it doesn't do much, and then it has these very intense periods like the 70s, as was mentioned earlier, but also the global financial crisis, and now where it literally just develops this very interesting characteristic in the portfolio. And we've had that now, but the problem is, like in the last few weeks, exactly as you said, the speculative positioning from investors and all kinds of investors has probably picked up a bit too much, and that has meant that you've overshot versus fundamentals.
So what does it mean going forward? Or again, is it also symptomatic of Kevin Warsh becoming the new Fed chair because of his, I mean, is it because they're waiting for, is he hawkish, or actually does it change fundamentally how he views the economy?
I think you got to ask, why have people been so keen on gold? I mean, part of that is structural, which is linked to deglobalization, like both economically and politically. We've seen that really since Russia's invasion of Ukraine, that global kind of sovereign investors have diversified towards gold. And I think the other factor which has really accelerated a gold rally has been fears about the dollar. We've seen that obviously last year around Liberation Day, but in particular into the end of the year, into this year, like the market was worried about dollar weakness, about policy. And the fact is Kevin Warsh at the margin seems to be quite a traditional candidate. He's been at the Fed before, he's got a track record, there's information about him, how his views have evolved. So maybe investors have relaxed a bit on the dollar view, which then means they can also be a bit less bullish on gold.
I mean, is this about geopolitics too? We've seen the market largely look through geopolitics.
Yeah. I think it's interesting. Obviously, this morning you also have a big sell-off in oil, and that to some extent would tell you that there's a bit of de-escalation on the geopolitical side. For example, related to the Middle East. I have not seen much news flow, I'll be honest with you. So it's not easy to square that. Maybe that's also reflecting the dollar being less of a concern. Commodities in general seem to be negatively correlated to the dollar because they're denominated in dollar. But I would say that the geopolitical risk into the midterms remains quite high. I think there's a lot of policy uncertainty with regards to the US, but globally, I feel. So at the margin, I would say that we're still very focused on building portfolios that are robust and can deal with these geopolitical shocks.
Christian, what do you do with AI right now? I mean, this is the next thing. I mean, we ask every day whether it's in a bubble or whether actually valuations and fundamentals make sense for it.
I would say that the market has traded AI relatively evidence-based. So especially in the US in the last year or so, it's been very much driven by earnings, less driven by valuations. Actually, outside of the US, we have to say, though, in Asia tech, valuations have been a big driver. So that explains maybe why also Asia tech has suffered a bit more in the last few days. But I would say that the market has been evidence-based. The problem is the AI CapEx evidence is starting to be a bit more mixed. Like, do we want more AI CapEx spend? Do we want less AI CapEx spend? The market hasn't made up its mind. Certainly the earnings season seems to behave like that. So it feels like AI CapEx cannot really drive the equity market as much anymore. And we've been saying that in our outlook as well. It's now about the applications and the adoption. And what our US strategists have highlighted is companies are starting to mention the cost savings from AI. And if you get more and more of that news flow, that could potentially drive another wave. But it's very different companies that are potentially winning. It might actually be the companies that are using AI that are rewarded for that.
Christian, does it change? We're also hearing that actually entry-level jobs are more difficult to come by because of how much a lot of these CEOs are spending on AI. Does it change labor dynamics?
I think our economists have been arguing that we'll have a great economy in the US this year, but the labor market will potentially remain somewhat weak. And I guess part of that is due to AI. Maybe the bargaining power power of labor, especially entry-level, kind of junior-level people, is a bit lower, because you could argue that AI is able to do the most basic things, and when you are a junior person, you often start doing the basic things, and then you progress and build up your knowledge. And we know the big kind of like barrier to entry for AI is data, domain knowledge, and that you get with seniority, that you get with like experience. So unfortunately, you have this transition period where I guess entry-level jobs are more tough to come by, which means possibly there's a case to maybe go to higher education study. Maybe instead of going with a bachelor, you go to a master or even a PhD to keep competitive with AI. But I think we'll have to find out that equilibrium.
Christian, when you look at, I mean, you're still bullish on equities, but actually you have the hardest job in the business. When you look at asset allocation, what are the kind of forces that pull you in one direction or the other, given all the complexities that we've just talked about?
Yeah, I think you're right. We're overweight equity, but we're funding it out of credit. So it's a relative view where we just think that credit is the weakest link. There's like very tight credit spreads. There's a bit of a carry bubble, which is also linked to the dollar. If the dollar keeps strengthening, if the yen keeps strengthening, you lead to a lot of carry unwind risk. So we feel like carry as a theme across assets is something we would avoid. We do think in the type of backdrop we're in equities, like you can still deliver good returns driven by earnings with a bit of optionality on valuations. Late cycle, you get restructuring, releveraging, and structural growth that can still drive equity. And we have plenty of those stories, as we discussed. So we are overweight equity, underweight credit. But currently in our discussions, a lot about portfolio protection. What can we actually do to maintain that equity overweight? Because it could get quite a bit more bumpy into the midterms, but also with that bullish sentiment we have.
Bumpy across all asset classes?
Well, yeah, across all the risky assets. You could definitely see equities get a bit more volatile. You could definitely see credit spreads widen a bit more. Yeah. I think our baseline is a bit like a spot-up, vol-up dynamic, where you often see that late cycle. You saw it in the late 90s, where equities kept going up, but they got more volatile. And last year was all about Goldilocks, very friendly volatility reset after Liberation Day, and you don't have that tailwind anymore, this kind of volatility reset. I think now the volatility might actually get a bit more elevated.
Christian, I mean, half the people that come on are very bullish on Europe. The others are not. So where do you stand on Europe? I mean, is there good value to be found, or is it just being left behind?
I mean, one good news is people don't seem to be bullish on Europe. I think like in these kind of surveys we do at the conferences and our conversations, Europe tends to be quite low in the list in terms of kind of bullishness. And that's good news, because you actually don't have this positioning dynamic which we discussed earlier. Right. The challenge is they're not bullish for a reason. There's relatively poor earnings growth. Our European strategists expect 5%. That's the lowest out of all of the regions. You have seen a decent amount of valuation expansion last year in the themes that people actually like: defense, infrastructure, and also banks. So at the margin, it's a bit more difficult. In the medium term, however, you could say that Europe could be a major beneficiary of AI, finding efficiencies and everything. So I think like we are currently underweight Europe in our asset allocation. We're overweight EM, a bit like the consensus. So we're a bit uncomfortable about literally the very short term, but sadly, the fundamentals for EM are still much better than for Europe right now.
Okay, Christian, as always, thank you so much for joining us. Christian Muller-Gleesman, Head of Asset Allocation Research at Goldman Sachs. Now, coming up, India's Prime Minister takes aim at President Trump with a budget that looks to support sectors hit by 50% U.S. tariffs. Details next, and this is Bloomberg.
Your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything. Welcome Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaj, and this is Next Africa. New episodes every month, only on Bloomberg.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
Interesting question.
Good question.
I so appreciate that question. You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
The conversations that matter, the insights you need. This is The Pulse, and I'm Francine Lacqua here in London. Now, India has unveiled a budget aimed at protecting its economy in the wake of the U.S. president's tariff threats. Now, the spending plan is packed with support for India's exporters who've been battered by U.S. tariffs, as well as fresh backing for strategic sectors like rare earths, semiconductors, and critical minerals. Now, let's get more with Bloomberg's Dan Strumpf in New Delhi. Dan, thank you for joining us. So first of all, how badly is India's economy affected by 50% U.S. tariffs, and what has India done in response?
Yeah, so the tariffs took effect last August, and what's been interesting about the way that the effects have taken hold is that it's been sort of a slow impact so far. Economic growth in India is still quite robust, well over 7%, which is really the envy of the world right now. And exports, including exports to the U.S., have so far not taken a seriously noticeable hit. Now, the concern in New Delhi, and this is being echoed across, a number of economists that we've spoken with, is that this year could finally be the year where the impact starts to really take hold. We do know that exporters last year, right around the time that those tariffs took effect, really front-loaded a lot of their exports to get ahead of the tariffs. The impact is starting to be felt more deeply now. So much of this budget is directed at providing support for some of those industries that are likely to be hit the hardest.
What kind of measures are offered in the budget, and what's been the market reaction?
So measures include things like support for some labor-intensive export industries. Now, in India, those include industries such as the leather sector, the textile sector, rug makers, marine products. The U.S. is a major buyer of Indian shrimp. This is an industry that's been badly affected, especially in the south of India. So there's more support for some of these industries. There's also support for industries that are exempt from U.S. tariffs, and that India has been pouring a lot more resources into recently. Now, that includes electronics components, that includes semiconductors, and other sort of high-tech sectors as well that India is trying to sort of prioritize. Now, to your question about the markets, the market actually so far did not like this budget. Now, that's not to say that the market didn't like the headline numbers and some of these supports that we're talking about right now. The real thing that investors seized upon were these higher tax rates on certain types of equity trades and derivatives trades, and these were mainly aimed at cooling some of the speculative fever that's kind of gripped a lot of the Indian market, particularly among retail investors, and that's contributed to a lot of the volatility that we've seen in the market in recent years. So that's the reason why there was a big sell-off. And then the second contributor was the relatively high amount of borrowing that we're expected to see to fund some of the initiatives in this budget. And that was really reflected in the bond market today, where you saw a big jump in bond yields in the Indian bond market.
Dan, thank you so much, our Bloomberg senior reporter, Dan Strumpf. Now, the British Prime Minister, Keir Starmer, concludes his East Asia visit, but some investors may question whether his trip did indeed make a difference to UK priorities. Now, my next guest argue it was pretty underwhelming, and China gained much more than the UK. Joining us now is Elisa Guerrero, Natixis Asia Pacific Chief Economist. Alicia, thank you so much, as always, for joining us. Now, we'll talk about China in a second, but first of all, what's your take on India? And how can Europe, if at all, benefit maybe from the fact that India has also been slammed by U.S. policies?
Yes, very much so. That's exactly where we are, but the UK was there before also. And I think we have to see still that that benefit coming over. Why? Because as much as India is growing, actually the highest growth in the whole of Asia, more than the Philippines in 2025, consumption is still quite weak. We do have imports from, luxury. So basically we have a K growth type in India where, you have this basically employees of, high-end services, digital services buying, and those are imports, but again, luxury final goods, but not so much intermediate goods, which is what India needs. Hopefully, the now very high tariffs on intermediate goods, machinery, etc., will come down so that Europeans can actually invest in India, manufacture in India, and re-export from India. Frankly speaking, and I heard the comments on the budget, subsidizing exports is not going to make it because India's share of exports globally is only 1.8%. The economy, as a percentage of global, is 4%. So it is not about Trump. It's really a problem in the Indian economy itself. So therefore, I think Europe and the UK before can help in that regard with manufacturing investment in India.
Alicia, if you look at Europe, I mean, is it easier to ratify, for example, Mercosur than the EU-India deal? And if yes, why?
It is for a very simple reason, actually, and that's the good news. And it's a bit technical, but let me clarify. Actually, the Indian deal only needs adoption by the European Parliament, not ratification. And the reason is that the Indian deal does not include an investor protection section, as Mercosur does. Let alone the fact that the India deal has actually put aside agriculture products, quite a relevant issue to understand what's happening with Mercosur. So it is much easier to get to the final line, even if it started later.
Alicia, I mean, if we move further afield to China, what exactly are the dynamics in China that could help or hinder some of the economies here, including the UK?
Yeah. So what we would need China to do, if I were Starmer or any European leader or any leader for that matter, is for China to consume. We've been saying this for a long time. Not only that, China should import more to consume or invest. So in other words, two problems. China consumes little. Everybody knows that. But that's not all. China does not like to consume or use intermediate products that come from the rest of the world. That's the trend. Unless China changes that displeasure for foreign goods, in whether it's politically driven or not, or just it is very hard to tell. But that's the main problem. China needs to import more from the rest of the world, and if it doesn't, there's no way we can really make any gain out of this major economy.
I mean, is there anything that actually the UK could do in terms of R&D and investments? Could we model, I mean, could Europe, could the UK model itself on the kind of deal that Canada had with China?
Yeah. Well, what we heard is, of course, AstraZeneca's massive investment in China, out of which I think 2.5 billion, if I'm not mistaken, is R&D. Is that a good thing? Well, on the one hand, of course, China is a major innovation platform, and it makes sense to be in China. But at the same time, if you only innovate in China, if you transfer your R&D to China, to a large extent, a large part of your R&D, you also become a little bit captured by China, don't you? Because that's where your ecosystem happens. That is from where you will be exporting in the future. And that makes companies only more dependent on China. So I would say that I think it is good to rely on China to be in that ecosystem, but you need to make sure that you do not depend too much on China also for innovation.
So interesting. Alicia, thank you so much. Alicia Garcia Herrero there, the Asia Pacific Chief Economist at Natixis. Now, coming up, how much further can gold and silver fall? We'll delve into the metals meltdown. Next, we have really quite a lot going on. If you look at the markets, it's really the drop in gold that's driving everything. The drop in gold also leading to people questioning how much they need to change actually their diversification. Gold actually is extending losses after the biggest plunge in more than a decade. Silver's year-to-date gains also wiped out, with the metal slumping as much as 16% after an intraday loss on Friday that was the steepest on record. We'll have plenty more on the markets next, and this is Bloomberg.
For us is the year that everything just comes together, right? We're not just moving money. The last decade, literally, we've been the race for Africa's growth, right? And the future of Africa, in our opinion, is not hype, it's infrastructure-led. When Africa wins, the global economy wins. We're building the pipes, and those pipes are now of age. Now, as of right now, we are the biggest fintech in Africa, the most licensed non-bank entity. In the last 10 years, we built that muscle. Now we're putting that to the test, all right? Now we've covered the entire world. We have UK, US, UAE, Canada, Europe covered through our partnership with Global Open, for example, and Nuvian. And the point behind that really is, how do we ensure we use that infrastructure to drive the next phase of growth for Further Wave by empowering our customers across all our segments?
Know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Haslada Amin in Davos, Switzerland, and this is Bloomberg.
Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. Metals meltdown, gold on track for its worst two-day drop since 1980, while silver's gains for the year are wiped out. Oracle announces plans to raise up to $50 billion to build more data center capacity as AI growth demands yet more investment. Plus, Iran's supreme leader warns of a regional war as the U.S. boosts its military presence in the Middle East. President Trump says he wants to make a deal. Now, pretty dramatic moves in the metal space is the dominant market theme. Right across the board means there's a lot of turbulence to analyze. Well, let's bring in Michael Hay. He is head of FIC and Commodities Research at SocGen CIB. Michael, so good to speak to you. I mean, especially when it feels like it could be the end of the world, but it's not really. But you don't really know what function gold is now.
Well, I mean, let's think about what's been driving gold. It's pretty well established: central bank buying, ETF flows, managed money positioning. We don't get to see the central bank buying real time, 3 months lag, 2 months if you look at customs data, 1 month if you look at London vault changes. My interpretation there is that they've paused. We know on Friday that hedge funds have reverse positions in both gold and silver, and ETF flows have been absolutely gigantic over the last several months. So that's what's been driving it.
Michael, what I've been underestimating is that there's a lot of Chinese day traders on these markets too, including gold.
Yeah.
Now, that was a little bit of a surprise to me. This is not central bank buying. This is like speculation.
That's right. And so last week there were reports of a bit of a clampdown on people opening up accounts there. Of course, these accounts have to post margin when it's a futures, and those have been rising with the volatility. The CME also has been rising its margin levels on a percentage basis rather than just a fixed value. So as the volatility has been picking up on the upside, these traders have had to cut their positions, both in China and in the US and here on the physical side.
So do we know how much that accounts for? Like if you look at central bank buying, because if central banks around the world look at US policies and say, actually, I want to get away from treasury, you know, longer term, I want to get away from dollar, then, you know, the gold is to the moon.
Yeah, that's right.
At some point.
Yeah, so I mean, China reports they have about 2,300 tons in their central bank. As I mentioned, it's kind of slowed down a lot recently. Poland has been picking up, of course. That hasn't really impacted the prices here in the short term, especially last week. It's the ETF flows that have really dominated. So to give you some perspective on China versus the rest of the world, if you think about global ETFs in gold, for instance, it's about 4,000 tons-ish. China was nothing a few years ago. It's between 200 and 300 tons. And that actually was the biggest increase in ETF flows since October was in China versus the rest of the world, particularly Europe and the Americas.
So what happens to gold next?
Well, I mean, we're going to stick with our forecast. I think the only thing that's happened is a removal of one piece of uncertainty about Fed independence, the nomination of Walsh. That's just one thing. When this uncertainty gets resolved, like we saw actually when President Trump was actually won the election, uncertainty was removed because we knew he was coming into power, and gold actually sold off because of that uncertainty coming off, but it came back up again. So I don't think anything's really changed fundamentally on the gold side, so I still believe it's going to go back up. It's going to be very volatile over the next week. Actually, this morning I was looking at options data, bets to the upside and the downside on gold, and the biggest accumulation of calls upside for November of this year was at the $10,000 strike. So it's still up there, and there hasn't been a bit of a change actually today and Friday. On the downside, you know, the biggest accumulation is around $4,500 an ounce. So there's a big asymmetry there as to which way it could go. So I'm in favor of it. Once we get through this volatility, it's still going back up.
Michael, I mean, what about silver? So again, silver saw a spectacular rise since the beginning of the year. I mean, Friday was a rough day for silver, but is it a kind of, you know, the same reaction function than gold longer term?
It is, but you have to remember that silver is a market that is 10 times smaller than gold. If you think about ETF values and hedge fund positioning. So it's going to do what gold does, but on a much more extreme basis. Historically, for every 100 tons going in and out of silver ETFs, you'd look at about a 5% change in the price of silver. Since October, that's 13%. So it's a much, much bigger impact on silver than gold. So when gold sort of stabilizes and starts to move back up again, silver will go with it.
I mean, I know you look at precious metals, but, you know, the best play could maybe be copper. I know it hasn't been as dramatic, but it kind of also has all the geopolitics there distilled in one metal.
Exactly. AI data centers, stock building.
Renewables,
everything. So there's a lot more supportive fundamental features behind copper. It got dragged down, of course, with silver and gold. I mean, obviously, copper and silver are co-produced. Out of the 25,000 tons of silver that comes out of the ground, about 6,000-ish comes out with copper. And if you look back historically to 1850, actually, they move up and down together. So it didn't surprise me it's come off. But for copper, you're right. I think there's a few more positive, strong fundamental features that should support that market.
Michael, I mean, is there anything so nothing's fundamentally changed, right? As you say, except for the fact that we now have a new Fed chair. But nothing's fundamentally changed. What happens to some of these precious metals if there's like an AI bubble that bursts?
Well, I mean, this is the relationship between these markets and the equity markets, for instance, is not exactly clear.
Yeah.
And so what we're talking about,
Well, meaning that sometimes it tracks it and sometimes it
doesn't.
diverges.
Yeah, so it's a bit unclear as to what exactly it's going to react to there. It's a bit of a hard one to call.
So what are you looking for next?
So what I'm looking for now is central bank buying to pick up, because the prices have come down, so it probably makes that a little bit more attractive to them going forward. We saw that pause over the last couple of months, so I'm looking for that to pick up. When that happens, then that gives it that fundamental feature again that gives it that strong support.
And the data lags by what, a couple of weeks
No,
usually,
for
or you
central
have it
bank
like
buying,
24 hours?
No. Central bank buying is 2-3 months. I mean, there's no
2-3 months.
They have to report to the IMF. But you know, so what we do with the central banks,
You must have secret data
well, we
that
do.
you look
We
at.
proxy it with customs data and things going in and out. That's sort of a month or two lag. And of course, a lot of the gold moves out of London, and we can proxy that by changes in the vaults in London, sort of with a 1 month lag. So yeah, it's not perfect.
I could talk to you about this for days, but actually, what have we understood about how the Chinese are trading this in terms of the crackdown from China on speculative buying? Does it change like some of the meme stocks that they did a couple of years ago, or is it a different kind of policy?
It's a different policy. I mean, there's the Chinese futures market when it pertains to commodities is highly speculative. Okay. It's very, very different than the Western markets, which are much more producer, consumer oriented. So they've always been quite speculative. So I don't think that's going to change.
Okay, your best buy for the next couple of quarters?
I like copper. I agree with you there. I think that's a solid buy. Lots of fundamental reasons behind it. As you mentioned, the AI, the EV, the stockpiling, the military rearmament, things like that. So copper is my buy.
Is there something that you're staying away from, or at least, you know,
well,
many
I'm not
question
staying away
marks?
from oil. I'm shorting oil. I still believe that's quite bearish going forward. So I wouldn't go long oil.
Okay, so interesting. Michael, thank you so much. So fun to have you on. Michael Haig, Head of FIC and Commodities Research at SocGen CIB. Now, returning to the nomination of Kevin Warsh as the next Fed chair, the former Atlanta Fed president, Dennis Lockhart, says Warsh could face early tensions on the committee. Lockhart told us Warsh is seen as hawkish on inflation and the Fed's balance sheet, but his ultimate approach may remain data dependent.
You know, his history is that of being somewhat hawkish, both in terms of inflation vigilance and interest rates, as well as the balance sheet. And he continues to talk about reducing the balance sheet and reducing the footprint of the Fed in markets, which is, of course, would be interpreted as tightening. At the same time, he's been aligned with President Trump in the White House in recent remarks. So it's not clear to me which Kevin Warsh will show up in May. I think probably he will be data dependent, and with the committee will make the best decision he can.
Given that there are 12 voting members on that committee, how significant is the influence of the Fed chair, and what do you expect to be sort of the direction going forward in the next 12 months?
The Fed chair enjoys a great deal of deference from other members of the committee. And in my experience, when it's a close call, the chair's preference often prevails. Having said that, a new chair has to earn the respect of the committee. And so I think he's going to have a honeymoon period. And during that period, he'll be trying to conduct himself in such a way that reassures the committee that he's going to be independent. And we'll see how that plays out. I think Kevin Warsh will be navigating some tensions and some conflicting views on the committee. So it's not an easy road for him in the first few months.
On the data front, there's talk that we could see inflation creeping back up. Certainly from the likes of PIMCO, that seems to be their assessment. Is there a chance that we don't even see a cut this year?
Always a chance, particularly when you're looking forward early in the year. There's so many months ahead of us that it's very difficult to predict. My personal view is no cuts in the first half, but maybe a repeat in the second half of some cuts that look a little bit like the last 2 years. But that's just speculation at this point. It will depend on how the economy evolves. And we have both elements of the dual mandate, inflation and employment, showing a trend, but not a trend that could not be broken by new events. So It's very hard to predict, I think, at this stage. One more cut is a reasonable and plausible assumption, I think.
Well, that was the former Atlanta Fed President Dennis Lockhart speaking to our colleagues Sherry Ann and Avril Hong. Now, in tech, Oracle announces plan to fund the expansion of its rapidly growing cloud infrastructure business and expects to raise between $45 to $50 billion of gross cash proceeds during the calendar year. Let's bring in Neil Campling, Bloomberg's senior strategist. So, Neil, this is a huge amount of money. How are they planning to do that?
Yeah, it's interesting that this time round they have announced on a Sunday evening plans to bring up to $50 billion through a combination of equity and debt. The point being that they're bringing equity, which basically means they're coming to at the market. So there'll be price discovery immediately on this kind of structure. Whereas last year we saw the CDS spreads blow out massively, which was an issue for them. And we have to also remember that Oracle itself is unlike many big tech companies in that it has got a very leveraged balance sheet. So it needs to send that message to keep its investment grade.
But, Neil, so what are the main risks of the company? I mean, pre-market, look, the share price is down some 2-3%. I mean, are they risking big but just have to go through with this?
It is a question of having to invest because we're still waiting to see the ROI for all this AI CapEx spend for all of the players in this marketplace. But as we've seen with tech waves in the past 20, 30, 40 years, there are very few massive winners from this. And if they want to have a seat potentially at the table, they've got to take this investment risk effectively.
Neil, talk to me a little bit about Jensen Huang of NVIDIA. I mean, he's always left, right, and center of anything we cover, but actually some of his recent comments are I guess, making investors concerned.
Yeah, I think though what he said at the weekend was, we are going to make a huge investment in OpenAI, but he did backtrack from the $100 billion investment was talked about last September. So actually, investors will take some comfort that they're not just putting any capital at risk without due concern, and also making sure that the investment is going to be sort of responsible fiscally, which is essential for investors in the long term. Whereas NVIDIA also has to fund those AI investments that in turn obviously will invest significantly in their own chips.
Neil, thank you so much. Neil Campling, they're Bloomberg's senior strategist on tech and AI. Now, the board of Walt Disney is said to be close to promoting the chairman of its theme park division to the role of chief executive. It's understood a vote on Josh D'Amaro will take place in the coming weeks. The 54-year-old has led the unit that delivers most of Disney's profits since 2020. If approved, D'Amaro will succeed Bob Iger, who ran the world's largest entertainment company from 2005 to 2020 and returned as chief executive in 2022. Now, coming up, Iran's supreme leader warns of regional war if the U.S. launches military strikes. We'll get some analysis next, and this is Bloomberg.
Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Astonishing day for U.S. technology.
It's shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
It's the most fascinating time for the global economy in years, and our conversations are front and center.
We're stress testing consequential ideas, and investors around the world are scoring them in real time, helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise, with some fun along the way.
This is Bloomberg Surveillance.
The conversations that matter, the insights you need. This is The Pulse, and I'm Francine Lacqua here in London. Now, oil has dropped after notching its biggest monthly gain since 2022, after U.S. President Donald Trump said Washington is talking with Iran. It comes as the Iranian supreme leader warned of a regional war if the U.S. follows through with strikes on the Islamic Republic.
This gentleman regularly says he brought warships. The Iranian nation will deliver a firm blow to anyone who attacks or harasses it. The Americans know that if they start a war, this time it will be a regional war.
Well, let's bring in Patrick Sykes, Bloomberg's breaking news editor from the Middle East. Patrick, as things stand, how high are the military tensions between the U.S. and Iran today?
Yeah, on the ground, still high. I think the ticking element is obviously that U.S. naval so-called armada, those naval assets coming into the region. We still don't know exactly where they are, but Trump said over the weekend a couple of days away from Iran. And then you have rhetoric from Iran at the top level from Khamenei there saying it would be a regional war if one were to happen. That being said, you mentioned oil there, and I think that's because diplomatically, rhetorically, we have seen a bit of a downtick in tensions. Earlier today, we had the spokesman of Iran's foreign ministry saying that messages were coming and going between Iran and the US via various intermediaries, various parallel channels of diplomacy going on at the same time. And he was saying that Iran hopes that they will bear some kind of fruit in the coming days. So there's indications of optimism there from Iran that there could be a diplomatic way forward. That's why you're seeing the dip in oil today.
And Patrick, OPEC Plus reacting with an ongoing freeze in production levels. So who's trying to keep things calm and get a peace deal between the U.S. and Iran?
Yeah, interestingly, it's predominantly the regional countries, right? Middle East, the Gulf, but not only the Gulf Arab states who have been really active on the diplomatic front. Just in the past couple of days, since Friday, Iran's foreign minister has had calls or meetings with counterparts from Turkey, Egypt, Saudi, Qatar, the UAE as well. We saw the UAE president also cancelling a visit that had been scheduled for later this week to Japan. Another indication, I think, that for them, this is a potential crisis right on their back door. They've seen it blow back physically the last time around when Iran retaliated by striking U.S. bases, and they're keen to avoid that again this time around.
Patrick, thank you so much. Patrick Sykes, Bloomberg's breaking news editor for the Middle East. Now, also with us this morning, Jasmine El-Gamal, founder and chief executive of geopolitical and communications advisor, Mindwork Strategies, and a former Pentagon advisor. Jasmine, thank you so much for joining us. I mean, first of all, what do we know about the situation on the ground in Iran? This was covered a little bit. There was a blackout. So do we have to start from there, or is it really the fact that we could be closer to a war without really knowing what the U.S. wants?
Right. I mean, it's a very, very tense moment in the region right now, and you can tell by the flurry of really high-level diplomacy that's happening from countries like Qatar, like Turkey, like Egypt, all trying to get the U.S. president to back down from his threat of a military strike. They've seen this play before. Obviously, the stakes are really high for them, and they're trying to convince Trump that there are still avenues for negotiation that haven't been fully explored. So we're going to see, hopefully this week, some of those avenues being explored.
Negotiations for what? To try and a change in leadership, or what exactly is the ultimate goal with everything that we're talking about?
So that's an excellent question, because really the question here is, are there actually topics to negotiate over, or are the two sides simply too far apart? So if you look at all the potential areas of negotiation, the potential areas of friction with Iran, you have their civil nuclear program, you have nuclear material that has potentially gone missing after the 12-day war, you have Iranian support for proxies in the region that affect the regional allies, you have Iran's treatment of the protesters that is now on the table as well, although probably less important to President Trump than all these other geopolitical issues. And then you have Iran's ballistic missile program as well. So the question here, and now we're hearing that the U.S. and Iran might be meeting in Turkey later this week. What is actually going to be on the table? Are all of these issues going to be on the table, or just the nuclear program, which many are saying is now not enough for the U.S. president?
But Jasmine, what do we know about these uprisings? So, I mean, thousands have been killed. Is that now over? Is there a balance in the country? Or it does feel like it's actually it's impossible to really see what's going on.
It's a very murky picture, but from what we do see coming out of the country, this has been some of the most horrific repressive action from this regime against protesters that we have seen in recent history. Speaking with friends in Iran, friends of friends, the stories that are coming out are absolutely horrific. Violence, indiscriminate violence, children, men, women, they are not differentiating. Really cruel practices like forcing families to pay a fee in order to retrieve the bodies of their family members. So even though, and the death toll varies widely, anywhere from 4,000 to 20,000 we've heard. But obviously the bottom line is this is more serious than we've ever seen before. The question is, this is what President Trump is weighing right now. Is a military strike going to make things better, or going to take not just the U.S., not just the Iranian people, but the entire region down a really slippery slope that no one will be able to control? And we haven't even discussed the impact on global shipping prices, on energy markets. I mean, it's a really uncertain situation, and I think the more uncertainty you have, the more dangerous it is to look at military strikes as the #1 tool rather than negotiations to try to bring the temperature down a little bit.
But Jasmine, I'm going back to the uprisings. They're not, there was at some point talk about a change in regime because of the uprisings from within. Right. Is that now off the table?
I don't think anything is off the table yet, but I think the questions that people are asking around the president in the region, what does regime change mean exactly? Right. Because there sometimes tends to be simplistic ideas about what regime change means anywhere, not just Iran. Is it about the supreme leader leaving? This is an old, decrepit, really repressive man that is completely out of touch with his population, which is very young, vibrant, dynamic, brave, very connected. Is it about him leaving, but maintaining the rest of the structure, the IRGC, the security forces, in a different form, sort of like Venezuela? Or are you going to dismantle the entire system, in which case you have to ask other questions like, well, who's going to be in charge? Are the security forces going to listen to someone else? How organized is the opposition? You start going down to day after planning, which by all accounts has simply not been happening in Washington or elsewhere.
Jasmine, if you look at, I don't know whether you want to call it the task force that are helping with the negotiations. This is like Egypt, Turkey, Qatar, Saudi Arabia, the UAE. Or do they all want the same thing?
Pretty much. They want stability in the region. These are countries, I mean, if you look at what the region has been through, really since the Arab Spring, and it's been crisis after crisis after crisis. Last year, then you had the horrific war in Gaza. You have Syria just starting to get back on its feet, but obviously still facing huge challenges, economic security challenges. So the one thing that all of these countries can agree on, even though there are rivalries and tensions between them, is that this region does not need any more instability. Yeah. That's the message from President Trump. The positive news that I see is that these negotiators, these intermediaries that you just mentioned, Qatar, Egypt, Turkey, are very trusted actors by the U.S. government. They helped get the Gaza deal. The president knows that they like him, or at least they pretend to like him. They have helped him get to what he wants, which was the peace deal in Gaza. He trusts them to make sure that he is kind of not straying too far away from what is best for everyone. So that's a huge deal, because usually when you have such intensely distrust, such intense distrust between the parties, there's zero trust between Iran and the United States. And remember that last time Iran and the United States were supposed to meet for negotiations, and the U.S. struck right before.
Jasmine, can we expect something this week? I know that, for example, the UAE president was meant to be in Japan and he canceled it. So in terms of timeline, how quickly could something happen?
I think with President Trump, again, as we've seen before, anything is on the table. And as I just said, the last time the U.S. and Iran were supposed to meet in Oman, Iran was struck by the U.S. and Israel. So I don't think anything is off the table, but from everything that we've seen, I think there is hope that negotiations will be ongoing before the president makes a decision on a strike.
Jasmine, thank you so much. Jasmine Al-Gamal there, the chief executive of Mindwork Strategies and former Pentagon advisor. Now, there's a brand new show launching this week at Bloomberg Deals, which premieres on Wednesday at 5 p.m. London time. This is Danny Berger going through some of the biggest names in business, talking about deals and M&A. Up next, it's Bloomberg Brief, and this is Bloomberg.
Trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Only on Bloomberg.
On AI, some people would say that there's maybe a little bit of a bubble in AI. When you have companies with market caps of $5 trillion, you don't see any bubble there at all?
Whenever we have an acceleration in technology and people get excited about it, you have significant capital formation around new companies that are trying to capitalize on that opportunity. And we've seen this before through history, and you're seeing it now. It won't be a straight line. The opportunity set with AI is enormous. There will be winners and losers, and it's hard to pick the winners and losers now. And certainly a lot of the capital that's being deployed will not produce adequate returns, and a bunch of the capital that's being deployed will actually not produce any returns. But it's hard, it's hard to call the timing on these things. And the thing I'd point to, just from a historical lens, is in the fall of 1996, Alan Greenspan talked about irrational exuberance in stock markets, and the NASDAQ was at 1,300. And the NASDAQ peaked 3.5 years later at over 5,000. So, these things can go on for a long time, but ultimately, there are adjustments, there will be drawdowns, there'll be rebalancing, and just, it's hard to call it, because the technology trend and the investment is real.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
It's 5 a.m. in New York City. Good morning, I'm Bonnie Quinn with your Bloomberg Brief. Let's get you set up for the day. Metals plunge, gold and silver continuing to give up those spectacular gains. The dollar holding it up as the market sizes up a Warsh-led Fed. Oil also dropping in a broader commodity sell-off as Iran-US tensions seem to ease and weather forecasts improve. And tech under pressure. Jensen Huang saying the $100 billion OpenAI investment was never a commitment. All right, an abject lesson in volatility. That's what our MLive strategist Van Ram is calling the last few days, particularly in silver, down 40% in 3 days. Many traders out there, he says, have never seen the likes of it. That is definitely causing some contagion, but we've also had 2 days of a market sell-off, right? The Nasdaq 100 was down almost 1.5% on Friday. Looks like we're setting up for a negative day once again today. Let's take a look at the bond universe. Not seeing too much movement there, so relative stability with the 30-year yield still at about 4.85 and that 2-year yield at 3.52. The market continuing to size up what a Warsh-led Fed might mean. Let's take a look at those metals, though, because that's where all the action has been. We had that massive run-up. Well, now gold is back at 47.21. I mean, it was still an elevated level a few weeks ago, but certainly in recent days, that level looks pretty tame. We're seeing silver also back down to $82 an ounce. That had got up to almost 125. And then the dollar index, well, that's holding up. The Bloomberg dollar index relatively unchanged today. Want to point to copper and Bitcoin as well. Bitcoin trading through some relatively important levels, if you like, although what levels are important for Bitcoin anymore is anyone's guess. All right, let's get to some individual market movers now. For that, we'll go over to London and Chloe Melly.
Good morning, Bonnie. Oracle is down this morning after announcing plans to raise as much as $50 billion to boost cloud infrastructure capacity so that they can meet demand from big customers like Meta, TikTok, and NVIDIA. And this really shows the scale of the financing that is needed to support the AI boom. And maybe investors are getting a little worried about whether those massive investments can pay off. And so we are down this morning. Moving on to miners, which are also in the red for the second day in a row after the massive sell-off that we saw on Friday. This sell-off in gold, silver, and copper triggered by the announcement that Kevin Warsh will be the next Fed chair. And this sell-off is continuing today and therefore putting pressure across that mining sector. And finally, for every loser, there is a winner. And the winner when it comes to falling silver prices is the jewelry maker Pandora, which is having a great day in Copenhagen today, up about 8%. And this really puts it in a good position ahead of results later this week.
Chloe, yes it does. Thank you so much. Chloe Melly there in London. And coming up later this hour, we're going to catch up with Ella Good of BNY Investments Newton on what a Kevin Warsh-led Fed would mean for markets. Let's get back to those commodities then. Precious metals extending losses today with spot gold falling as much as 10% in this session. For more, Bloomberg Intelligence metals analyst Emmanuel Mangieri joins us now. Emmanuel, volatility just absolutely off the charts. We have plenty of, reasons being put forth, including Ed Yardeni talking about margins, basically causing some of this liquidity event to happen. What would you say are the main catalysts behind the massive drop we've seen, particularly in silver?
Hey, morning. Yeah, thanks. Good to be with you today. So, like you say, lots happening, a lot of moving pieces. As mentioned before, the Fed chair, definitely one of the key drivers behind the sell-off and the nomination of somebody to be more hawkish, as Fed chair proves for a stronger dollar and obviously not as supportive for gold and silver particularly. And then to what you mentioned about the CME margins and raising those margins, essentially what we're seeing is it requires a lot more capital, a lot more liquidity, and a lot more of those future positions. Two things can happen. Number one, either raise that liquidity or that capital to cover those positions, or number two, you sell off your positions. And that obviously accelerated the downfall from the Fed chair that we saw within gold, silver, platinum, the entire precious metal segment. Silver had rallied hard, but we were always cautious to silver in terms of our view, and it was due a correction. The gold-silver ratio was sitting below 50, which is well above historic normals. So it's come back down to that 60, about that 60 level. But yeah, that is called the devil's metal, or referred to sometimes as the devil's metal for a reason, because of volatility, especially when gold falls off or gets sold off, that hits silver a lot harder.
Yeah, absolutely. And I'm sure many people are cursing it as the devil's metal today. Emmanuel, what kind of contagion could we be seeing, or are the moves in some of the other asset classes pretty isolated?
No, I wouldn't call this isolated. I think we have to look at the fundamental drivers of these metals and these commodities. Our long-term view on gold is still quite positive, and we're still quite bullish. Yes, we're going to see a lot more of the short-term volatility that we've seen at the start of this week, towards the back end of last week. But you're still going to have the support from central bank buying, and that remains elevated, particularly from emerging markets. geopolitically, that uncertainty and the whole macro environment is still quite uncertain. So that all those supportive factors are still there for gold. Yes, one of them has fallen away in terms of the Fed independence. And obviously this flows onto the other metals, such as silver, platinum, palladium. But we have to look at them in tandem or look at them separately. For silver, the industrial case still remains. We're still quite positive that the market is going to be in deficit. Yes, it does carry, it's a quasi-metal. It's got gold factors or precious metal status factors, but it's also an industrial metal. So we have to look at those factors, and those still look supportive. So yes, it had rallied quite too hard in our view, but do we see it continue to crash? No, we're still positive on the outlook, just given that fundamentally it is still quite well supported, especially given the demand from the renewable sector.
All right, we'll see how the session progresses. Emmanuel, thank you so much. That's Emmanuel Munderi there of Bloomberg Intelligence. Oil on the decline as well, as geopolitical risk seems to ease a little bit, with President Trump saying Washington and Tehran are talking. That's after Iran's supreme leader warned of a regional war. We want to get to Patrick Sykes now for more. So, Patrick, on the one hand, we have an armada headed in Iran's direction, and on the other hand, we seem to have this ratcheting lower of tensions in terms of rhetoric. Can both be, true at the same time?
Yeah, that is the truth on the ground, right? We've still got those military assets moving towards Iran. Trump saying over the weekend that they're a couple of days away, so he's trying to clearly build the pressure in that perspective. But on the other side, just this morning, the spokesman for the foreign ministry in Iran was saying that there are various messages going through various intermediaries via regional countries between the US and Iran. And they're also saying the key quote there was that they're reviewing and making decisions on the details of each diplomatic track, and they hope that will yield results in the coming days. So Iran signaling at least some optimism, cautious optimism, that diplomacy could give some kind of result, perhaps within the week.
This started as President Trump concerned for Iranian citizens that were protesting, right? Now we're talking about nuclear checks and so on. What will be the fundamental drivers of these talks?
Yeah, it's fair to point out that, Trump's stated target since those protests began has been a moving one, right? From the start. The latest kind of stated goal that we have from him is to get Iran to agree to some kind of new nuclear deal. We did have the Iranian foreign minister saying last week that Iran would never negotiate over its ballistic missile program. That's, of course, another source of tension with the US, not to mention Israel closer to Iran. But for the moment, the focus is on nuclear. Iran as well this morning saying that their main priority is sanctions relief. So, we're kind of in a world pre the June war of last year where they both sides seem to be approaching a deal. But that parallel also, makes us stop and pause because that process was interrupted previously in June by those surprise Israeli and later US strikes. So diplomacy on multiple tracks is going on for sure, but I think there's a lot of caution among Iran watchers and no doubt in Tehran itself about how much to trust the US in this process.
All right, Patrick, thank you so much. That is Bloomberg's Patrick Sykes there. Now to other top stories trending on the terminal this morning. Oracle is planning to raise $45 to $50 billion this year to build additional capacity to meet the contracted demand from its largest cloud customers, including AMD and OpenAI. Oracle plans to raise half of the funds via equity-linked and common equity issuances, and the rest via single issuance of bonds early in 2026. NVIDIA CEO Jensen Huang says the company's proposed $100 billion investment in OpenAI was, quote, never a commitment. Huang said that NVIDIA will invest, quote, one step at a time, and described the potential investment as huge and potentially the largest investment we've ever made. And Disney is close to picking its parks chief, Josh D'Amaro, as its next CEO. D'Amaro has led the unit that delivers most of Disney's profits since 2020 and will succeed Bob Iger if approved. The appointment will conclude a 3-year CEO search, which since 2024 has been led by Disney chairman James Gorman. Disney reports before the bell today. Coming up, Ukraine says a Russian drone strike on a bus has killed 15 civilians ahead of another trilateral meeting with the US. We speak to the CEO of DTEC, employer of the workers killed in that strike. That's next. This is Bloomberg.
This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
Watch Bloomberg Tech.
This is the Asia trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Jemima Bersecci in Davos, Switzerland, and this is Bloomberg.
The trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
Let's talk about significant risk transfers to find space in their balance sheet.
Hedging some of that risk.
You could look at it the other way. Obviously, this stuff is risk-weighted.
I would much rather be long than be short.
We're in a kind of sweet spot.
Very, very strong alignment.
3 revolutions in one.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Every trading day, only on Bloomberg.
This is Bloomberg Brief. I'm Bonnie Quinn in New York. Ukraine President Volodymyr Zelensky preparing for the next round of trilateral meetings between the US, Russia and Ukraine. He says the talks are set for Wednesday and Thursday and posted on X, quote, Ukraine is ready for a substantive discussion and we are interested in ensuring that the outcome brings us closer to a real and dignified end to the war. Joining us now is Bloomberg's Greg Sullivan. Greg, is there any hope that this round of talks will lead to any kind of breakthrough?
Well, so far, and this is the continuation of earlier talks that we saw that happened last month here in Abu Dhabi. So far, it's not clear what progress, if any, has been made, though the warring parties did sit face-to-face, and the talks will continue later this week, as President Zelensky said. It's very clear that one of the biggest issues, though, which is the Kremlin's demand for territory that it does not control and hasn't been able to seize militarily from Kyiv. Little progress has been made on that. The Kremlin has not backed away. And of course, Ukraine is very hesitant to cede territory that it still does control, and that also is heavily fortified and could carry security consequences down the road. So that issue, we've seen very little progress made on it, even as these talks continue. Now, the talks were supposed to happen this weekend. It's unclear why they were delayed till Wednesday and Thursday, as we heard. We did see Russian envoy Kirill Dmitriev travel to Miami and meet with Trump's envoys Steve Witkoff and Jared Kushner. But again, not clear what progress was made there, if any, though both sides cast that as constructive.
All right, Greg, thank you so much for the update. That is Bloomberg's Greg Sullivan. Meanwhile, officials say more than a dozen people were killed in central Ukraine when a Russian drone struck a bus transporting DTEC mine workers. The company said the strike was part of a large-scale Russian attack on DTEC mining facilities in the region. Bloomberg's Oliver Crook is standing by now with the CEO of DTEC. Oliver.
Yeah, that's right, Vani. Thanks very much. We're very happy to be joined by Maxim Timchenko, who is the CEO of DTEK, which is Ukraine's largest private energy company. Mr. Timchenko, thanks for joining us this morning, albeit under very tragic circumstances with you losing 12 mine workers, from what we understand, in an attack on a bus yesterday. First of all, can you give us an update on what we know? Last time I spoke to your team yesterday, you were still gathering information.
Thank you, Oliver. Yes, yesterday was one of the darkest days in the history of our company. You know that we are at this war since 2014. As an energy company, more than 10 years we're on this energy front, and yesterday it was the largest single loss of our people. And coal miners just going home after the shift to their families, their houses. They were targetedly attacked by Russians, by 2 drones, which brought to this disaster and loss of lives of our people. So unfortunately, this is what Russians do. Russians do with civilians.
Yeah, and your workers are often in the line of fire, you know, obviously fixing substations, connection points, power plants that are often the subject of Russian attack. Are you able to determine whether this was part of a more broader attack on the energy infrastructure in DTEK, or was this a one-off within the region? What can you tell us about other sort of damage that has been done?
No, since October last year, we experienced daily attacks on our energy infrastructure. Either it's on frontline, our grid, transformers, power lines, or our power stations or our coal mines. But the cynicism of these attacks is that the same place as they attacked our people yesterday, only after 6 hours they attack our coal mine and facility of the coal mine, just 20 meters from this strategic place. And this is basically the face of Russians. There is no limits for them. They attack civilians. They destroy life of people.
And when we last spoke about 6 weeks ago on December 23rd, you said this was going to be the hardest winter Ukraine has had yet, amid several very difficult winters. And just to give people some context in terms of what that means, obviously tens of thousands of people periodically have been without electricity, without heat. And I just looked it up this morning that in temperatures in Kyiv today are a high of minus 14 degrees with a low of 23 degrees Celsius. So in Fahrenheit, that's 6 degrees Fahrenheit for the high and low of negative 9 degrees Fahrenheit. Can you give us a broader update of the energy situation currently in Ukraine? Last time we spoke, you said that since September, about more than 50% of energy generation had been knocked out or damaged in some way. Is that figure higher today or lower? Do you manage to restore some of it?
Unfortunately, this figure is higher, and that's the primary reason why our people stay without electricity for more than 20 hours every day. So we have apartment blocks without heating for weeks. And the average temperature in apartments is plus 6, plus 8 degrees. So basically, Russians bring us to unlivable conditions, millions of our people. Energy supply is extremely important for us, is to have some break to recover and to ease the situation. But unfortunately, with such weather conditions, extremely difficult to do. I just visited our power stations. You can imagine in our machine building, the temperature is minus 10. So under these extreme conditions, it's very hard for us to recover power stations, to recover our turbines, to relaunch our facilities.
And I wanted to ask you about some of the other conditions. Obviously, the military, the war is going to be one of the main factors influencing the energy situation. But there's also been reports over the weekend of large power blackouts due, I think, well, you'll know better than me, and we'd like to know and I get an idea, due to ice and the weather conditions. What can you tell us about those blackouts? And is there a chance that it will happen again? You have your sort of arms around the issue. Can you prevent it from happening again?
Yeah, this kind of blackouts eventually is the result of Russian attacks and destruction of our equipment. After 5, 6, 7 attacks of each power station, each power unit, of course, the state of this equipment is very low, very bad. That's why weather conditions or any other reasons can bring us to such a blackouts or such a consequences as we observed just 2 days ago. We're in a difficult situation. We're at survival mode now.
And then we also heard from President Trump saying that he made a plea to President Vladimir Putin, saying that there should not be any attacks on Kyiv, potentially not any attacks on energy infrastructure for the next few days, for the next week. Has there been any sign, as you are the operator of one of the largest sort of power companies within Ukraine, that there has been some kind of energy ceasefire in the last few days? And how long do you expect it to last if there has been evidence of that?
First of all, we are very much grateful to the President Trump for this initiative. 1 year ago, he agreed already on energy ceasefire and helped us to recover important parts of our equipment, be more prepared for the current winter. And now, yes, at large extent, we see that it's still honored. For the last 3 days, there is no large attacks on our infrastructure. But it's matter not days but weeks, which we need to recover what was destroyed recently. So that's why for us it's extremely important that it will prolong.
And do you have any idea how much longer you expect it to last?
We hope that our team and our people can negotiate for longer time. So it's difficult for me to make any predictions.
Okay, well, Maxim Timchenko, the CEO of DTEC there, thank you so much for your time on what is a very difficult day, obviously, for Ukraine, as it is every day, but in particular for you today. And with that, Vonnie, I'll hand it back to you in New York.
Absolutely, Oliver. Thank you so much. That is Bloomberg's Oliver Crook. Coming up, President Trump says he'll close the Kennedy Center for 2 years this summer. More on that and what else is making headlines in your front page news next. This is Bloomberg.
The phone is, what's great about it is it's a well-developed gaming ecosystem, right? So, folks know to find games there, but it's also a highly competitive gaming ecosystem. So its developedness gives you both that upside and that downside. But what's exciting is that now we are moving beyond the phone to the TV. So I mentioned like one of the big gaming areas we're going after. One of the big gaming areas we're going after now is social gaming experiences that will show up on your TV. So we are now announcing, we're going to announce here actually, that we're going to have these social party games that you can play on your TV with your phone as the controller. And it's things like, recognizable games like Boggle, you got Pictionary, we've got a Lego party game. We, basically are going to like unleash this with a bunch of creators, and they're going to go figure out stuff that we didn't even imagine that they can do with that interactivity.
Investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
Know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
Time Time now for your front page news. First up on the New York Times, President Trump announcing the Kennedy Center will close in July for a 2-year reconstruction project. This coming after the center has been rocked by cancellations and boycotts by performers, contributors and audience members in recent months. Trump has attached his name to the center, installed loyalists to run it, according to the Times, and called for changing programming to make it more in line with what Trump is calling, quote, widespread American tastes and sensibilities. Next up, the Washington Post reporting the Trump family crypto firm, World Liberty Financial, sold a 49% stake to a UAE investment firm just days before Trump's inauguration. The investment was reportedly worth $500 million. The UAE's national security advisor and royal family member, Sheikh Tahnoun, was involved. A White House spokeswoman said President Trump's assets are in a trust managed by his children and there are no conflicts of interest. And finally, the Wall Street Journal on a Texas election upset that's being dubbed as a wake-up call for Republicans. The Journal saying the state-level Democratic win really in a Texas region that voted for Trump by 17 points threatens to diminish Republican hopes for the midterms.
Tariffs, I think, are probably the first time in my career I've had to deal with like a fundamental change in government policy in terms of how we think about how markets work.
The challenge, especially within my supply chain, is now how do you have enough productivity initiatives to offset the increased cost of all the product?
Can you just move your supply chain out of China and into the U.S. or out of Mexico and up to Canada? Is it that easy?
It's not that easy, but we do have flexibility. And we had been, prior to tariffs, prior to any of this, we had been on a journey to diversify our footprint out of China. So probably 2-ish years ago, roughly 65% of our toy and game volume was coming from China. Today, as we entered into 2025, that was around 50%. All we've done is really accelerate the path to get down to roughly, call it 30% by the time we enter into 2027. For us, I mean, if tariffs stay, if tariffs go, it's never good to have so much of your manufacturing base centered on one geography. We think the diversification is good, but it does take a bit of time to get vendors and suppliers up to speed. Quality is a big deal, especially when you're dealing with toys and kids. It's not an instantaneous thing, but it's not also a 5-year, have to build a new plant from scratch.
What is going to be the consequence for U.S. markets? We have gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
It's 5:30 a.m. in New York City. Good morning. I'm Bonnie Quinn with your Bloomberg Brief. Let's get you set up for the day. Metals plunge. Gold and silver continuing to give up spectacular gains. The dollar, though, holding up as the market sizes up a war-led Fed. Oil also dropping in a broader commodities sell-off as Iran-US tensions ease and, of course, weather forecasts improve. And tech under pressure. Jensen Huang saying the $100 billion OpenAI investment was never a commitment. Let's look at these markets because it looks like we're in for another down day following 2 down days at the end of last week, with the Nasdaq 100 finishing Friday down 1.3%. Van Ram, our MLive strategist, calling the drop in metals an abject lesson in volatility. Silver was down nearly 40% in 3 days. It's actually briefly turned negative on the year in this session. Bond-wise, though, we're seeing relative calm. We have the 30-year yield just below 485, the 10-year yield at 421.56, and the 2-year yield holding in just above 350 as well. Obviously, sizing up what a Warsh-led Fed might mean, and not maybe coming to conclusions just yet until we know more. Let's look at those metals, though, because that's where all the action was over the last couple of days. Really, traders would not have seen anything like this, particularly the younger ones, as our MLive team says today. Lots of interpretations out there. Paul Donovan saying this drop has relatively little economic significance. He says more likely the FOMO trade becoming exhausted. Ed Yardeni saying, look, CME participants were forced to liquidate because of the increases in maintenance margins, which happened twice in the last couple of days. He actually says Warsh's nomination should be bullish for precious metals because Warsh favors stimulating growth with lower interest rates. So there's lots of interpretations, like I say, out there. But let's get to some individual movers now. A few hours before the U.S. market open, here's Chloe Melly.
Good morning, Vonnie. Oracle is down almost 4% this morning after announcing plans to raise as much as $50 billion so that it can boost cloud infrastructure capacity and meet the demand from big customers like AMD, NVIDIA, and Meta. And so this really shows the scale of the financing that is needed to support the AI boom. And it's leading investors to maybe be a little bit worried about whether those massive investments can really pay off in the long run. And so we are down in pre-market trading this morning. Moving on to miners, which are in the red for a second consecutive day after the massive sell-off in precious metals that we saw on Friday. We saw gold, silver, copper sink on Friday because of the announcement of the next Fed chair, which was seen as quite a hawkish pick and led those commodities tumbling. And we are seeing that again today with gold and silver also falling. And therefore, this is reflected in that this pressure is reflected in those shares across that mining sector this morning, all in the red. And finally, even though silver prices tumbling is bad for miners, it's actually great for Pandora, the jewelry company, which is seeing a strong performance today in Copenhagen, up about 7%, because it means that the cost of making this jewelry is going to be a little bit less now that silver is less expensive.
Yes, a little relief for Pandora there. Chloe, thank you so much. Chloe Melly there. Ella Gooda of BNY Investments Newton says risks abound even after some immediate relief following President Trump's nomination of Kevin Warsh for next Fed chair. She writes, quote, short-term inflation expectations are rising and bonds are not priced for an inflation comeback. Ella is head of fixed income and co-head of real return and joins us now. Very pleased to have you. Ella, you know, you're a little bit worried about persistent inflation. If we do see persistent inflation, how does a Warsh-led Fed, how does Kevin Warsh even make the case for rate cuts?
Well, I think the whole argument and the conundrum, I guess, to solve for is going to be on the productivity issue. So will we see significant enhanced productivity in the years ahead, let's say over the next couple of years, to actually make up for this boost that we're seeing on nominal growth that's also coming through the reindustrialization of the economy, not just in the US, but across the board. So I think that's the big question mark. I mean, my argument would be that on the way to getting to that productivity story, the risks on inflation are actually pretty high. And so it's quite easy to conclude we will get that productivity boom, but it's not certain. And certainly when you look at the inflation expectations at the short end, as we were saying earlier, those are starting to tick up. And so when you look at how bonds are priced, I would argue that they're pricing very little premium for that. And so this is the argument we're making.
Right. And so your answer to that is seemingly to get out of treasuries for the most part, right? What are you doing in terms of your holdings?
Well, I mean, we still have a risk-seeking portfolio across the board, so we still expect equities to benefit from this enhanced nominal growth and this rebuild of the AI infrastructure and industrialization across the world, really. So that's a positive, but at the same time, you know, it's going to likely come at a cost, right? So either we have contained inflation or we don't. But the asymmetry is that we potentially might get some. And so this is, I guess, where the, you know, in a portfolio you want to lean probably still on on the precious metal side. So gold has a place in a multi-asset portfolio. You want to lean on steeper curves to continue and perhaps own bonds in those jurisdictions where you're getting paid a significant positive real yield, and away from those where the risks are actually potentially on higher inflation or lower real yields.
I want to come back to what you just said about precious metals in a moment, but just to drill down on that, you're maintaining your lowest duration in 3 years in the fixed income space, and you're staying away from 10 years plus maturities. And as you say, you're looking elsewhere, places like, France, JGBs, maybe even the Antipodeans.
Yes, away actually from JGBs, because we still have to reprice real yields higher in Japan. I think that's been the trend over the course of the last year or so, at least. And in France, mostly because of the makeup of the political risks on the fiscal side. But gilts we continue to like, and as you say, the Antipodeans, and there's significantly positive real yield in emerging markets in local currency terms. So lots of places where you can get paid a decent yield without having to take some of this risk.
What would entice you back to the US? What would a Warsh-led Fed have to do? I mean, yes, he's talking about, maybe getting rid of forward guidance, or he has talked about that in the past. He's talked about, potentially getting, he hasn't said getting rid of the SEP, but I mean, it looks like if we had a Warsh-led Fed, we may not have that sort of interest rate guidance that we have been used to getting. I mean, what would that mean for the Treasury market and for the yield curve?
Very difficult to know right now. That's why I think bond markets will demand more premium. That was the reaction in the curve. So we saw some steepening of the curve, slightly lower yields at the front end, but generally, as you were saying earlier, very little volatility, very little moves. So I think on the whole, it's inconclusive right now. And the main reason is that you have a composition of voters at the Fed. So there isn't just a Kevin Warsh Fed. There is basically other members of the governing council. And so it will depend very much on the data. That's why we're saying you need this productivity story to allow you to ride much lower interest rates. That's perhaps number one. Number two is on the liquidity side. So if Warsh favors a lower balance sheet for the Fed, that has implications for liquidity. Actually, that would not entice us into treasuries, the predominant reason being that actually lower liquidity is negative for treasuries, particularly out in the maturity curve. And so this is, the reason we're staying away. What would make us be more interested? The inability to lower that balance sheet at the Fed, as well as much lower inflation prints. This productivity story would probably be supportive of treasuries. Those would be the reasons to own it.
I do want to come back to what you mentioned about precious metals and how they play a role in a portfolio, but anybody looking at the action in the last 3 days might be terrified to allocate to precious metals. What would you advise today?
Yes, I mean, of course, if you're buying early January into mid-January, you probably didn't have a nice experience. But look, I think this is the point about structural allocation. Metals have started to move a long time ago. Of course, in some cases, like with silver, it's a more difficult argument to make in terms of price discovery. But I think when it comes to gold, that argument has been pretty persistent for us. And just as we discussed for bonds in an environment where debt levels are high, geopolitical cross currents are rising, and you have some inflation risk premium that needs to come in. I think the argument to be made that bonds stabilize our portfolio is more difficult now than used to be the case pre-2022. So this is essentially the argument we're making. We're not looking at a one-day vol, two-day vol, despite how nasty they were. But actually the argument to make, in fact, is that over the last 3 months, you've had substantial rises in precious metals across the board, and also in metals miners and so on. So I don't think that ship has sailed yet.
Okay. Ella, thank you so much. We'll have you back soon to see what happens with the progression of this metal story. Ella Guda of BNY Investments Newton. Now to other top stories trending on the terminal this morning. Disney is close to picking its parks chief, Josh D'Amaro, as its next CEO. D'Amaro has led the unit that delivers most of Disney's profits and will succeed Bob Iger if approved. The appointment will conclude a 3-year CEO search. Disney also reporting before the opening bell today. Shares of AstraZeneca will begin trading on the New York Stock Exchange today. The listing upgrade will replace its ADRs that have been trading on the Nasdaq. The UK's biggest drug maker makes almost half its revenue in the US. And Bad Bunny makes history at a politically charged Grammy Awards. The Puerto Rican singer took home the top prize, the first time the album of the year went to a Spanish language work. Winners at the ceremony spoke out against the ICE crackdown on undocumented immigrants, with Bad Bunny saying, quote, ICE out. Other winners also dedicated their awards to immigrants. Coming up, House Speaker Mike Johnson confident a deal to end the partial government shutdown could come in a matter of days. More on that next. This is Bloomberg.
I'm David Weston. Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. We go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
We need more transparency.
Oil and gas is still important.
They said every citizen should be investing in the market.
Accelerate progress in all fields of science.
Watch Wall Street Week right here on Bloomberg. More than what you need to know, it's what you need to think about.
I'm Alex Rodriguez.
And I'm Jason Kelly.
And we're back with another season of The Deal.
With athletes and entrepreneurs who are changing the game on and off the field. Jerry Jones. Some good-looking trophies.
1 and 1 is 3 in sports, not 2. And it's because that 3 is imagination. That 3 is putting yourself in a way, having yourself hit the home run.
Erica Ayers-Badon.
I'm a high-energy board member. I'm very passionate. I have a lot of opinions.
Robin Arzón.
I want to light fires in people's lives, and that is still one of my core mandates for all of my businesses.
Justin Tuck.
I tell all of my friends that play in leagues now, make these relationships now while you're hot. Don't wait till you're like your 12th year in and you're just hanging on.
Stay tuned. You won't want to miss it.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
There's a lot of details in this. We could get deep in the weeds, but we will do that over the next 2 weeks. And I hope that Democrats will be in good faith, as Republicans are, to try to bring some order. I think even Tom Homan has acknowledged both of those things are acceptable and what he was intending to do already. So I think we're on the path to get agreement, and I really hope that everybody will come to the table in good faith. That's what's going to be required here.
The U.S. government has been in a partial shutdown since Saturday, but House Speaker Mike Johnson confident there the two parties will agree on a deal for federal immigration enforcement. Joining us now from Washington is Bloomberg's Kasia Kimishinska. Kasia, how does this proceed? What kind of talks or deal-making is ongoing?
Washington is struggling with two issues here that are related. One is funding the government, and the other is trying to find a way to limit the anti-immigration enforcement conducted by the Trump administration that led to those two tragic shootings and killings of Americans in Minnesota. Because remember, it was after the killing of Alex Pretty that Democrats said, we can't do this anymore. We can't agree to fund the Department of the Homeland Security, which is the department responsible for enforcement of anti-immigration measures. So now the House has to agree what measures will be taken to limit this enforcement in order to be able to fund the government. As right now, as you said, we are in this partial government shutdown, and the House Speaker hopes that the agreement will be reached today, perhaps with a vote as early as tomorrow.
Kasia, when we turn abroad, President Trump saying Iran is talking to the U.S. and there's a lot happening. I mean, what is happening exactly?
We saw weeks of escalating tensions between the US and Iran, very strong rhetoric on both sides. Iran warning of regional war over the weekend, and President Trump kind of trying to have it both ways, saying that he hopes that they will talk, that Iran will agree to a nuclear deal, but also the US increasing its presence in the region, its military presence. And the latest here for the semi-official Tasnim agency is that we might see some significant high-level talks between the US and Iran in coming days.
Kasia, I have to ask you about this state-level Texas election that went Democrat, right? And it was a surprise. It was a jurisdiction that includes Fort Worth, and it was a huge swing. What is Washington, D.C. saying about this election this weekend?
Definitely a big surprise, perhaps the first time that you and I can discuss a local state Senate election in Texas here on air. But it was a very surprising win by a Democrat, even after President Trump got involved and endorsed a Republican running in that race. That was a seat that Republicans have held for more than 40 years. And here we go. We have a Democrat who is running on those issues of affordability, of lowering costs, public schools, bringing back reason to the politics. So, of course, it's a surprise and a victory for the Democrats that they already frame as a broader message, as a sign of President Trump losing traction and really failing on in a lot of areas with the policies on affordability, as you mentioned, ICE and immigration, anti-immigration enforcement. But on the other hand, it's a very small local race.
All right, Kasia, thank you so much. Kasia Klimashinska there for us in Washington, D.C. Turning to tech, shares of Oracle taking a dip in the pre-market after the company announced plans to raise up to $50 billion this year for its cloud infrastructure capacity. Let's bring in Bloomberg's Neil Campling for more. Okay, so it's raising the money, Neil. Is it the money that it's raising or how it's raising the money that's causing a little skepticism, let's say, among investors?
Morning, Bonnie. I think, for one thing, the stock is lower because they have said that half of this funding is going to come through equity. So there will be a sense of price discovery that will affect the stock price. I think the key question now, of course, is when are we going to see a return on investment, which is the big question that happens with all of these AI investments taking place. But where Oracle differs from many of the other big tech companies is Oracle's balance sheet is pretty levered. It's got a net debt on the balance sheet, whereas many other big techs have net cash. And I think what Oracle are doing here partly is because they want to protect that investment grade rating on the debt side, having seen those CDS blow out last year. So it's a different kind of strategy. I think what was surprising to some investors was actually that they announced this on a Sunday evening, and perhaps also that unlike some of the other deals we've seen in AI, there was no sign of any backstops in terms of private equity or Middle Eastern sovereign wealth funds.
Yeah, exactly. I am curious, though, the stock down around 50% from its record in September, so maybe that's partially why, the equity portion of the raise. Can we move to the NVIDIA story, though, because this is really casting a pall over markets today, and you have to think Jensen Huang knows he moves the market when he talks, right? So when he said that it was never a commitment, this $100 billion investment in OpenAI, surely he knew that that was sending a message to the market, investors, and so on. What was he trying to say?
I think the message is that he's trying to convey fiscal prudence and discipline. So the previous stories last September were they were going to invest $100 billion in OpenAI. He said at the weekend they're going to make a huge investment, but he wouldn't commit to what that number would be, which I think is actually a good sign that they are going to sort of weigh the options for every investment they make. They're not stepping back from the AI ecosystem, but they are saying, he's saying, that we are going to be fiscally careful with all of our dollars that are spent on this ecosystem.
Yeah, but is it because investors have gotten a little bit skeptical about the whole, the amounts of money that are being thrown around? Because he very definitely said to the reporter, oh no, nothing of that size when it came to the 100 billion. So is he just hip to the fact that, investors are getting a bit more wary of these eye-popping numbers?
I think so. I think if we look back to the fact that the Mag 7 has been under some pressure in terms of stock performance, if we look at some of the comments that came out of Davos in recent weeks, and if we look at the price reaction to Microsoft's CapEx numbers and the growth rates for Azure last week, then we could say it's a healthy sign that investors are not willing to bet on AI without any fiscal discipline. And I think Jensen is playing into that we are going to be careful with the investments. So I think that's an important message to convey, that investors have said, let's see some returns on this investment coming through in AI.
We'll see what else he says in Taiwan. Neil, thank you so much. Bloomberg's Neil Camping there. Let's turn to autos now, and BYD's EV car sales dropped 30% in January. This is winding back of subsidies hurts demand in China. For more, let's bring in Bloomberg's Craig Trudell. Hurts China, but also there was a front-loading of purchases knowing that these subsidies were going to come to an end, right? So how much are EVs becoming less popular, and how much is this a sort of just a leveling off story, and we'll see numbers revert to sort of quote-unquote normal in coming months?
Yeah, I think it's always a little bit dangerous to sort of overread into trends in the first months of the year, because seasonally it's always the slow point for the auto industry. That being said, these numbers were a bit on the troubling side, and that's reflected in the move in the share price. And it was something that we saw across the Chinese car makers today, with a lot of weakness across even manufacturers that fared better in January, Geely being the main example there. So some concern about whether or not we may, see some real softness across the industry as a result of those subsidies falling by the wayside.
And you have to wonder what it'll mean for US EV makers as well, given that China had started to become so popular here, and international sales were down 25%, or shipments at least, in January for China's overseas sales. I have to ask about Waymo, because it's looking for about $16 billion, which would value the Alphabet unit at $110 billion in valuation. I mean, I guess investors seem to be flocking to this. New investors now include Sequoia Capital and Dragoneer. Craig, what more do we know?
Yeah, I think, the expectation here is that Alphabet will still be, kind of the main player in helping Waymo raise more money. We've seen, for some time that's been a major advantage for Waymo, in that, we've seen, other players that have been trying to compete with them in this very costly space of developing a self-driving system, have run out of patience, or run out of time with, their owners. I think about, GM and Cruise, and Ford and Volkswagen, their AV company, Argo AI, a few years ago, that was shut down as a result of the fact that progress was taking so long. So, we're now seeing real progress in Waymo's business, where, more and more cities across the U.S., they're deploying, and they're looking actually to put driverless vehicles on the road here in London before year end, and also looking at Tokyo. So this is no longer just a U.S. story for Waymo, where they're also trying to go international and increasingly compete with the Chinese players in this space as well.
Craig, thank you so much. That is Craig Trudell there in London. Coming up, we're going to get you set up for your trading week with central bank decisions and, of course, the non-farm payrolls, potentially. This is Bloomberg.
East and Africa regions are home to some of the biggest deals and fastest growth in the world. Vibrant resources and high-yield investment opportunities abound. I'm Jumana Versace. Join me on Bloomberg Horizon's Middle East and Africa for the stories, newsmakers, and insights shaping the decisions of traders across this exciting region.
You had heightened levels of volatility.
There's still room to maneuver.
Reduce the opportunities.
It allows you to increase significantly your net income.
Every trading day, only on Bloomberg.
Bringing you the world's business and financial news whenever and wherever it happens. I'm Michael McKee at Mount Everest, and this is Bloomberg.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Hazlida Amin in Davos, Switzerland, and this is Bloomberg.
Now a look at what's ahead this week. Disney reporting earnings today before the opening bell. Then, of course, we have Alphabet, the big one, on Wednesday, and another big one with Amazon on Thursday. Plus, ECB and BOE rate decisions coming on Thursday. And we wrap up the week with the payrolls report scheduled for Friday. Let's take a look at the macro environment as we move into today after a sell-off the last 2 days of last week, and we're seeing NASDAQ 100 futures pointing to an open about 1% lower once again today. Now, obviously, this has something to do with the sell-off in precious metals. Gold down another 3.9%. That 4,700 mark, really incredible when you think that we had gone past 5,500 just last week. The dollar index, though, holding up after some recent gains. That's it for Bloomberg Brief. Surveillance is next.
Such an incredibly exciting moment with AI. It is really the most profound technology of our lifetimes, and I think it has the potential to help us rethink literally everything. The potential for economic impact, societal benefit is honestly boundless. When we think about the economic impact for Europe in particular, it's around a 1.2 trillion euro estimate of the productivity growth that can be unlocked. This platform shift that we are living through, I think, is going to create untold amounts of value for the world, but also for the businesses and for economies, which is why I'm incredibly optimistic in this moment for Europe, but also for the whole world.
How do you think about job losses or safety for some of the AI tools?
You know, I hear the anxiety, and I understand the anxiety about jobs. I think that we are certainly going to live through a massive transition about how people learn to work alongside these tools. I mean, the reality is I do think there'll be some number of jobs that are displaced. I think it is a smaller number maybe than some anticipate. We estimate it's around 7%. And I think what's important is that we have programs that help those 7% transition into new fields of work. I think what is more likely is that most of us are going to learn to work alongside these tools. So we estimate about 2/3 of us. If you think about the tasks you do in your daily life, when you look at every industry, there are administrative tasks that are happening everywhere, and that's what AI is most helpful in improving.
of politics to the world of business. Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Of the 4 candidates that were out there, I would say that Warsh was probably the worst.
I expect him to be tested in the same way that markets tested every single central banker.
This is going to be a very interesting confirmation process.
I fully expect that Kevin Warsh will get through eventually.
What will be more important is how the economy evolves.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Monday, meeting gravity. This year's big winners now threatening to undo this year's equity gains as the explosive rally in precious metals develops into a 3-day rout, and AI's big funding needs are receiving a skeptical response. Jensen putting a question mark over OpenAI.
So this is the exact quote when he was speaking to reporters over in Taipei. It was never a commitment. He's talking about the $100 billion investment in OpenAI. They invited us to invest up to $100 billion. I also invite anyone to invest up to $100 billion in me. And of course we were very happy and honored that they invited us, but we will invest one step at a time. Why was he doing this? What was he signaling to markets, given the fact there are a lot of ways to phrase this? This seems like a full step back from this commitment.
Particularly after this followed a Wall Street Journal report going into the weekend that suggested he's indicated and criticized the lack of discipline in OpenAI's business approach. None of that looks good. Spare a thought for Oracle, who are also coming out with all of their funding needs for the year ahead and saying they need to raise as much as $50 billion this year. Not great timing for that headline from that company.
Yeah, $50 billion in debt and equity, and right now you're seeing the stock say, I don't think so. And right now there's a real question, is there overinvestment in the wrong assets? And the fact that NVIDIA suddenly is saying, hold on a second, we need to reassess, raises some questions about this trade, but also the messaging. Jensen Huang has to know what the market's reaction is going to be. So why would he phrase it this way? And by the way, I also would be grateful to invite anyone to invest this amount of money.
Well, he was forced to phrase it this way because the Wall Street Journal reporting over the weekend, basically Jensen Huang putting a lot of criticism on OpenAI, even though he'd come out and said he thinks it's a fabulous company, it needs to do well, and NVIDIA wants to invest in it. Over the weekend, the Wall Street Journal really digging into some of his private comments behind the scenes about the concern he has and what he calls the lack of discipline at OpenAI.
It's a tough start to the week for a lot of people in this market. Let's put it that way. The Kospi in South Korea down by 5%. Gold and silver getting absolutely hammered over the last few sessions. Gold off the lows, we're still down by 4%. Energy in the mix as well. We've all talked about that tight relationship between precious metals and equity risk. You're seeing that play out this morning.
Yeah, although the why is sort of a big question. How much is this technical and how much is this fundamental? There's a huge discussion around the short squeezes that have taken place and the fact that even if you see the biggest two-day sell-off in silver on record, you still are up for the year if you bought at the end of last year. So a real question here about whether this is just a pop off the top or whether this is something that has deeper significance.
We've got a lot to talk about this morning. Coming up this hour, we'll catch up with Lori Calvasino of RBC as this year's big winners unwind. We'll speak to the former senior U.S. intelligence official Norman Rule as U.S.-Iran tensions ease, and Andrew Sheets of Morgan Stanley as markets struggle to price a Kevin Warsh-led Federal Reserve. We begin this hour with stocks sliding on course for a 4th day of losses as precious metals plunge and the AI trade meets some resistance going into earnings this week from both Alphabet and Amazon. Joining us around the table is Lori Calvasino of RBC Capital Markets. Lori, good morning.
Good morning.
What would you tell clients who ask you, Lori, what is this morning?
So look, I think there's a whole lot of stuff hitting the market all at once. And we said coming into this reporting season that it was a chance for investors to kind of push the macro aside and focus on the micro. The macro has been pretty pesky in terms of sticking around in unusual ways. And I would also argue that the micro has been a little bit underwhelming. If you look at the beat rates and just a very simple, kind of gauge on how reporting season is going, last week, it was about 77% of companies were beating consensus estimates. Now that sounds good. This is for the S&P 500 until you go back and look at last quarter when it was like 82, 83%. So, and we're seeing similar things on the rates of upward revisions, about 51.4% to the upside. Back in September, that was 65%. So, we've described this as slightly squishy, not a disaster, but not good.
Squishy is not a word I would use to describe what happened with Microsoft just last week. Luckily for them, Kevin Walsh happened to the Federal Reserve, and we barely discussed it on Friday. Is that a warning ahead of Alphabet, ahead of Amazon?
So look, I think the other thing we have to contend with, if you go back to the second half of 2025, and it seems like ages ago now, it's been such a long start to the year, but we really noticed all the way back on Labor Day that we were seeing AI jitters coming back into the market. We've seen the PE multiple of the S&P 500, just a simple forward PE, hit a ceiling and be unable to penetrate it since really August. So we've been kind of seeing the multiple shift around. And I think especially on these top 10 market cap names, they're pretty much priced for perfection. The bar is high, and there's not a lot of room for error. I'm not an expert on any one of these individual stocks, but I can tell you that there was a healthy appetite, even before all of these macro issues sort of hit the market, of diversification. Do we need to diversify away from some of these big mega cap growth names? And that hasn't gone away.
Are some of these big mega caps passing the baton in terms of earnings growth to smaller companies? Or is the squishiness that you're talking about pervasive across different tenors of the equity market?
I feel like some of that is going on within technology, but I'll tell you as a generalist, when I look at sort of the broader S&P 500, I'm getting very frustrated in my reading. And so, I think it's pretty well known by those who follow our work that we spend a lot of time on my team reading through earnings call transcripts. Nobody wants to talk to us during earnings because they're all busy, doing the same thing. And the reality is that I get excited when I get to the tech companies. Like when we finally got a bunch of them last week, I felt like I had better things to read. And I do feel like, if you're going outside of tech and looking at the end users of AI, right, which is sort of going to be the next phase, they're using better examples and they're getting more granular, and like it's more interesting stuff to read. It's not just like, hey, we're adding to efficiency. Hey, we're adding to productivity. They're giving us some real examples. But I almost want to say, like, where's the beef? Where's the numbers? Where's the numerical impact to revenues? Where's the numerical impact to margins? Where's the numerical impact to earnings? We're just not getting it yet, and it's probably because it's not there to get. And I think that's the issue with kind of rotating within this AI trade. I can kind of see it happening within the tech space, but is it broadening out beyond that tech space where we're seeing really measurable impact? I don't think we're getting it yet.
So what would it take to get to another phase where suddenly you could see equity markets rise in tandem in the hope for AI to come back? Or do you see this as actually beginning the sort of step down in terms of valuations and enthusiasm?
So, I think that valuations can generally hold pretty steady, but I do think what it has encouraged me a little bit is that in the Q&A portion of earnings calls, we are starting to see analysts ask the question. And, that's where some of these better answers are coming out. And I forget which company it was, but there was one that actually said, we wish we had better specifics to give you. And I thought that was actually a very intellectually, kind of honest response. So I do think the analyst community is starting to push a little bit harder, but I don't think we're going to necessarily get it this reporting season.
When you look at the discussion when it comes to the earnings report, some of the commentary you talk about in your note is the consumer color.
Yeah.
What is these companies saying about the consumer right now and the health of the consumer?
So you kind of have to take it week by week. And if you go in the first 2 weeks, we mostly got sort of derivative looks at the consumer, meaning, big banks coming out and telling us, hey, all the stats look good. We're not seeing any red flags. That's been a very consistent message for several quarters now. And that does feel like it's holding up. I would say last week we finally started to get like some specific consumer companies that really understand what's going on boots on the ground level. That messaging hasn't changed all that much, which you're still seeing, kind of the companies that are more on the experience side of things are saying things still look pretty good. That's been a key theme. We did see one consumer company, really, kind of talk about how they had seen weakness in big ticket items and those sorts of things. So I would say the narrative is still coming out, but it does seem to be pretty consistent with what we heard last reporting season, which is, yes, the aggregate spend is still healthy, but there are problems underneath the surface. Not in every company, not in every vertical. People like to go around and, talk about whatever fits their narrative. But if you look at it broadly, it is still pretty mixed. And there's still signs of consumer stress under the surface.
Overall, though, it does seem like, based off this reporting, the consumer is resilient. What else is standing out to you that basically is on concerns of the C-suites?
So I would say early on, the first 2 weeks, and I did feel like I heard less about this last week, but it just felt like the first 2 weeks geopolitics cast a pall over the entire kind of broader outlook discussion when companies are sort of talking about kind of vaguely, kind of what they're expecting in the year ahead. That did feel like it got a little bit better last week. I think that for all the financial companies, and they were still, a significant chunk last week, but sort of the interest rate credit card cap issue was coming up. We are seeing like other policy discussions that are coming up, and I would say generally on those, whether it's something healthcare related, even housing affordability, companies are sort of still casting those as manageable. We're glad the administration is focused on this. But that interest rate credit card issue is one that keeps coming back like a bad penny.
It's not going away, is it?
No.
Is that putting a dark cloud over the financials for you?
What we said, we're overweight the sector and we like the sector. We think that investment banks had a problem on the valuation front. So it didn't overly worry me that first week when you saw some of them getting hit, kind of more mixed results. We've liked the regionals better. We've thought generally outside of that kind of capital markets area, valuations have looked pretty good. Earnings revisions have looked pretty good. But we did, sort of poke holes into maybe one pillar of our thesis. And there are, like 5 or 6 reasons why we like the sector. One of those had been the perception that the policy tailwinds were stronger than the headwinds there. And so we did sort of call that out after the first week. And, when we wrote our recap that, we might need to question that assumption.
You're right to point out some of the jitters, and some of the headlines too were sell America. The good news this morning, notable I think, is that bonds are actually running. Bonds are running and yields are down by a couple of basis points across the curve.
Yeah, and is this because ultimately it is having the same kind of reaction function? I'm sitting here listening to Lori talking about the idea of credit card caps, and I'm thinking about the new Fed pick and the idea of easy policy. And I wonder, is the idea of deregulation and accommodation getting squishy? Right? The idea of you give with one hand, you take away from the other. You give less regulation of the banks, but you cap some of the interest rates. You necessarily lower rates at the front end, but you might shrink the balance sheet. It's sort of like, how do you understand this in markets? And right now, it's squishy.
That was Friday's story, struggling to price Kevin Walsh at the Federal Reserve. Did you have similar conversations with clients?
So look, in talking to our rates team, I think what they always stress, right, and they try to take kind of a middle of a road approach on this, that this is a committee decision at the end of the day. And I think they're sort of sticking with that thesis. When I sort of take a step back looking at it from an equity market lens, what I really noticed was that the Russell 2000 didn't do well after the pick. And we also were looking at that after the Fed meeting on Wednesday. I have this little screen on Bloomberg set up, so I watch all these, kind of different sectors and parts of the market and how they trade after 2 p.m. And we actually saw, the S&P was flat, but the Russell 2000 lagged a bit, and then we saw it get hit again on Friday. And what I thought was very interesting about that was something, kind of my rate strategist had said, he was talking about in his market, kind of these short-term trades might unwind quickly. In my world, the short-term trade equivalent is the Russell 2000, because fast money hedge funds like to bid it up on Fed dovishness and sell it off when their dovishness goes too far and they have to take it in the other direction. I have also pointed out that beyond, kind of this Fed issue, kind of going back and forth, they're just not cheap anymore. They're starting to get back to November 2024 highs on a couple different PE metrics, and they're not net short anymore in the CFTC data. So that does, it's a space we've generally felt better about. The earnings data is looking a little bit better there. But if you were just buying the small caps on the Fed, you got your answer on Friday. What should happen there?
The Russell futures are down by another 0.75% so far this morning. Laurie's going to be sticking with us. S&P 500 futures down by 0.6%. With an update on stories worldwide with your Bloomberg Brief, let's cross over to Vonnie for more. Hey, Vonnie.
Hey, John, good morning. A partial U.S. government shutdown entering its 3rd day. House Speaker Mike Johnson is hoping for a vote on funding bills today. Minority Leader Hakeem Jeffries saying Democrats want an agreement on their demands for reforms at DHS before they'll vote in favor of the package to reopen the government. NVIDIA CEO Jensen Huang saying the company's proposed $100 billion investment in OpenAI was, quote, never a commitment. The Wall Street Journal earlier reporting the investment plan announced in September had stalled after some people inside NVIDIA expressed doubts about the deal. Huang downplaying the report, saying NVIDIA will continue to invest in the ChatGPT maker. Disney is close to naming a new CEO to succeed Bob Iger. Sources telling us here at Bloomberg the company's board will likely promote theme park division chairman Josh D'Amaro. D'Amaro has led the unit that delivers most of Disney's profits since 2020. The board is expected to vote in the coming week. Disney also set to report earnings within the hour. And that is your Bloomberg Brief. John.
Watch this space in the next hour. Who knows, we might get an update. For those of you worried about a Bob Chapek repeat, then the good news this time around is James Gorman's running the succession planning and not Bob Iger.
Yeah, it seems like right now there is probably going to be a successor, and that person is going to stick because evidently Bob Iger enjoys his yacht and wants to spend more time on it.
Why not? And the reason I mentioned Gorman is because he oversaw such a fantastic succession plan over at Morgan Stanley.
Yeah.
Ted Pick doing phenomenally well.
He just had an incredible quarter and ultimately has become chairman, and actually is succession, not repeat, come on back, let's do this again.
What a mess,
It is
honestly.
a mess.
More on that story in just a moment. We'll catch up with the Walt Disney story in about 17 minutes' time. Up next on the program, gold losing its shine.
I don't think anything's really changed fundamentally on the gold side, so I still believe it's going to go back up. It's going to be very volatile over the next week.
Up next, we'll catch up with Bloomberg's Will Kennedy, live from New York City this morning. Good morning.
Is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe. I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie. This is your opening trade.
Only on Bloomberg.
World's most powerful investors don't ring a bell. They quietly reshape entire industries. This is the money shaping the world. The Dealmaker playbook, where power and billions of dollars change hands every day. From private equity and credit to venture capital and M&A, we bring you the inside scoop on the biggest deals and debates, plus exclusive conversations with finance's ultimate insiders. I'm Danny Berger, and this is Bloomberg Deals. Every week, only on Bloomberg Television.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
3-day slide on the S&P 500, developing into day 4. Equities are down across the board. We're negative by 0.6% on the S&P. On the Nasdaq 100, down by 0.9. Don't think you can overstate the importance of the story around NVIDIA and OpenAI. We can get to precious metals in just a moment, but the pushback from Jensen Huang, I think, is very important.
$100 billion, as they had in a letter of commitment last September, is not necessarily an actual commitment, and they will evaluate each investment one step at a time. It raises a question, especially given the reporting over the weekend about Jensen Huang's concerns about OpenAI. Is this just the beginning of a pullback in terms of funding OpenAI more broadly, some of the more speculative investments?
It's an invitation, not a commitment. They don't need to follow through, and that's what seemed to be spooking some of the market about what is going on with OpenAI. And to your point, Jonathan, what is going on with Oracle doubling down again, the need for debt. Zero Hedge was talking about, well, this isn't just to expand their AI infrastructure, it's actually to make sure they have cash by the end of the year.
The Nasdaq underperformance so far this morning. NVIDIA's down by about 1.9%. I mentioned precious metals. What a move. Under surveillance this morning, gold losing its shine.
They've paused. We know on Friday that hedge funds have reversed positions in both gold and silver, and ETF flows have been absolutely gigantic over the last several months. I don't think anything's really changed fundamentally on the gold side, so I still believe it's going to go back up. It's going to be very volatile over the next week. Once we get through this volatility, it's still going back up.
So here's the latest this morning. An explosive rally in precious metals developing into a multi-day rout. Gold extending losses this morning, at one point nearing its biggest 2-day drop in more than 4 decades. Bloomberg's Will Kennedy joins us now for more. Well, I think we're all waking up and asking the same question. What happened over the previous few days, and what was this morning?
Well, I think that we quoted someone today that this trade
had become very, very crowded. And clearly the precious metals rally is a story that's been developing over the last year. And it just accelerated and accelerated, and I think it got to the point where it was unsustainable and some form of correction was necessary. But yes, indeed, it's been dramatic, and I think it's been particularly dramatic because both the up and now the down has been driven by a lot of retail investors coming in through ETFs and now coming out, especially in China.
Well, it's not just what's happening in precious metals, it's also base metals. We've seen it in copper as well. And this morning you're seeing it in crude. WTI and Brent down by 5% or so. Are they different stories or the same thing?
It's partly the same thing. I think that what's happened in precious has got people a little bit bearish on the whole commodities complex. But in oil, there is also the Iran in the background. There are signs that Iran and the US are talking and that they may be able to avoid a conflict. And of course, that is the biggest geopolitical risk in the oil market right now. The threats that we've heard from President Trump that he may take military action against Iran. And if those threats are off the table for a while, it's quite bearish for crude. So you've got that story, you've got the commodities sell-off, you've got the dollar playing into commodities as well, and you put that together, and that's why we've seen this quite chunky move in crude this morning.
Massive move. Crude's down by 5% on WTI, Brent's down by 4.9. Well, just before you go, how orderly is some of this? The physical market, what do things look like? What are you hearing from contacts?
So I think we should differentiate between the gold and the silver story here. Silver has become very speculative, very frothy, quite probably disorderly, if you want to use that word, on the way up and the way down. Because the thing about silver is it's not bought by central banks, it's not held as a reserve by central banks. And what had been driving the gold rally had been, at least, especially initially, central bank buying, this whole idea of central banks needing to diversify away from their dollar holdings. And I think you had a guest on earlier explaining that trend probably remains in place, and that the macro story for gold probably is still there. So I think as we look forward, we should probably differentiate between this rather crazy silver market and what's going on in gold, where the long-term stories that people have been talking about probably haven't fundamentally changed.
Well, thank you. Will Kennedy out of London on the latest moves in the commodity market. Check out silver at the lows today, just in today's session, down by 16%, and right now down about 2.9.
The rise has been absolutely shocking. There was this one statistic that I read over the weekend that I loved. For years, silver accounted to 5 to 7% of the cost of manufacturing a solar panel. Today, it accounts to 15 to 20% of the cost of each solar panel because of how much prices have increased. How, as a manufacturer, do you price and source some of these resources if it's trading like a Bitcoin or if it's trading like a penny stock? And this is increasingly the question because it is something that people actually use.
This is why the trade was loved so much from the long side, because you had that industrial component and that precious metal component as well. But to Will's point, volatile on the upside and volatile as we move to the downside. This has been pretty explosive stuff in both directions for that metal.
And frankly, the trading's gotten a lot thinner, and there's a real question of who's going to step in and buy. And ultimately, right now, people are wondering if Chinese retail buyers are going to step in and buy the dip. And if they do, then they'll get more excited to maybe go and follow. But at this point, how can a respectable trading house put any kind of risk on the line when it's unclear what the drivers are and you've got increasingly thin liquidity?
Lori Calvasina of RBC is still with us. Lori, I wanted to talk to you about the relationship between precious metals and what's happened with equity risk, the correlation between the both, the traditional correlation and what we've seen play out more broadly in the last 12 months or so.
So when I talked to Chris Looney, our gold strategist at RBC, the thing he emphasized coming into last week was the dollar and uncertainty really driving the gold price. Checked in with him on Friday, and he said, look, we've obviously seen some volatility here, but he thinks the uncertainty story is going to stick around this year. So I think it's a question that comes up in a lot of my meetings is, why are equities ignoring X, Y, Z? And, what my response is that equities are not ignoring X, Y, Z. They are shifting underneath the surface to the sectors that might benefit from X, Y, Z, or might, shifting away from the ones that may be hurt. But primarily what we're seeing, right, is the realization of kind of that itch to sort of protect against those macro risks going to things like gold, right? I can't tell you how many times in my year ahead outlook discussions I was asked, what is Chris thinking right now? And I think the reality is you kind of do this with one hand and you do this with the other hand, right? I think that's what's been going on a lot in my world.
Do you expect a tight correlation to continue between equity risk and precious metals?
I think we have to see going forward. I think the reality is there are just not a lot of fantastic alternatives. And I do think that within the S&P, kind of that AI big mega cap tech story had been one way to play defense, right? And so when you're sort of concerned about whether it's geopolitics, macro, the economy, whatever it is, you can go to secular growers. Well, now are those secular growers starting to look, a little bit less attractive? So I think it increasingly pushes people outside equities to protect against those risks.
How much is all this volatility Kevin Warsh's fault?
I'm not the best person to ask on that. I tell people when I go to Europe and I go to Canada, they want to talk about the Fed. They want to talk about geopolitics. They want to talk about Greenland, all these issues. And when I come home to the U.S., they want to talk about earnings. And so, they're just very, very different focuses. To me, what I've told people is if you look at the equity market performance in different kinds of Fed rate environments, I don't have to get too caught up in this fight. We had a new component of our modeling this year that looks at how equities perform in a 12-month period when the Fed is either doing nothing or hiking or cutting by a certain amount. The best environment for stocks is when the Fed does absolutely nothing. If you look at the next two best, it's when the Fed is hiking or cutting 100 basis points or less in a 12-month time frame. So my only kind of dog in this fight is I don't want the Fed to be doing too much.
I know we don't talk about Bitcoin very much, but Bitcoin's down some 25% in the past couple of months. And I'm just wondering if that signals to you that it's correlated with precious metals, that it's correlated with something else, or that, frankly, the bubble's bursting.
Well, it's funny. I have a chart in my weekly, which we put out this morning, and I was updating this one on Friday, so it doesn't sort of show the activity over the weekend, but it had actually already shown as of Friday that Bitcoin was breaking down a bit, and then also there's this index looking at private markets-related stocks. And we started looking at that after, kind of October, November. We have a few other things on the chart, including the S&P. And what we basically show is that, a lot of these different gauges of risk all kind of broke down at the same time in October and early November. And we often can see that when Bitcoin breaks down or just, it can be not necessarily a leader of a decline in the equity market, but at least a sideways kind of move, causing some indigestion. So we watch that religiously in the weekly. And we did call that out, that, you're seeing both that private markets index, which nobody's talking about, by the way. That's just not coming up in conversation these days, at least in my meetings, and then Bitcoin also breaking down. Is it sort of confirming that we need a little bit of a breather in this market?
Laurie, it's good to see you. Thoughtful stuff. Thank you. Laurie Calvasina of RBC Capital Markets. Up until now, the stock market quite resilient in the face of these pockets of real volatility, crypto being one, JGBs being another, gold, precious metals more recently.
I think that all risk assets, dollar denominated, were up last month, despite all of the headline risk. That just gives you a sense of your point.
Up next on the program, we'll catch up with Norman Rule of CSIS as the US and Iran turn down the temperature.
We have two crises,
two essential crises, and for both it's now or never: democracy and climate, and they are absolutely interlinked. And we have to solve them together. We're losing the democratic infrastructure and norms to deal with the climate, and we're losing the climate stability that is essential for a democracy. We have to solve them together. We've never faced a threat like this to our democracy at a time when it's a perfect storm, at a time when we're being told by climate scientists, some of you may be in this room, that we have to cut our emissions, fossil fuel emissions, in half in 5 years now. You know, when I started to realize what was happening, it was 12 years, and we haven't done it.
Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
We are on the longest losing streak of the year so far. 3 days, could become day 4. We're down again this morning by 0.5 on the S&P, negative by 0.8 on the Nasdaq 100. Precious metals also getting hammered this morning. We're down about 2 or 3% on gold. Silver recovering. The volatility in silver is just absolute nonsense. Down 16% to down 1.97.
I love this.
For no reason. Based on what we've seen.
Yeah, we've escalated from, you know, a lot of volatility to just sheer nonsense. And I think a lot of people are viewing it that way, which is a reason why you've seen actually people pull back from trading it. What is spurring this, and how much is being driven by retail investors over in China?
Well, when John's saying nonsense, this is basically the tone Paul Donovan of UBS took this morning. Has FOMO lost its mojo? Basically, people trying to spin this when it comes to silver and gold as fundamental economics. It seems more likely that the fear of missing out trade has become exhausted.
We've got a lot to track, and it's exhausting so far already this morning. Futures recovering, we're down about 0.5% on the S&P. Let's get you an update on some single names, some morning movers. Yahara has more. Hey, Yahara.
Hi, John. As you guys have said, the precious metals rally has come crashing down, and we're seeing mining stocks falling as a result. We're seeing Barrick Gold down 2.5% here in the pre-market. And Lisa, you asked what is driving this? Well, Ed Yardeni saying the sell-off may have started with President Trump picking Kevin Warsh to lead the Fed, but the bigger driver was the CME raising margin requirements, which forced traders to liquidate their positions. Meanwhile, Oracle shares also falling in the pre-market, down 3%, as the company says it plans to raise up to $50 billion to fund its AI computing build-out. Roughly half of that would come from debt, adding strain to an already heavy balance sheet. So the concern here is that borrowing more before AI profits show up could add strain to cash flow, which is already negative, and pressure credit ratings. And Bitcoin ending the month of January lower, its 4th straight monthly decline, something we haven't seen since 2018. And we start February not on a good note. Bitcoin this morning below 78,000, and that is hitting crypto-linked stocks like Coinbase and Michael Saylor's Strategy, which is down 7.5%, and it now owns Bitcoin worth less than what it paid. John?
Yahara, thank you. More from Yahara in the next hour. On our radar this morning, gold and silver extending losses into a 3rd consecutive day, nearly unwinding their recent record-breaking rally. At one point, gold nearing its biggest 2-day drop in more than 4 decades. Elsewhere, NVIDIA CEO Jensen Huang saying his company's proposed $100 billion investment in OpenAI was, quote, never a commitment. Huang adding that NVIDIA will invest one step at a time, calling the potential deal, quote, the largest investment we've ever made. And finally, House Speaker Mike Johnson confident the partial government shutdown will end by tomorrow, approving the plan would fund Homeland Security for 2 weeks, allowing more negotiating time, while the rest of the government would be cleared through September.
I could just say I'm really happy that it took a half an hour for us to talk about the government shutdown that begins today, because it indicates that it's not on people's radar, which is a positive thing, and I really hope personally that it gets resolved quickly. Right now, the affected agencies are the Treasury, Defense, Homeland Security, Transportation, Health and Human Services, and Labor Departments. What about the data? Do we get the data? The labor market report is going to come out on Friday, and that ultimately, to me, is my main question.
We get it if Speaker Johnson is accurate in his confidence that we will avoid this by Tuesday. If it goes longer than Tuesday, I'm not sure we get the data, the non-farm payrolls report coming out on Friday. And I think it is a little bit more of a tricky calculus right now. There was a call over the weekend between Democratic leaders, Hakeem Jeffries and his caucus, and then he had to go tell Mike Johnson, don't count on Democrat votes for this. So it is going to be a little bit more challenging, and I don't think they're out of the woods just yet. I'm not counting on it ending tomorrow.
I was hoping to go through the whole show without talking about this at all.
Well,
never mind the last 60 seconds.
Someone just, shoehorn that in there just to, wreck your day.
Well, we might not get the data if it stays shut.
65K is the estimate for Friday, by the way. I hope we actually see the number. The previous number was 50,000. Elsewhere, let's turn to geopolitics. Crude prices falling as President Donald Trump looks to strike a deal with Iran.
Why wouldn't he say that? Of course he would say that, but we have the biggest, most powerful ships in the world over there, very close, a couple of days, and hopefully we'll make a deal. If we don't make a deal, then we'll find out whether or not he was right.
Iran's Supreme Leader warning of a possible regional war. Bloomberg's Jumana Basenji joins us now from Dubai for more. Jumana, good morning. Are we close to a breakthrough here?
I think that's a big question. Diplomacy is definitely back on the agenda again, John. If you compare where we were going into the weekend on Friday, I think there was a feeling that perhaps military action was imminent or possibly could happen over the course of the weekend. We walked in today, and it really feels like the diplomacy angle is the angle that has been actively pursued over the last 24 hours. And a lot of the push has been from Gulf Arab nations. You know that the Qatar Prime Minister, Foreign Minister, traveled to Tehran. He met with Ali Larijani, who's the Secretary of the Iran National Supreme Council. After that, Larijani posted on X that a framework for negotiations had been agreed to. They've also had calls with the Egyptians, with Turkey as well. And so really, there has been a push to bring Iran back to the negotiations table. Now, here is the question. What exactly are they going to be negotiating? Because what we understand is that the Trump administration wants to tie in 3 elements into this round of negotiations. It's not just about their nuclear ambitions anymore. They also want to include the ballistic missile arsenal and the fact that Iran still sit on a huge number of short and mid-range ballistic missiles. And they also want to bring in the discussions around Iran funding many of those proxies in the region, including the likes of Hezbollah and Houthi. The Iranians have said that those last 2 elements are non-starters at this point in time. They're willing to continue negotiations on nuclear, but not necessarily the other 2. And so it is going to be interesting to see whether there is daylight between the 2, whether these negotiations can actually push forward. They're not direct, as we know, they're indirect. And at the same time, the U.S. President Trump, has warned of that huge military presence, the armada that's being built up in the Arabian Sea, the arrival of the Abraham Lincoln, the F-15, the F-35, the buildup of troops in the region as well. All of that as a means of deterrence. But some people are saying maybe they're just biding time and waiting to build up a stronger presence before we actually go down the military channel.
Jumana with the latest out of Dubai. Jumana, thank you. Jumana Basenji there of Bloomberg. To extend the conversation, joining us now is the former senior U.S. intelligence official, Norman Rule. Norm, I think Jumana's asking the right question. Negotiations. What's up for negotiation?
Well, good morning. Diplomacy continues and to remain the administration's primary goal with Iran, but significant U.S. military action is a serious near-term possibility. The nature of the U.S. force buildup and Iran's continued unwillingness to make the substantial concessions that Washington seeks bring us to a continued impasse. A U.S. military strike on Iran could begin with little notice. It is true that diplomacy dominates the landscape, but the Trump administration will not tolerate its time being wasted. Regional partners are indeed focusing on an intensive diplomatic campaign, but the Trump administration's demands have been consistent. They're harmonious with what it has been asking for years and previous administrations. Substantial concessions on Iran's nuclear weapons capability, its ability to build a long-range missile program to include an ICBM program that could threaten the United States, and regional militia programs that destabilize the region. If Iran does not concede on this, there is a high likelihood of military action in the near term.
Norman, is diplomacy then just a real option, or what you're describing it maybe, is it just a distraction tactic?
It is a real option, and I think the Trump administration has actually played this well. It has used rhetoric, it has used the threat of significant tariffs, and it has used this military buildup to produce a dynamic in which multiple countries are now pressing the Iranians to produce concessions that would achieve what all of these countries want. None of these countries want an Iranian nuclear weapon, missile threat, and all these countries oppose Iran's regional malign adventurism. So, in essence, we all want the same thing. It's just Iran refuses to cooperate. The challenge is that to do this, Iran will have to make substantial changes in the DNA of the regime itself, and politically, it's been unwilling to do so. The hope is that because of the unrest and the significant economic challenges the regime faces, that this might be a moment where the regime's leadership, in order to seek regime long-term survival, may be willing to make those concessions or begin a process to do so. So it's not an unwise tactic that the administration is pursuing. The question becomes, is there a reason to believe that it will be successful without military option? And there is reason to be pessimistic.
Well, you've been watching Iran for decades. Any evidence that they are willing to make some of those concessions?
None.
So that basically leaves the United States with likely a military option. Is that accurate?
No, it means that I haven't seen the evidence. The evidence may be classified, and the diplomatic process is still underway. There is reporting that U.S. Special Envoy Witkoff and the Iranian foreign minister may meet this week, perhaps in Ankara, and that process may produce additional pressure. The U.S. Military presence in the region is truly dramatic. It is providing the United States with a capability that Iran will understand, allows the United States a capacity for intensive multi-day air and missile capacity over virtually any part of Iran against which Iran cannot compete. So this is going to create a conversation within Iran itself, and therefore that evidence may not exist today, but it may build up over coming days. And again, that's the process the Trump administration is trying to create. So the Trump administration is not doing anything unwise. It's creating a dynamic that it hopes to achieve an end.
Meanwhile, Norm, we have heard from Iran that this will cause a regional war and warns of that as one sort of deterrent to the United States. Do you have a sense of what the region's neighbors and behemoths, frankly, think of all of this? How much is the U.S. building up troops in coordination with Saudi Arabia, Qatar, Israel, and the others?
Okay, so sure. So first, whenever this happens, Iran knows it cannot compete militarily with the U.S., so Iran threatens to disrupt the global economy, to transform this into a regional war, to use asymmetric tools. So it's fallen back on its traditional tactic. It's conducting a live fire naval maneuvers in the region, and it's trying to show that it could close the Strait of Hormuz, which it could do temporarily. The United States has responded by pushing out a vast amount of air defense to its partners in the region over the last several days to improve their protection. We would be able to clear the Strait of Hormuz. It would take some time, and how long, it depends. And of course, the partners in the region are doing what they normally do to ensure that the global energy market is well supplied, as it would be through storage, through releases from strategic reserves, so that if there were an interruption in the Strait of Hormuz, it would be temporary. And also, I should say that if Iran were to do that, it would have no strategic impact on the course of the campaign in Iran itself. So Iran just is playing whatever card it's got. It can't compete on the campaign in Iran, so it's trying to use diplomatic pressure externally to convince other countries to convince Washington not to attack.
Hey, Norm, appreciate the analysis this morning, sir. Thank you. Norman Rule there of CSIS. Crude, Brent, and WTI trading lower this morning. The prospect of de-escalation between those two countries contributing to some of that move so far today. This is the story I wanted to get to. Disney, the Walt Disney Company, putting out earnings. Adjusted EPS 163, the estimate 156, and the park business getting it done, which is interesting when you consider the succession planning going down at the company.
Yeah, the person who is likely to take over is the person who is running the parks division division, I believe Josh D'Amaro, who may be announced as soon as this week as the board meets to discuss who Bob Iger's replacement is going to be. This has been the leader. Very curious to see some of the other questions around the controversies and what happened with late night television and everything else that evidently pushed Bob Iger to say, I think I need to spend more time on my yacht.
The stock is just about unchanged in the pre-market so far. Let's give you an update on stories elsewhere this morning with your Bloomberg Brief. Is Vonnie Quinn. Hey, Vonnie.
John, thanks. Yep, Disney shares falling in the pre-market. The company reporting first quarter earnings that beat on both the top and bottom lines. And Disney reportedly close to naming a new CEO to succeed Bob Iger. Sources telling us here at Bloomberg, the company's board will likely promote theme park division chairman Josh D'Amaro. Elon Musk is taking steps in a massive consolidation of his empire. Sources telling us here at Bloomberg, Musk is merging SpaceX with his artificial intelligence firm xAI. A potential announcement could be coming as soon as this week. Representatives for both SpaceX and xAI didn't immediately respond to requests for comment. Fifth Third announcing it's closed its historic merger with Comerica. The deal creating what will be the 9th largest U.S. bank with approximately $294 billion in assets. Fifth Third CEO Tim Spence saying, quote, "We are creating a stronger, more diversified bank that is well positioned to deliver exceptional value." And that is your Bloomberg Brief. John.
Hey, Vonnie, thank you. Appreciate it. Up next on the programme, the President pushing for rate cuts.
Do you have a sense of what he's going to do as far as interest rates are concerned?
I hope he's going to lower them. I hope he's going to lower them.
Up next, we'll catch up with Andrew Sheets of Morgan Stanley.
This is a 15, 16 grams tuna. Then sushi rice is still a little bit warm. So take one, like a very, don't make it too tight. So from now, and very light, like a little ball. Put wasabi in the middle. Then my process 1 to 6. 1. This is putting the between the rice air. Then make the 4 fingers curl. Make sushi shape. Then touch this. 2. Then turn. Now these 2 fingers, top of the bottom, make the sushi shape more beautiful. 3. Then, I mean, looks like pushing, not pushing. 3, 4, turn, same way, 5, and 6. So this is 1 to 6.
Trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
Let's talk about the significant risk transfers to find space in their balance sheet.
Hedging some of that risk.
You could look at it the other way. Obviously, this stuff is risk-weighted.
I would much rather be long than be short.
We're in a kind of sweet spot.
Very, very strong alignment.
3 revolutions in 1.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Every trading day, only on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Equity softer, we're down by 0.4% on the S&P, we're down by 0.75% on the Nasdaq, and down another 0.5 on the small caps. The Russell 2000 trading lighter, softer, lower, negative by 0.49% so far this morning. Under surveillance this morning, the president pushing for rate cuts.
I think he may get Democrat votes soon. I think he's so good that he'll probably get Democrat votes. He should. It's very good. My choice, my Fed choice, should get Democrat votes.
Do you have a sense of what he's going to do as far as interest rates are concerned?
I hope he's going to lower them. I hope he's going to lower them, but you know, he's going to have to do what he wants to do. He's a very high-quality person. He should have no trouble getting through.
So here's the latest this morning. Markets looking to price a Kevin Walsh-led Federal Reserve. President Donald Trump's nominee, known on Wall Street for being hawkish on inflation. Andrew Sheets of Morgan Stanley joins us now for more. Andrew, good morning. We've said it a number of times over the past week or so. Who is Kevin Walsh? What does he stand for when he becomes the Fed chair?
Well, thanks. Good morning. It's great to be here. Look, this is something that the market is going to need to figure out. And I would say the good news so far is that the initial reaction that we've seen, I think, is the reaction you would associate with credibility, right? Over the last couple of weeks, there have been real questions around the stability of the U.S. dollar. You've seen large increases in precious metals prices, and the reaction to Warsh's nomination or the perceived nomination would be that gold prices were down, silver prices were down, the dollar was higher. So I would say that's one important factor. The second factor, though, that we have to consider is this is a difficult job in the best of times, and this is an especially difficult job now. Inflation's above the Fed's target. Mortgage rates are still higher than I think a lot of Americans would prefer, and valuations are high in the market. And so this is also, he's going to be coming into a Fed with some challenging things to navigate.
The endorsements on Friday were pretty notable. We're talking about establishment figures, defenders of the liberal order, Geeta Gopinath, Mohamed Al-Erian, the Canadian Prime Minister Mark Carney. The list just got longer and longer going into the weekend.
People really think he's good because he has the credibility of having been on the Fed, having been an economic actor for a long period of time. I just wonder if legitimate is commensurate with predictable, and whether we really can understand exactly how he's going to go forward.
But also other individuals like former Secretary of State Condoleezza Rice, Jason Furman, who worked under Obama. Does that actually make it harder potentially for the MAGA wing of Trump's party to embrace this Fed chair pick?
It would be nice if we can turn the volume down on the Fed speak. And I do wonder if that's the direction Kevin Walsh is going to take things.
Rich Clarida, the former vice chair and currently at PIMCO, said this: Walsh, based on his writings since leaving the Fed, may be much less likely to rely on extensive forward guidance about the future path of interest rates, especially during normal times, as in the case today. In other words, are we watching the death of forward guidance?
Is the market already there, less reliant on the communication coming up from this Federal Reserve anyway? Lisa pointed out going into the weekend, and I think rightly so, that the story in markets has been elsewhere, away from the Federal Reserve in the last 12 months.
So I'm actually not sure it has fully moved away. I mean, I do think one remarkable factor of this year is that despite everything that's happened, you know, kind of constant weekends dominated by big events, is that implied volatility on U.S. rates is lower than where it was on January 1st. And so I do think this fact of maybe less forward guidance, less communication, a market that I think has gotten very used to a Fed that is telling it where it's going to go, how fast it's going to get there, what it's thinking at all times. If that really is going to be a major change under a Walsh-led Fed, that would be a major shift. And we think that could support a steeper curve and higher volatility as the markets just have to adjust to this different regime.
At the same time, just to sort of build on what John's getting at here, there's a sense that right now the market rises and falls more on Jensen Huang, the central banker to the world, than Fed Chair Jerome Powell. And there's a sense that ultimately this is kind of a, not boring time, but it's a time for the Fed just to sit back and do nothing. Isn't it just true that it sort of depends whether Kevin Walsh gets tested? Otherwise, it kind of doesn't really matter?
So I think that testing question, I think that's exactly right. And again, I think if we think about the market and the risk to the market environment, one would be that you see disappointment out of one of these big tech-led enterprises where the market is clearly very optimistic about the future. But the other is that we haven't yet really seen a tension between what the Fed, I think, would like to do, which is bring rates down, and the underlying data yet, right? So far, the data, even though inflation is still above the Fed's target, you still have somewhat weak jobs growth. You've had enough to convince the Fed to get closer to neutral. what happens if the inflation data remains a little bit sticky this year? What happens if there's more conflict between maybe a desire to cut rates and the underlying inflation data, or if the labor market reaccelerates, if we get stronger jobs growth again? We haven't seen that yet, and I think that would present a real test and a real challenge for the market to deal with.
What do you make of this argument that if the Fed were to allow the balance sheet to roll off more significantly, it would tighten financial conditions enough to allow the Fed to cut rates really aggressively at the front end? Do you buy that? Do you think that that is a recipe for lower rates in nirvana?
So I do think this is a real complicated path to go down, because again, I think in theory you could say, look, the Fed has different levers it can pull to ease financial conditions. If it does a lot by easing financial conditions by buying a lot of assets, then maybe it can do less at the front end with rates, and vice versa. So if you're doing less with the balance sheet, you can do more with rates. I think the difficulty, though, one, I think the market is clearly very focused that there needs to be a sufficient level of reserves in the system. There's already, I think, debate about how close you're getting to that level. If you're going to run the balance sheet off a lot more than that, do you risk more liquidity squeezes in the reserves market? And I think secondly, and again, I think this goes back to the point we were just mentioning, it takes the market some time to adjust. So going very quickly from one regime to another, I think also would be a recipe for more volatility. So I think in theory it makes some sense, but I think it would be important for the Fed to use a glide path for that, to give more clarity. And ironically, kind of what we're talking about here is less forward guidance, less forward-looking. There's clearly some tension there.
It might be hard to go from one regime to the other if the former Fed chair is sticking around. Do you have any insight or thinking about Jay Powell, whether or not he stays on as a governor?
So we don't have a specific forecast for that. Our expectation is that he would stay until we hear otherwise. But this is another factor that I think is important for this debate, right? Unlike a lot of jobs in business, the Fed chair is presiding over democracy. He needs the votes of the rest of the committee to execute policy. And so that is a change. And I think when we talk about what would Chair Warsh want to do and how would he like to take the Fed, another part of this will be to what extent can he get the rest of the FOMC to share in that vision, to move in the same way. And I think that's also very, very important. Again, this is a reason why at Morgan Stanley we're not expecting this to represent maybe as much of a rapid shift of Fed policy, because you have the rest of the Fed to move along.
We've got space for one more question. I want to squeeze this in, and you can answer it however you want to answer it. We've seen convulsions in JGBs, convulsions in precious metals and crypto. I want to understand from your standpoint whether we could see some convulsions in corporate credit this year, given what we're hearing from Oracle over the weekend.
So far, actually, I would say credit's been surprisingly calm. And I think an important factor there is that the economic data so far has been good and yields have remained elevated. And so I think the risk for credit, the way that credit does convulse, is I think if we saw much weaker economic data, if we saw much lower treasury yields that take away that yield-based buyer, I think if what the market is dealing with is somewhat higher rates, a steeper curve, because economic data is holding up, that's actually quite good for the demand story. And look, some of these companies might have to pay up more because they're issuing a lot, but I don't think it leads to those convulsions, so to speak.
Andrew, it's good to see you. Thanks for dropping by. Andrew Sheets there of Morgan Stanley on the credit markets, and the next leader of the Federal Reserve.
Will he please stand up? I mean, I think that's what everybody's wondering, exactly. Who is this person? And will we find out, because he will put a muzzle on everybody at the Fed?
Wouldn't that be good news?
For
some people in this market, that's the world they want to see. They don't want to hear from the Federal Reserve so much.
Tell me about your feelings. I'm there for it.
And the news conference.
Exactly.
Get rid of the dots.
No, come on. I want all of it.
No more Fed show. No?
Well, that's another story.
You just want an afternoon back.
Exactly. Coming up on the program, we'll catch up with Matt Miskin of John Hancock and a whole lot more. The second hour of Bloomberg Surveillance up next.
Know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
You don't think the court was hurt by the perception that it was a political decision?
The court's always hurt, it seems to me, if we look political. One of my concerns, my present-day concerns, is there's too much partisanship. It's true historically that most presidents have appointed justices to the Supreme Court who are members of their own party. The partisanship should not be an overriding factor. What you look at is temperament, learning, background, reputation, whether or not you have those qualities of independence and caution that make for a good judge.
Increasingly, you see dissenting opinions in the Supreme Court aren't quite as civil as maybe you might prefer. And is that of concern to you?
Yes, it's of great concern to me that our civil discourse, our civic discourse, is not civil enough. Aristotle said that a democracy depends on an open debate where you respect the dignity of those with whom you disagree. He said democracies only live if they are sustained over a period of time by a thoughtful, rational discourse, a discourse in which you respect the dignity of those with whom you disagree.
I'm David Weston. Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. We go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
We need more transparency. Oil and gas is still important.
They said every citizen should be investing in the market.
Accelerate progress in all fields of science.
Watch Wall Street Week right here on Bloomberg. More than what you need to know, it's what you need to think about.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade. Watch Bloomberg Tech. This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
The only thing the equity market really cares about is revenue growth and earnings growth.
We've got some enormous spend going on here.
Valuations do speak for a stretched market. There is more CapEx in the pipeline.
We actually think the Max 7 is interesting again.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the second hour of Bloomberg Surveillance starts right now, and your scores look like this. Equity futures on the S&P pulling back by 0.5%. Fourth day of losses potentially just round the corner. The Nasdaq 100 down by 0.8. In the commodity market, we're down by more than 2% on gold, by more than 2% on silver. Brent and WTI trading lower by almost 5%. Big moves to kick off the trading week. Going into this later this week, Alphabet and Amazon earnings, and then on Friday, we hope at least, we've got a payrolls report.
This morning feels like whack-a-mole. Right now, there's so many different narratives that are coming around and swirling. You start to ask, why are equity markets down? Is it because of the risk-off move that you're seeing in crypto and metals, or is it because we're seeing some skepticism around the AI trade and some of the investments in OpenAI? There is a swirl, a toxic swirl that has come together. We've seen this again and again, and yet there has been a sense that things have bounced back. With respect to the metals, there is a sense that this is a lot of speculative trading and that this is bouncing around. And what a lot of people are looking for is, when does the buying step in and solidify some of these levels that had gotten a bit bonkers last week?
Potentially, the buyers will step in if we see some more movement on the geopolitical front. After speaking to Norm Room, potentially diplomacy will not work. And then, of course, we could be off to the races when it comes to gold and silver. I love what you said earlier, though. How much of this is just basically because Kevin Warsh has been announced now at the Fed chair, and how much is that potentially just so overdone?
I would put more weight on Jensen over Kevin at this point. Jensen Huang with some punchy comments over the weekend. It's not a commitment. A $100 billion investment in OpenAI is not a commitment, which raises a lot of questions about all the other headlines we've seen over the past 12 months.
The idea that every single big tech company is lined up behind OpenAI with huge investments, and Jensen Huang filed a letter of intent to have a $100 billion commitment, or up to a $100 billion commitment last September. Now, taking some emphasis off of that after reporting that he had been skeptical about exactly what the money was being put to use. It comes as Oracle raises $50 billion in debt and equity markets to finance its build-out. there is more skepticism getting built in, especially as the earnings with Lori Calvasina point out you're not seeing the bang for the buck yet, and that's causing some concerns.
Nvidia in the pre-market negative by more than 1% so far this morning. Coming up this morning, this hour, we'll speak to Matt Miskin of John Hancock as investors dial down risk, Henrietta Trays of Vader Partners as the government shutdown standoff rolls on, and James Steele of HSBC as the precious metals route enters day 3. We begin this hour with stocks falling, with gold melting down. Matt Miskin of John Hancock seeing the most popular narratives as mirages, writing between run it hot on macro and the US dollar debasement for markets, both look unlikely to materialize. Matt joins us now for more. Matt, good morning. Why are you pushing back?
Yeah, we're just not seeing it in the data. If you look at the consumer confidence report, it was the opposite of run it hot. It was actually pretty cold, like up here in the Northeast right now. We're seeing the consumers are saying jobs are hard to find. This labor market is relatively weak. And then we're getting inflation data showing that inflation, if you look at Trueflation, which is just an alternative inflation source, that's saying under 1%. We're thinking inflation is moderating more than the markets think. We think the jobs market is weaker. And you put these things together, it is the other side of the boat from this run it hot narrative. We also look at this dollar debasement. Yeah, it is. The dollar's weaker than the euro, the yen right now. It is a currency war all over again. We had currency wars about a decade ago. The dollar's frankly winning right now. That's probably going to help U.S. exports. It's going to help the U.S. be a bit more competitive. We don't see this dollar debasement helping lift all this riskier assets.
So, Matt, let's unpack this. So you're questioning run it hot, you're questioning dollar debasement, and you're short inflation. Where does that leave you on precious metals?
Not a huge fan. You know, the FOMO trade is one that you really got to be careful of. It's one of the easiest mistakes as an investor right now is to get this fear of missing out type mentality. That and trading geopolitical headlines. Precious metals to us has gone through one of the most historic runs in history. It was the sweet spot of these narratives. But we really think that you would look to trim into it, take some profits there, you know, redeploy into higher quality assets, look for some income in this market where we still have some really attractive income to generate.
It sounds like, Matt, you like bonds. If you are going against the inflation narrative, you're going against this idea of precious metals, and you're talking about a currency war that could lead to cutting rates around the world. How significantly do you have conviction about this? Are you buying 30-year JGBs with aggression?
That's a little rich for my blood, Lisa. But the JGB move is one that is, you know, pretty significant here. A lot of volatility off of very low yields still. In the U.S. here, we still have some really higher yields. We never got yields to come down that much. And then we've got this nice roll down now going into 2026. So before, you always had to fight the short end of the curve. The yields were so attractive, but that's been chopped down, and it is likely still to get chopped down this year. So the 10-year part of the curve is our favorite part. The roll down into the short end looks really attractive. We've got, you know, real yields, you know, for retirees that we work with. If you can get some real yield, you know, rewind 10, 15 years ago, you couldn't even get that for investors. So we've got real yields. We're looking at mild credit. You know, investment grade corporates is about as risky as we're looking to get here. Really underweight high yield. But look, there's other things you can do in the equity space. You can take some risk there. In the bond market, you're not getting paid for that additional risk. Intermediate, relatively high quality, keep it boring. Bonds look attractive here.
Matt, how much is this call underpinned by an idea that we are seeing some froth come out of the AI trade? The idea that people are going to be looking for safety outside of equities after the big driver of so many of the gains kind of loses steam.
Yeah, it's like a one-legged stool in terms of the U.S. equity market and economy. Just the AI momentum was so massive in 2025, and we think it's going to be hard to replicate in 2026 on top of a massive level. And I get it. There's great businesses there. They've grown earnings well. But we are looking at more of the mid-cap space. Quality value is our mantra in looking at equities across the world. Industrials are a place that have high return on equity. They've got an earnings growth story here. The One Big Beautiful Bill will help some of the CapEx accelerate into 2026. But we're looking to, you know, navigate that and kind of just, you know, move away from it, find other parts of the portfolio. Investors have never had so much equity exposure and consumer net worth as they do today. And consumer net worth is $173 trillion. We're in the most concentrated stock market in history. our biggest job as a asset allocator is finding better opportunities or opportunities that can pound for pound meet what the U.S. equity market and large cap and tech have done for investors over the last decade.
Matt, when you say move away, is it because you think it's a bubble or you think it's just overdone?
It's overdone. And yeah, I mean, the valuation's just, you're tapped out. It's going to be hard to generate returns out of the multiple expansion anymore. You already got it. Now, earnings growth is the last engine of return. And look, it's still on. That engine's still going, but that's the last engine you have. And we think that's going to moderate. If you look at the analyst estimates, it peaks out on a year-over-year growth rate in Q2 and then starts to moderate. One of the things we are learning here in the markets over the last 12, 18 months is the second derivative. So in Europe, for example, if you go from 1% growth to 2%, the market is in love with that. Well, if you go from 20% to maybe 15%, maybe the market won't love it as much. And you do get these days where you get this kind of reaction function. John was talking about, the issuance of debt here over the weekend, concerns about the liquidity or the funding of some of this AI investment. You can get a pretty quick turn. So we want to find other things in the portfolio that could step up when AI starts to slow down.
And as you see inflation moderating, do you think that potentially a more dovish Kevin Warsh shows up to the Fed when he gets confirmed?
Yeah, we do think that ends up happening. And look, right now, the Fed is in a really tough spot. You look at the Beige Book, right? So there's quantifying ways of kind of looking at the Beige Book. So this is how the Fed kind of asks businesses and consumers how things are. And it's all over the place. The line is just like, up and down, up and down. 1 second it feels like we're in a recession. 1 second we're feeling like we're great. Back and forth, back and forth. And it's really hard. Well, we think in about 3 to 6 months, we're going to get through all this kind of macro turbulence. And we're going to end up seeing where we finish out. And in our view, we're going to be at this kind of back to pre-COVID normalization. Relatively low growth, 2% inflation. And in that world, it's lower interest rates. We're lucky right now. We still have that higher interest rates. That's why we want to take advantage of it. But we think in 6 to 12 months' time, we're kind of back to this low growth, low inflation world, and yields will likely come down with it.
Matt, thank you, sir. Lots to think about after this appearance. Matt Miskin there of John Hancock. So let's take a step back and give it 60 seconds or so. Consensus view sounds like this. 3 pillars of a better outlook. You've got easing fiscal, easing monetary policy, and massive tech capex support in this market for as long as the eye can see. Matt Miskin's coming out and questioning a couple of those pillars and saying, I'm short inflation, I'm long bonds, and I don't like the move in precious metals.
He's saying we're not seeing some sort of breakout in any kind of growth. And frankly, we're not seeing ongoing investment in AI that continues to the same pace that we've seen. And frankly, he thinks that it is overdone and that you do have elevated valuation. So you take away those pillars and suddenly you're left with bonds. And that seems to be his aggressive call right now, at least in the United States.
He was down a single basis point on 10s this morning, 422. Let's get you an update on stories worldwide with your Bloomberg brief. Here's Vonnie Quinn. Hey, Vonnie.
Hey, John, thank you. President Donald Trump is planning to close the Kennedy Center for about 2 years for renovations. The president's decision coming after he faced significant backlash to his renaming of the center to the Trump Kennedy Center. Many prominent artists have since cancelled performances, and ticket sales have been on the decline. Shares of Oracle trading lower in the pre-market. They've reversed now, trading higher, in fact. The company planning to raise $45 to $50 billion this year to build additional cloud infrastructure capacity to meet demand. Its largest cloud customers include Advanced Micro Devices, Meta Platforms, NVIDIA, and OpenAI. President Donald Trump expected to adjust a critical minerals stockpile, to launch one even, with $12 billion in seed money in a bid to help protect manufacturers from supply shocks. The venture, called Project Volt, is set to merge nearly $2 billion in private capital with a $10 billion loan from the U.S. Export-Import Bank to secure minerals for manufacturers. And that is your Bloomberg Brief. John.
Hey, Vonnie, thank you. More from Vonnie in 30 minutes' time. Up next on the programme, Speaker Johnson's shutdown strategy.
Let's say I'm confident that we'll do it at least by Tuesday. And because of the conversation I had with Hakeem Jeffries, I know that we've got to pass a rule and probably do this mostly on our own. I think that's very unfortunate.
Up next, we'll catch up with Henrietta Trays of Vader Partners, live from New York City this morning. Good morning.
investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
The Middle East and Africa regions are home to some of the biggest deals and fastest growth in the world. Vibrant resources and high-yield investment opportunities abound. I'm Jumana Versace. Join me on Bloomberg Horizon's Middle East and Africa for the stories, newsmakers, and insights shaping the decisions of traders across this exciting region.
You had heightened levels of volatility.
There's still room to maneuver.
Reduce the opportunities.
It allows you to increase significantly your net income.
Every trading day, only on Bloomberg.
What is going to be the consequence for U.S. markets?
We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
Things improving slowly. We're still lower across the board by 0.4% on the S&P, by 0.75% on the Nasdaq. If you're just waking up and tuning into this, check out precious metals, gold and silver. This is child's play. The stuff we saw earlier was absolutely ridiculous overnight. Double-digit moves in percentage terms on silver, massive moves in gold.
Yeah, the biggest two-day move in silver, if you count Friday's session, on record. The biggest two-day drop for gold going back to 1980. Still, though, when you take a look at how far some of these precious metals have run up, you would still be up on the year if you bought at the end of last year. So there still is froth to be taken out, and that, I think, is what a lot of people are looking for.
47.61 right now on gold. Under surveillance this morning, heading down to Washington, D.C., Speaker Johnson's shutdown strategy.
There's a lot of details in this. We could get deep in the weeds, but we will do that over the next 2 weeks. I think we're on the path to get agreement, and I really hope that everybody will come to the table in good faith. Well, let's say I'm confident that we'll do it at least by Tuesday. We have a logistical challenge of getting everyone in town, and because of the conversation I had with Hakeem Jeffries, I know that we've got to pass a rule and probably do this mostly on our own. I think that's very unfortunate.
So here's the latest this morning. The House racing to end a partial government shutdown without Democratic support for DHS funding. Bloomberg's Lauren Dezensky joins us now for more. Lauren, welcome to the program. Can we avoid all of this? Because I tell you, from Wall Street's perspective, they care about one thing. Can we get payrolls data this coming Friday?
Well, we know at least that we are currently in a partial government shutdown. It looks like they will secure a deal to reopen the government. It looks like possibly Tuesday is what Speaker Mike Johnson said. But the big real sticking point is over this resolution on immigration raids and this impasse over immigration. Democrats really are concerned and dug in about trying to really push the administration and the government really away from funding Department of Homeland Security. And Mike Johnson sounded confident about this 2-week runway to negotiate immigration issues, but the Senate would certainly beg otherwise. They spent months trying to hash out a deal years ago, and that was scuttled entirely. So where and how the government can move forward on this incredibly tricky issue is a little bit difficult to see.
But Lauren, can Speaker Johnson actually get through just the funding package on Republican votes alone if not a single Democrat is willing to sign up for it?
He's already said that he's looking for goodwill from Democrats to make it happen, essentially indicating that he will need some Democratic support in some way, shape, or form to then at least kick off this 2-week process. So I think he's kind of appealing to goodwill here. Yesterday on Meet the Press, he said that he sees a path forward and kind of offered some olive branches that I think he's really counting on Democrats, some sympathetic Democrats to come to his side.
Lauren, appreciate your time down in Washington. Laurie Dezensky there. Joining us now to continue the conversation, Henrietta Trace of Vader Partners. Henrietta, welcome. Can we find an off-ramp here? I think we can find an off-ramp for now. We have until Tuesday, as the speaker suggested. They're going to try to move things forward tonight around 4, 5, 6 o'clock. I would say for investors, you brought up the BLS data. That's huge. There's also the IRS funding that lapses, and it's tax filing season now. But when I travel around and talk to investors, one of the questions I get a lot is, what's happening with the president's $2,000 rebate check? Are we going to get that for the tariffs?
And I would encourage folks to think about the fact that we just ate all of January up on this conversation. It fell apart at the last minute, and now we need to spend all of February basically dealing with the same government funding bills and then a DHS package, and then we'll have the State of the Union. It's basically already March, and it's only February 2nd. So for the investment community, it's really focus on what will not get done because we're not doing this. We're not getting a second reconciliation bill. We're not getting movement on other items that the president talks about quite a lot.
Well, it seems like Leader Chuck Schumer, senator from New York, cut a deal at the White House, but it doesn't seem like Minority Leader Hakeem Jeffries in the House was privy to that. How big of a gap right now is it between the Senate leaders for the Democratic and the House leader from the Democratic Party?
Yeah, there definitely is a gap, and you can tell because there's not a vote for the rule as Speaker Johnson laid out. I think the disconnect between Jeffries and Schumer is unfortunate. It will ultimately be bridged. You saw the guys right behind Jeffries, Jim Clyburn and Steny Hoyer, saying that they're going to provide the votes for this package, encouraging their members to vote yes. So I think a lot of this also is to do with what we went through back in the original shutdown, which is really propping up potential Speaker Jeffries in advance of the next midterm election cycle, giving him an opportunity to really stake the ground, get more recognition, leadership from the conference on the House side. And I think that's what this is really functionally about.
Okay, so if Speaker Johnson can find the 218 votes and we get back to the government operating as normal and we get the BLS data on Friday, they still need to figure out the DHS funding. They're going to have 2 weeks to do that. Do you see a deal for that new bill potentially that has to be drafted?
Man, I mean, they don't even agree on whether or not ICE should be wearing masks or have name IDs. You know, in the wake of the shooting in Minnesota, that was just a really immediate thing that Democrats gravitated to. I think you see it out in the ether as well if you talk to folks in Minnesota or anywhere else in the world where ICE has been inserted into these cities. They talk about the masks and they talk about IDs a lot and video cameras as well. Getting early messages that Speaker Johnson's not going to agree to those three components suggests that we're in for a very rocky ride over the next 2 weeks. I'd be shocked if we were able to pull it off without having this bleed into, another 2 weeks.
Henry, I have to say, none of us sound excited about talking about a government shutdown. Pretty much, you can just feel the pall of exhaustion fall over the conversation as soon as you say the two words, government shutdown. I just wonder if we're moving to a phase where we can stop this kind of piñata or this kicking the can down the road where we're always talking about this. Maybe it's 2 weeks, maybe it's 1 month, maybe it's 2 months. Are we going to get out of this, or is this the path of travel for the foreseeable future?
I think welcome to a midterm election year. Look at some of the special elections that just took place. There's one in Texas where the swing was 31 points away from Donald Trump. And I think what Democrats learned in October is that as long as they can steer the message, they're winning elections. So I don't see a reason why this would necessarily stop. The good news for investors is that once we get BLS done with, it will be done with all the way through September 30th. So we can talk about DHS, but it won't necessarily be, hey, when we get the employment report, hey, is the IRS going to be able to process refund checks? And investors can sort of tune out a little bit. The immigration narrative in an election year, I mean, come on, that's a tale as old as time now.
There's a sense also that maybe President Trump is looking for more concessions when it comes to not just getting the budget through, but also getting his new Fed chair picked through. And there is the potential for maybe the lawsuit to be dropped against Fed Chair Jay Powell about the renovations. I'm just wondering how realistic you see that process in being stymied, whether you do see a potential path to get Kevin Warsh as the Fed chair by May.
I've been working with Senator Tillis's staff for a really long time now. They have very high conviction. I do not think he is messing around. When he says, I want this case dropped and I will block all other nominees and all other considerations at the Fed, you should take that very seriously. So he's going to need to get that concern addressed. We have many months before we actually need to replace Jay Powell, and they're going to probably take all of those months. The president will have to capitulate. We saw the markets respond sufficiently to give him a message that he needs to drop this lawsuit. Jay Powell delivered a very forceful rebuttal to that in real time, as we all saw from that video. I would take that incredibly seriously. I don't think Senator Tillis is going to get rolled on this in any way, shape, or form. He's just getting louder, if anything else. So I think they will need to address that. It'll probably take some time.
And he made that point when he joined us on Friday, Henrietta. But once the DOJ investigation does get wrapped up, and once likely Kevin Warsh gets through his Senate Banking Committee, how does he play on the floor? Do you think Democrats vote for him as Fed chair?
I think so. I think you'll have a lot of aisle crossing. I think that is generally the direction of travel here with this particular nominee. You probably would have seen much fewer votes, maybe even a 50-50 split on a Kevin Hassett, for example. But judging by the temperature of what I picked up this weekend from staff on the Democratic side, there are going to be some lingering questions. There's a lot of random stuff in there. But as somebody who's already been in a similar position, has already gone through these approval processes, I think that he's on a path to getting bipartisan support.
Right. In 2006, he had a voice vote, and he pretty much sailed through unanimously to join the Fed. And Henrietta, I just wanted to end on this point because you sort of mentioned it earlier. What went on in Texas over the weekend? I know it's just a state Senate seat. But how this Democrat won in a +17 Trump district when he was outspent and outraised money-wise, is this a harbinger, do you think, for the midterms, or is this just a special election?
It is a special election, but the midterm cycle and this pre-midterm that we're in right now, we've been in since November, is highly predictive of electoral outcomes. And one of the things that I've been concerned about for Republicans all year is their effort to redistrict. Redistricting is all fine and well. You do not do that in a wave year, because Dems have already wiped away the potential advantage. I think it's one seat here or there that you might see any kind of plus up versus what was happening when we started this year. Now you're looking at a wave election. They diluted their districts, so they're not solid red anymore. They tried to eat into some of the blue spots. If you're getting a +31 in the Dem favor trajectory in a state seat in Texas, you got a problem. So the primaries, I think, are really fascinating to watch right now between Cornyn and Paxton, for example. How that's going to play out and what it's setting up for the general, I think, is going to be really exciting for anybody who cares about elections to watch. These are big swings we're talking about.
Henrietta, thank you. Appreciate your time. Henrietta Trace there at Vader Partners. Do you remember how ridiculous it was when we were confirming Powell to a second term? Elizabeth Warren called him a dangerous man. Yeah. I think Democrats at the time were obsessing over diversity and had little interest in the thoughts of the people that are actually nominating to the Federal Reserve. It was a kind of crazy time 4 or 5 years ago as well.
Yeah, it seems like right now it's going to be a very different conversation where it's going to essentially be down to, do you think that the Fed is an independent body? Great, cool, let's go. I mean, that's essentially where we're at.
I know, but I think it's still going to be quite testy when it comes to Kevin Warren. You already heard what Elizabeth Warren had to say. She's not excited about this pick from the Trump administration.
She's excited about any pick.
True, but I don't think it's going to sail through like, say, he did in 2006, which was unanimous.
If Powell's a dangerous man, I mean, like, you know...
Kevin Warsh has his finger on the
Kevin
nukes.
Warsh is going to have a great time with the senator from Massachusetts when that hearing takes place. Coming up on the programme, James Steele of HSBC with some big moves in precious metals.
Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at Japan's Akasaka Palace in Tokyo, and this is Bloomberg.
World's most powerful investors don't ring a bell. They quietly reshape entire industries. This is the money shaping the world. The Dealmaker Playbook, where power and billions of dollars change hands every day. From private equity and credit to venture capital and M&A, we bring you the inside scoop on the biggest deals and debates, plus exclusive conversations with finance's ultimate insiders. I'm Danny Berger, and this is Bloomberg Deals. Every week, only on Bloomberg Television.
Recovering here, stocks are lower by just 1/3% on the S&P 500. Massive moves in Asia. The Korean Kospi, the South Korean stock index, which had been absolutely flying year to date, up by more than 20%, was down 5 percentage points overnight. Futures pulling back on the Nasdaq were down by about 0.6%. But I have to say, relative to what we've seen elsewhere and what you were seeing in the European session and Asian session too, no drama. In the bond market, 2s, 10s, 30s shaping up as follows. Bond yields on 10s down not even a basis point at 423. And in precious metals, a picture of calm relative to what we saw earlier on today. Gold and silver down by 1 to 2%.
Yeah, earlier it was, what, 10, 11% declines in silver. You're seeing some of the biggest declines on record for both gold and silver, but it comes after some of the biggest gains on record for gold and silver. And it just raises this question, what is it telling us? If you listen to gold, what is the message? And ultimately, people are saying, well, it's volatile, it's speculative, but there isn't a clear signal yet, not yet.
We have seen these pockets of volatility. I keep going back to it. JGBs, you mentioned crypto. We've seen it in precious metals. We're seeing it now in things like energy, Brent, WTI. It hasn't spilled over into the equity market. Daryl Prong's going to join us later in the next hour. And I think that's a big question. Why is rate vol still so low, given these explosive events elsewhere? And why is equity vol, given everything we're talking about, still so low as well?
Especially if there is a fundamental question to the AI trade that potentially is part of the crypto and the metals and the oil, and that's something that people are raising as well. To the rate volatility story, it is fascinating. I feel like people have just been, sort of stunned into silence and calm because there have been all of these different pistons that are firing at different levels, and they're firing at different times, and they're all kind of evening themselves out. People don't have a sense of where the economy is going, and I think the numbers aren't clarifying that because we might not even get them on Friday.
10-year bond yield's just about unchanged, 423. Payrolls due on Friday. Let's hope we get the payrolls report. As we count you down to the up and about, 2 hours away, let's get you some morning movers. Yahara has more. Hey, Yahara.
Hi, John. Disney shares have been flickering between gains and losses, though we are up about 1% now this morning as its Parks and Cruise division delivered record results in the first quarter due to higher spending and higher attendance. That unit is run by Josh D'Amaro, who, of course, we have reported could become its next CEO as the board closes in on a decision, which seems like a logical next move given the outperformance of this unit and it's the company's biggest profit engine. Meanwhile, the precious metals rally has come crashing down, but as you guys just said, it has been easing as of late, though we are still seeing Barrick Gold down about 1%. Newmont now up 1%, speaking to the volatility that you guys have been talking about. A lot of questions around what's driving this. I look forward to your interview with Mr. Steele. And we end on NVIDIA. Those shares are lower, down 1% in the pre-market as CEO Jensen Huang tempers expectations around AI investments. Huang saying that NVIDIA's proposed $100 billion investment into OpenAI was, quote, never a commitment, signaling a more measured approach. And it's all about timing. This comes at a time, at a delicate moment for tech, given all the questions around the big AI spend. And of course, that means that Alphabet and Amazon may face increased investor scrutiny this week when they report. John?
Yahara, thank you. Thanks for the update. The stock is lower by about 1% in the pre-market. On our radar this morning, Disney earnings beating analyst estimates on both the top and bottom lines. The company's board is close to promoting theme park division chairman Josh D'Amaro to CEO, as Bob Iger announces plans to step down before his contract ends. Elsewhere, Oracle shares reversing earlier losses. The company announcing a plan to raise up to $50 billion this year. The company also looking to expand its cloud infrastructure capacity as AI demand grows. About half of the funding will be in debt. That stock is up by close to 4%. And finally, Coterra and Devon Energy announcing one of the largest oil and natural gas deals in years. The two companies combining to create a U.S. shale producer with an enterprise value of about $58 billion. The all-stock transaction expected to close next quarter.
We've seen an ongoing consolidation in the shale patch, and I am curious how much this is trying to get scale ahead of any additional supply coming from Venezuela or elsewhere, and the fact that oil prices have come down so much. What you have seen from some of the larger companies in the oil space is efficiency, is job cuts, is all of these technological advancements. How can you do that unless you have the scale and you're seeing a remedy to that increasingly?
The best part of the Permian Basin is called the Delaware Basin, and both of these together, their assets could come close to 1 million barrels a day instead of, or net acres. For these two companies, that means together they can actually maybe start to fight up against the likes of Exxon or Diamondback Energy. It could be a lot more powerful, maybe if they want to, say, do some exploration in places like Venezuela.
If you're tracking the energy story elsewhere, we are trading soft. We're down by about 4 to 5% on Brent and WTI. I want to stay on top of commodities. An explosive rally in precious metals developing into a multi-day rout. James Steele of HSBC writing, the bull market appears entrenched but has limits. Prices may eventually recalibrate lower. James joins us now for more. Jim, good to see you.
Hello.
Second time in about a week, we need to pick up on some of these moves. Extreme volatility. I think it's fair to use that word in silver. Seeing something similar in gold. How would you characterize the price action of the last 12 hours?
Well, I think you've got to look at what was happening last week and into throughout the weekend. Any commodity that moves in a parabolic fashion, the way gold and silver did, really invites volatility and invites profit taking. You know, there's been a lot of fresh money injected into the market. There's always a steady audience for gold and silver. But since August last year, and really at the beginning of last year, we saw new entrants come into the market in a bigger way, not just in the US, but globally. And a lot of them may invite more volatility. They can leave as quickly as they got in. And when you get a drop, it can put some scare into the market. And you've got to forget, you've got to remember rather that this nature, this sudden rally, it hasn't been reversed, but it has been dented. And when we got the news about Kevin Walsh, which was very welcome to the market and therefore took some risk out, that's really what started this, and it fed on itself. The liquidity wasn't great, which made the decline even more so.
Are the tailwinds still in place, or does Kevin Walsh compromise the story?
Well, I think anything that brings stability that is positive will calm the gold market down a little bit. It's a safe haven. It's a portfolio diversifier. Now, what we've got to watch out, I think you made a good point about equities. There's a significant amount of buying in gold is agnostic to the price move because it's as a hedge to the equity markets. You know, managers, asset managers, portfolio managers, they have to be in equities. They don't have any choice. But they do have a choice about whether they hedge or not. And gold consistently has shown itself to be a superior portfolio diversifier. So if we got a further pullback in equities, and I'm not saying that we will, please don't think that. But if we were to, then typically you get liquidation following in gold. Gold doesn't go up necessarily because equities go down, because what can happen is that those who hold it as an insurance policy will liquidate it to raise cash. So you get a secondary impact on the gold market, but that's because it's behaving in the function and for the reason that you bought it for.
Jim, you've been covering commodities for a long time. How much has the composition of the buyer base of gold and silver changed over the past couple of years? As an increasing number of hedge funds look to gold as a diversifier away from equities, as you see an increasing speculative bet in these particular precious metals?
Yes, effectively, it's a much broader church now in the gold and the silver markets. More in the gold. Gold's one of those things. It's rather like the weather. Everybody talks about it, but a lot of people don't know a great deal about it. But we've seen veterans in the market year in, year out, and lately that's getting a lot broader. And that's because it is a good portfolio diversifier. A lot of times you can't explain certain moves in the financial markets, and it leads one into gold. But I think what started this gold rally in its present genesis was the elevation in geopolitical risks in 2022 with the invasion of Ukraine, because not too long after that, we got a spectacular amount of central bank buying. If you look at it this way, up until last year, for the three previous years, almost 1 out of every 3 ounces of gold that came out of the ground went into a central bank vault. So why shouldn't the market have rallied? And that, I think, is the key. And they remain, they didn't buy quite as much last year, but they remain good buyers.
So I guess another way of asking this is, has the central bank buying been entirely priced in? Have some of the stable, dependable buyers of gold already been priced in, given how much the precious metal has rallied? And now the speculators are just pushing it up into potentially riskier territory.
I think that's a good point. I think everybody realizes that the central banks are in the market and are likely to stay in the market, and that's why we would think that any further sharp decline in gold would probably bring more of them back in. I don't know if you can say it's going in, the more recent buyers are highly speculative. I think they're just reacting to events. What we've seen is an elevation in geopolitical risk. And years before, and this is a change in the gold market, if you think about, for example, the Gulf War, Iraq invades Kuwait, oil and gold jump, Iraq is expelled from Kuwait, oil and gold go right back to almost to the dollar, to where they were before. But in the last 5 or 6 years, gold has not given back the gains it's made on geopolitical risk. It's kept a portion of them so that when the next event occurs, the market goes up from a higher base. And that's why we've been able to build, because the risk atmosphere is elevated.
But James, this recent drop over the weekend, how much is that because Iran and the United States seem willing to try a diplomatic avenue before Trump potentially weighs military options?
Well, I think that's part of it. We got wars, and then we got some relaxation on the geopolitical front, and they both came together at a time when a lot of buying had suddenly come into gold, and the combination there triggered a lot of liquidation and profit taking.
Can we just finish on your price target for gold? So gold at the moment is 47.83. Where are you at over the next 12 months?
Our average for the year is very close to that. And our range is about 3,950 to 5,500.
Has it ever been that wide, your range?
No.
What makes it so wide now?
The volatility and
so
the amount of money that can come in and out of the market.
This is going to be a feature of the next 12 months, this volatility?
Oh, I think so. I think we're at a permanently higher level than we have been historically. We're likely to, I'm not saying we're going to stay at this dollar level, but it's going to remain higher than it has been. We're making moves in a day that was the absolute level of gold when I first started. I know I'm aged, but shortly after our victory in the Boer War is when I started looking at the gold price. But the gold market had an absolute number of several $100s, below $500 when I first started covering it, and now we're making those moves in a few days.
How do you think Gordon Brown feels?
Well, as a Scottish Presbyterian, I was all for him when he came in, but
sure.
that wasn't maybe the best call.
No, James, it's good to see you. Thank you, sir. James Steele of HSBC. Let's give you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Vonnie Quinn. Hey, Vonnie.
Hey, John. Thank you. A big win for the Democrats in Texas. Taylor Remmett winning a special election for state senate and flipping a reliably Republican district that President Donald Trump won by 17 points in 2024. It's a race viewed as a bellwether for next year's midterm elections. Waymo is aiming to raise about $16 billion in a financing round. That would value Alphabet's autonomous driving unit at nearly $110 billion. Sources telling us here at Bloomberg the company will provide about $13 billion, while the rest will come from outside investors, including Sequoia Capital, DST Global, and Dragoneer Investment Group. Tough news for those of us ready for the weather to warm up. Punxsutawney Phil saw his shadow this morning's sunrise in western Pennsylvania today, here on Groundhog Day. That means 6 more weeks of winter rather than an early spring. A silver lining, though, Punxsutawney Phil, he's right just 35% of the time. And that is your Bloomberg Brief. John.
Bonnie, thank you. Thanks for the update. Up next on the programme, pricing at Walsh-led Fed.
His history is that of being somewhat hawkish. At the same time, he's been aligned with President Trump in the White House in recent remarks. So it's not clear to me which Kevin Warsh will show up in May.
Up next, we'll catch up with Mark Shaw, the former Chief of Staff to former Vice President Mike Pence. Live from New York City, you're watching Bloomberg TV.
What's great about it is it's a well-developed gaming ecosystem, right? So it, folks know to find games there, but it's also a highly competitive gaming ecosystem. So it's developed. This gives you both that upside and that downside. But what's exciting is that now we are moving beyond the phone to the TV. So I mentioned like one of the big gaming areas we're going after. One of the big gaming areas we're going after now is social gaming experiences that will show up on your TV. So we are now announcing, we're going to announce here actually, that we're going to have these social party games that you can play on your TV with your phone as the controller. And it's things like, recognizable games like Boggle, you got Pictionary, we've got a Lego party game. We, basically are going to unleash this with a bunch of creators, and they're going to go figure out stuff that we didn't even imagine that they can do with that interactivity.
Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Bringing you up to the minute news whenever and wherever it happens. I'm Sherian in Seoul, and this is Bloomberg.
Woke up this morning around 2 a.m. Eastern Time, checked out Bloomberg Anywhere, markets falling out of bed. Several hours later, this. Futures down by 1/3% on the S&P. Things are calm. We're down about 0.6 on the Nasdaq. Things are calmer. In the bond market, 2s, 10s, 30s shaping up as follows. Yields just about unchanged on the session now. Anchored at the front end. On the longer end of the curve, down by not even a basis point. And precious metals, wild swings, double digits in percentage terms on silver. Silver now down by not even 2%.
This reminds me, actually, when we were in Davos and we were having conversations with people outside of the U.S. and they were saying, oh my goodness, the world is falling. Look at all of these headlines. Everything has changed. And then we talk to U.S. investors and they say, ignore it. It's noise. Just take a look at this. And it's just essentially much more stable. You're seeing that kind of behavior play out in markets in real time.
Equities recovering very quickly. We're down by about 1/3% on the S&P. Under Savannah's this morning, pricing a Walsh-led Fed.
His history is that of being somewhat hawkish, both in terms of inflation vigilance and interest rates, and he continues to talk about reducing the balance sheet and reducing the footprint of the Fed in markets. At the same time, he's been aligned with President Trump and the White House in recent remarks, so it's not clear to me which Kevin Warsh will show up in May.
So here's the latest this morning. The future of the Federal Reserve in focus as investors anticipate policy changes once former Fed Governor Kevin Warsh returns to the central bank. Joining us now to discuss is Mark Short, the former Chief of Staff to former Vice President Mike Pence. Mike, welcome back to the program. Let's go through some of the details and some of the endorsements we've had over the past few days. Geeta Gopinath, Mohamed Al-Erian, the Prime Minister of Canada, Mark Carney, and the list goes on and on and on. Is Kevin Warsh a pretty conventional Republican pick to lead the Federal Reserve?
Look, I think he is. He's somebody who's been on the Reserve before, and I think that of the options, it's a pretty strong pick for the president. I know there's some people who question, what these hearings are going to be like when he gets there because of positions he took against quantitative easing after the financial crisis and reconciling that with a very dovish approach now. But look, if the Senate can confirm Tulsi Gabbard to DNI and Kristi Noem to DHS, I don't think it's going to be much of a challenge for them to confirm Kevin Warsh here to the Fed.
Mark, you were in the room in Trump 1 when the debate was going on who Trump was going to pick, and he ultimately landed on Mnuchin's pick of Jay Powell, which I know was not VP Mike Pence's choice. What do you think went behind this process, why Kevin Warsh was picked and not the other Kevin?
Well, look, I think there were basically three finalists in the last go-round. There was Jay Powell, there was Kevin Warsh, and there's John Taylor. And I think that there were different camps aligned with each. But the reality is that Steve Mnuchin made the appeal to the president. Then when the president asked, he said, who's going to keep rates lower? And Mnuchin was clear in saying it would be Jay Powell. And I think that's what the president was looking for. It was less of a question about sound monetary policy. It was a question of who's going to push for lower rates. And, I mean, there's an irony, of course, now that the president is upset with Jay Powell for not having rates lower. But I have to believe that there's been, that same conversation has repeated itself this go-round. And I think there's probably been assurances that Warsh is going to adopt a dovish approach here.
But that's why it's so precarious, given the fact that when he was at the Fed, he actually was calling for a hawkish, tighter monetary policy. Do you think his views have truly evolved, or is he just trying to be politically correct in the moment to get a job?
I mean, I don't know that I can put myself in his shoes and know that. I think that I do think he has certainly the credentials here. Again, as I said, of the options, I think there's probably a lot of comfort on the street and comfort in the Senate that this is where the president landed. And he is going to have to address the apparent change in position from where he was after the financial crisis to where he is today. But nonetheless, I think that he's going to have a term that's going to extend far beyond President Trump's term, and so he perhaps is playing a long game here too.
Mark, I'd love your take on what we heard from Tom Tillis, the North Carolina senator who seems to not care at all since he's not running for re-election and is going to block the process until the DOJ lawsuit or complaint against the Fed is lifted. Do you think that he has more popular support among sitting Republicans than he did maybe a couple weeks ago, not just with this, but in general?
He probably does. I think there are others who are applauding some of the positions he's taking, but feel they can't take the same because they'd be concerned about their own reelection options. But, I think that as it comes to, he's going to block this until the investigation is concluded on Jerome Powell. I think most people assume the investigation of Jerome Powell is less on the merits and more an effort to pressure the Fed to lower rates. And so at the end of the day, is the White House going to say, we're going to continue the investigation, or we're going to say, hey, we've got our own guy now to run the Fed, so let's pull back on the investigation? It seems like at the end of the day, it seems to me that this is not something that's going to continue into next year, as potentially the president suggested, on Air Force One the other night. It seems to me there'll definitely be a desire to pull back on the investigation to allow this to move forward.
I guess I was getting at something bigger, especially because we are in midterm year where we're going to be getting a government shutdown evidently every 2 weeks. And I'm just wondering, Mark, going forward, at what point you start to see Republicans look at either distancing themselves from President Trump's policies? Are you seeing any groundswell of that, especially after the special election in Texas, after the midterm outcomes? Are you seeing anything like that, or is it sort of a case-by-case situation?
I think it's more case by case, but I think it's going to continue to ramp up, I would say, over the course of the year. And it's not just Texas. I mean, there's been a series of special elections in deep red states of Mississippi and Georgia in which Republicans have been defeated. So there's clearly a trend building at this point, and there's no doubt that other Senate Republicans are recognizing that. However, they also know that the president has enormous sway over the base, and particularly in primaries. And so I would look to see more Republican senators distance themselves after you get through primary season, but being reluctant to do so until they've secured their nomination, and then that's behind them. So yeah, Tillis is in a different position. I don't anticipate you're going to see too much more of that in the short term, but perhaps toward the summer months, I think as members look toward the general election in November and they're behind their primaries, that's when you'll begin to see more members begin to perhaps take positions similar to Tillis.
Mark, on a final note on Kevin Warsh, the president spoke at a dinner over the weekend. I'm reading a quote Washington Post had. Someone in the room actually said to me, all of this is accurate. Quote, if he doesn't lower interest rates, I'm suing his ass off. And then the president says, I'm kidding. Mark, do you think he's actually kidding, or is Kevin Warsh potentially going to face the same fate as Jay Powell if he doesn't lower interest rates?
Well, I think he would face the same fate if he didn't lower interest rates. But again, I think this process has played out for a while. It's pretty hard for me to see that the president would not have moved forward with his nomination unless he had pretty strong assurances that Warsh was looking to lower rates when he got there. And so yeah, I think he would, if he didn't, I think he would face the same pressure from the president. I think the president's somebody who likes lower rates for lots of reasons. He made his resources in real estate. The president believes that it's better for exporting and for manufacturing base if the dollar is depreciated. And I think he knows the impact on equity markets when rates are lower. And so I think he wants to continue to push for that agenda, regardless of who the personnel are inside the Fed.
Hey, Mark, thanks for making time for us. Mark Short there, the former chief of staff to the former vice president, Mike Pence. I'm intrigued by the Druckenmiller nexus, legendary investor, and the extent to which we could see Bessent and Warsh work well together over the next several years.
Yeah, with Stan's guidance.
I'm not implying anything like that. That's not where I was going with that.
Some sort of insider trading, but the tutelage of Stan Druckenmiller coming very much to the government near you.
That was better framed towards the end. Coming up, Daryl Cronk of Wells Fargo, Jason Thomas of Carlyle, Andrew Honhorst of Citi, Oksana Aronoff of JP Morgan Asset Management. The third hour of Bloomberg Surveillance up next.
When I visited Fernandez at IMAX's headquarters outside Toronto, we went to the facility where IMAX designs and maintains its cameras. The latest next-gen equipment was out with directors on filmed for IMAX sets, but there was still plenty of cool gear on view.
As the head of the finance department, do you look at all the things in this room and think, this costs that amount of money, this costs that amount of money?
Thankfully, no, I don't. When I think about cameras in general and what we, when we first, I'll give you a really prime example, the film cameras. When you thought about it, okay, are we building 2? Are we building 4? Are you building 8, right? And that's where I start to think about, well, what makes the most sense from a return perspective? Because yes, Nolan wants the cameras, but how many other filmmakers out there use the film cameras? The lens that I look at it through is essentially, how many do we build and in what way? Because the one thing is we are going to invest to build it right and to build it for longevity. But do you need 10 of them? No. Building 4, that was the right number. And do we potentially want to build a couple more? Maybe a couple more, but I don't think we need 10 because they won't always be in use all the time.
I imagine that at different points you need to tell people no. What's that process like for you?
Oh yeah, it's a key role in the CFO position. It is a word that most people are used to, and yet they still think you're not going to say it.
Trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
Let's talk about the significant risk transfers to find space in their balance sheet.
Hedging some of that risk.
You could look at it the other way. Obviously, this stuff is risk-weighted.
I would much rather be long than be short.
We're in a kind of sweet spot. Very, very strong alignment.
3 revolutions in one.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Every trading day, only on Bloomberg.
I'm Alex Rodriguez.
And I'm Jason Kelly.
And we're back with another season of The Deal.
With athletes and entrepreneurs who are changing the game on and off the field. Jerry Jones. Some good-looking trophies.
1-1 is 3 in sports, not 2. And it's because that 3 is imagination. That 3 is putting yourself in a way, having yourself hit the home run.
Erica Ayers-Badon.
I'm a high-energy board member. I'm very passionate. I have a lot of opinions.
Robin Arzón.
I want to light fires in people's lives, and that is still one of my core mandates for all of my businesses.
Justin Tuck.
I tell all of my friends that play in leagues now, make these relationships now while you're hot. Don't wait till you're like your 12th year in and you're just hanging on.
Stay tuned. You won't want to miss it.
Know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Jemana Bersecci in Davos, Switzerland, and this is Bloomberg.
Of the 4 candidates that were out there, I would say that Warsh was probably the worst.
I expect him to be tested in the same way that markets tested every single central banker.
This is going to be a very interesting confirmation process.
I fully expect that Kevin Warsh will get through eventually.
What would be more important is how the economy evolves.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the third hour of Bloomberg Surveillance starts right now, and your scores look like this. We're negative 0.5% on the S&P 500, down by 3/4 on the NASDAQ, on a 3-day slide on the benchmark. Will it become day 4? In the bond market, yields just about unchanged throughout the session. In commercial, in the precious metals part of the market, anything but unchanged. Precious metals all over the place. Silver down by 16% at one point. Now we're down by 4. Gold's down by 3. I can't keep up. 47.51 on gold this morning.
The volatility has been absolutely incredible. The records we've ever seen when it comes to some of the dips in silver, and frankly, the biggest decline for 2 days going back to 1980 for gold. James Steele was just talking about the composition of the buyers of gold. It had been central banks. It had been these stable, reliable buyers. Suddenly, every hedge fund under the sun is turning to gold as a diversifier away from equities. And then you get speculators on top of that. And suddenly, the volatility is here to stay. And that, I think, is something we can see for the foreseeable future.
He's got a massive range for gold for the next year or so, a range of 3-something thousand to up to 5K. And I asked him, like, has your range ever been that wide before? And he said, no, this is going to be a feature of the next 12 months. Tons of volatility with a higher floor.
We could see 3,900 to 5,500 in 2 weeks. I mean, that's essentially where we're at right now because of the lack of trading as it gets to sort of these nosebleed areas in terms of valuations. It just raises a question. Does it act as the same diversifier, the same stabilizer if it has this volatility? And that ultimately is going to be a question for a lot of hedge funds that are turning to this rather than, say, the U.S. dollar or treasuries.
Lots of earnings in the week ahead. We'll get Alphabet on Wednesday, Amazon on Thursday, and hopefully we'll get this on Friday, a payrolls report. We've tried to avoid this topic over the last week or so. Can we avoid a government shutdown?
Speaker Johnson says we're going to avoid it. He says he's confident, let's say by Tuesday, that is tomorrow, as we said over the weekend, that this will be wrapped up. But the path is not going to be easy because he has to go through a procedural matter of having a rule and then basically making sure most of the Republicans show up or trying to get some Democrats to agree to this, even though Minority Leader Hakeem Jeffries told him over the weekend, do not rely on Democrats for this vote. So basically, maybe tomorrow, but maybe not. It's not stuck in stone that we're going to get this. So Friday is a bit iffy.
That's the story down in Washington, D.C. The story for big tech, AI funding needs, and a bit of pushback from NVIDIA's Jensen Huang. No pushback to this, though. Oracle kicking off an 8-part US dollar bond offering with a big goal and some big fundraising.
Yeah, $50 billion, with more than half of it coming from debt financing. Interestingly, you are seeing Oracle shares significantly higher in pre-market, although this comes after some significant declines so far this year. It raises this issue with Oracle. How are they going to fund some of their big promises, particularly tied to OpenAI? This gives some clarity to that. Nonetheless, there still are some very big questions about whether Oracle is overcommitting, especially given the pullback from NVIDIA, and what price are they going to pay in debt markets? How willing will the debt markets be to finance this?
Oracle up in the pre-market. On the equity side of things, we're higher by about 6%. Coming up this hour, we'll catch up with Daryl Cronk of Wells Fargo, with stocks heading for a 4th consecutive day of losses. Jason Thomas of Carlyle, as AI bubble concerns are growing, and Andrew Hoddenhorst of Citi, looking ahead to the January payrolls report. We begin this hour with stocks sliding to kick off a new trading month. Daryl Cronk of Wells Fargo writing, volatility is picking up rather quickly, centered in currency volume, commodity volume, and rates volume. Thus far, it has not spilled materially yet into equity volatility. It's a market to watch for vulnerabilities and extremes. Daryl joins us now for more. Daryl, welcome to the program. We've seen that volatility pick up almost across all these different asset classes, with the exception of a couple. They're the big ones, bonds and equity. What gives?
Yeah, good morning, John. I think that's right. It's interesting because as the currency volatility and the commodity volatility really have been the epicenter of this, you haven't seen it as much in rates and certainly in equities. The VIX this morning at 18. Remember in November and October of last year, the VIX was at 28 intraday in both cases. So far, equities have not spilled through. A lot of this was the push out of some leveraged and weak hands in the silver and the gold markets on the speculation. It really hasn't changed the outlook for the strong economy, U.S. GDP growth. It hasn't changed the outlook for earnings for companies up to this point. So it's more episodic and idiosyncratic about where it's happening. But you do have to be careful about to the point about not being overly exposed in places where there are extremes or vulnerabilities.
Well, where do you think we should be focused on right now? We've had the blow up in JGBs, if we can call it that, the convulsions we've seen in both Bitcoin, crypto more broadly, and elsewhere in things like precious metals. What's next, and what would you be wary of?
Yeah, I think you have to watch and maybe lean away from, in the short term, some of the liquidity proxies. So Bitcoin's a great example, down 12% in the past week, basically, and year over year, if you look at it from where it was last year this time, down 22%, right? So it's really struggled, and it's predominantly a liquidity proxy. Certainly some of the commodities have been these liquidity proxies as well. So I think you stay away from those and you stay to more the tried and true. We still like large cap US, mid cap US. We would fade the small caps, even though they outperformed large by almost 500 basis points in the month of January. We're concerned about the durability. And again, if you want to stay away from kind of the edges of the market where liquidity extremes are the most prominent or lack thereof, you've got to kind of fade smalls, we think, at this point.
Daryl, would you go back into bonds as a liquidity proxy that seems to work amid this volatility?
It's a great question, Lisa. I mean, it's what everybody's trying to figure out, right? Is the U.S. Treasury the safe haven? Can you rely on it again? So we're very selective. We're what we call a bullet strategy right now on fixed income. Right in the intermediate section of the curve, we think the steepness is the best there, the roll down effect of what investors are getting. We still think on the long side of the curve, there's risk there. We would not go out and reach for yields in today's environment. Certainly if U.S. GDP growth picks up into 26, like we think we do, you've still got to price a little more growth premium into the long side of the curve. Oil prices having moved higher, admittedly down today, but having moved higher, also are going to put a little bit of a tailwind in inflation, right? We saw the PPI numbers last week. So if you start building in growth and inflation premiums on the long side of the curve, we think there's still some risk there that investors should kind of fade on the long side of the curve.
This is the difficulty about this moment. You have sort of these three prongs. On one hand, you've got the economy. On the other hand, you've got geopolitics. We haven't even touched Iran. And then, of course, you have the AI trade and this question of how far that can really power things at a time where valuations have gotten pretty elevated. How much are you worried that that particular leg is being called into question as we see the likes of Jensen Huang talk about the lack of a commitment to the $100 billion for OpenAI, and as you see other signs that maybe people are pushing back?
Yeah, it's a really great question, Lisa. I mean, what most people don't realize is they think when they stare at their portfolio or their screens, that tech is still the engine that's powering things forward. Tech and financials are two of the three sectors that are actually down year to date. It's been this heavy rotation into energy, materials, industrials. In fact, if I broke tech down, the dispersion between the haves and the have-nots are almost unbelievable in the first month of the year. Semiconductors up 15% for the month. Software inside of tech down 13%. So you've got almost a 30% dispersion just between semis and software. So you're going to have to go in and really be selective, even within the GIC sector itself or the technology sector, where you want to have that exposure as we move out into 2026 on the calendar.
Well, to Lisa's point, though, when you hear Jensen Huang talking about things with OpenAI, it was never a real commitment. And behind the scenes, he's talking about some issues he has with what the company is doing. Do you want to not have that direct exposure to the massive hyperscalers?
Yeah, it's a good question, Anne-Marie. I still think, to me, the funding element of this is somewhat overplayed. I don't think it's this circular or difficulty getting the funding that these hyperscalers or others need. I actually think the real choke point that ends up as we play this thing out through 2026 becoming the issue is, can I get the energy? Can I get the industrial companies that can supply on time and on budget with what the build is going to suggest for all the CapEx that we're counting on and delivering out into 2026? So frankly, I'm a little less worried about some of the funding noise and concerns about, will they get that versus more about how do we get to kind of phase two of this, right? We've solved the algorithms. We know we've made the commitments. We'll get the funding. Now the question is, can I get the energy? Can I get the industrial companies to help build the facility, the data centers and other things on time and on budget and as expected to meet the CapEx high bar of elevation that's sitting out there for 2026.
Jonathan has brought this up a lot of times, too, when it comes to the calendar for the rest of the year. The OpenAI IPO, though, how important is that for this trade?
I think I wouldn't say it's important for the trade overall. I think it's one milestone or one element on the confidence factor, right? Will investors show up and still pay some of those lofty valuations on expectations to come, right? Because the valuations are going to be tough to stomach, quite frankly, when you start looking at what those things are going to end up being based off of current or next year type of earnings. So you're really betting on the true future of these are game changers and what's happening. So I don't think it derails the trade. Frankly, what I think my biggest concern when I look out on the calendar, Anne-Marie, into 2026 is if we start to see CapEx expectations and budgets roll over, right? You don't have to have them stop on a cathartic heartbeat stop. You just need them to either show signs of peaking across the broad sector and starting to decelerate. And I think that's what will be more concerning for investors out into 2026.
Hey, Daryl, it's good to see you. Thank you, sir. Daryl Cronk there of Wells Fargo with the latest on this market. Let's give you an update on stories elsewhere this morning with your Bloomberg brief. It's Vonnie Quinn. Hey, Vonnie.
Hey, John. Thank you. NVIDIA CEO Jensen Huang saying the company's proposed $100 billion investment in OpenAI was, quote, never a commitment. The Wall Street Journal had earlier reported the investment plan announced in September had stalled after some people inside NVIDIA expressed doubts about the deal. Huang downplaying the report, saying NVIDIA will continue to invest in the ChatGPT maker. In sports, Carlos Alcaraz is the youngest tennis player in history to complete a career Grand Slam. Alcaraz beating Novak Djokovic in the Australian Open finals. After dropping the first set, the 22-year-old won the next 3 frames to win the tournament. Alcaraz is saying he must get, or he may get, a kangaroo tattoo to commemorate his victory. Melania, a documentary about the First Lady, had a stronger than expected opening weekend at the box office despite poor reviews. According to ComScore, the film by Amazon and MGM Studios took in $7 million at US and Canadian theatres. The movie focuses on Melania Trump during the 20 days before President Trump's return to the White House last year. And that is your Bloomberg Brief. John.
Vonnie, thank you. Novak Djokovic is such a ridiculous athlete. Just think about how many Grand Slams there are every year. There's 4. And he's been in the finals 38 times.
I like that you just skipped over the Melania.
I know,
You went straight to Djokovic, and you're like saying they're incredible specimens.
Insane.
I think that truly amazing creatures that just defy humanity.
And to think Alcaraz could keep up with all of this over the next 20 years or however long he plays the game, it's just phenomenal what these guys do.
Yeah, I mean, the training that goes into that, I feel tired already.
And Rafa looks ancient now he's retired. Like, they sort of like age 20 years after these guys stepped in.
Well, I understand why.
Yeah, okay. Of course I'm skipping over the movie and doing the sport.
So predictable.
Why would I talk about the movie that none of us have watched?
Well, true. I know people who watched it.
Oh, really?
Yes.
They got a review. What did they say?
They said, no, I'm not going to give this.
They went to the movies?
They did. I know some people who went to the movies. Yeah, they did it for more comedy than anything else.
Oh, right, okay.
Let's move on.
Happy to. I tried to. Up next, the Morning Calls Plus, Jason Thomas of Carlisle, as AI bubble concerns are growing. That conversation up next.
Is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Only on Bloomberg.
I'm David Weston. Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. We go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
We need more transparency.
Oil and gas is still important.
They said every citizen should be investing in the market. Accelerate progress in all fields of science.
Watch Wall Street Week right here on Bloomberg. More than what you need to know, it's what you need to think about.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
There's a whole lot of stuff hitting the market all at once. And we said coming into this reporting season that it was a chance for investors to kind of push the macro aside and focus on the micro. The macro's been pretty pesky in terms of sticking around in unusual ways. And I would also argue that the micro has been a little bit underwhelming. We've described this as slightly squishy, not a disaster, but not good.
That was Laurie Calvasina of RBC Capital Markets joining the program a little bit earlier on this morning. If you're just joining us, good morning. Equity futures on the S&P negative by 0.5% on the Nasdaq. We're down by 0.75%. That's the price action. Here's your morning calls. First up, Morgan Stanley downgrading Humana to underweight and slashing its price target. The firm citing vulnerability in the Medicare Advantage business. Elsewhere, Citizens JMP raising its price target on Amazon. The analyst expecting the tech giant to benefit from its partnership with Anthropic. And finally, Jefferies reiterating a buy on Oracle, saying the company is committed to its aggressive AI expansion. Sticking with Oracle, sources telling us here at Bloomberg the cloud company is tapping the debt market once again. Oracle looking to raise cash in an 8-part bond deal. Jason Thomas of Carlyle tracking the whole ecosystem for us, and he joins us now. Jason, welcome to the program. I was reading a note of yours at the turn of the year. Absolutely fantastic read, actually available on the Carlyle website, so I suggest everyone should read it in full. Where you talk about the ability to be bullish on the technology, but still skeptical on the valuations. Can you just run us through all of that?
Sure. I think if you look historically, what you see is that the market in general, the equity market, has proven quite able at identifying truly transformative technologies. So if you look today and look at the cyclically adjusted price-to-earnings ratio, the prior times that it reached comparable levels was 1929 and 2000. That sounds kind of scary, given we all know what happened thereafter. But in both cases, you had a technology, it was electrification in the 1920s. You went from roughly 30% of homes to 70% of homes electrified in about an 8-year period. One could imagine just how exciting that technology would be in a world where homes were illuminated through kerosene lamps, where most of the mechanical power for manufacturing still came from steam. Similarly, of course, it was the internet that led to the big run-up in valuations in 2000, the potential for really just, again, the transformative change. And so in both cases, it wasn't that the technology fizzled. I mean, certainly electricity didn't prove to be some sort of fad. It was that the market wasn't so good at thinking second, third order effects. The capital really rushed in to the hardware bottlenecks. And of course, it was a huge run-up in both the CapEx, in terms of what the investment that was being deployed, but also, of course, the valuations. And almost all of the economics ultimately was more derivative and diffuse. It was the users of the technology where really the value accumulated, as opposed, again, to those hardware bottlenecks.
Jason, if you fast forward to today, in 2026, we're seeing Oracle selling $20 to $25 billion this morning of bonds to finance some of their data center build-outs and their cloud computing. When you see all of the debt issuance tied to some of the hardware aspects of the bottlenecks that we're talking about, does that give you pause? Does that raise concerns in your mind?
Oh, absolutely it does. Again, this is essentially what we saw in both of those prior episodes. This is where the capital is channeled. Today, the bottleneck, everyone agrees, is compute. And of course, the electricity to power that computational capacity. So that's where all the money is moving in. But if the past is prologue, it's actually going to be the downstream users where most of the gains are. So for example, in electricity, the big run-up in valuations were the electric holding companies. And it was, of course, the electric equipment manufacturers. But when you looked 10 years later, it was the durable goods manufacturers. All of a sudden, you had products like electric blankets, stoves, refrigerators that didn't previously exist. So it was the electricity that allowed them to drive down the production cost, dramatic increase in productivity, but also created a market for the service. In addition, electrification spawned an entirely new industry because of the radio. Initially, radios were just viewed as durable goods like any others. The economics accrued to the manufacturers of radios. But by the end of the decade, of course, you had an entirely new industry, sponsored content. And in the Great Depression, even as radio sales fell, everything else in the economy fell, advertising on the radio rose sevenfold. Again, the internet birthed industries like social media, search. So even as the initial capital went into companies like Cisco, of course, the constraint then was bandwidth. It was the need for a new network architecture. So I think the message is that people should not be so concerned about the absolute increase in overall market capitalization. The concern should be the concentration, where it's been allocated. And I do think that some of the rotation that we've observed this year is just a sense among many investors that they cannot allow all of their incremental risk budget to be consumed by data centers, by this choke point, and having a much broader view of where the value of AI is ultimately going to accrue.
So, Jason, to put you on the spot a bit, do you think that some of the recent volatility and sell-off in some data center names or some big tech names is the beginning of a trend? Has some room to go in terms of the deflation of some of these valuations as the dispersion continues and as people try to shift away from some of this concentration risk?
Yes, I do. And the reason I say that, at the end of last year, having conversations with very large capital allocators, they're looking at their portfolio in real estate, in infrastructure, in credit increasingly, and of course, the big cap equities. And again, they see that all of their incremental risk budget for really the last 2 years has been consumed by this single thematic. And not just AI, we're talking about computational capacity for AI. So I think that this makes many people uneasy, and they're looking for ways to diversify. And I think it's an important point, because you don't actually need to be bearish. You don't need to think that the expected returns on some of this development won't materialize. All you have to do is just be conscious of your prudential concentration limits to want to back off a bit.
Jason, you've written about this extensively. Just as a final point, this shift from asset light to asset heavy, do you think there's been a decent enough appreciation for what that means for valuations for some of these firms?
No, not at all. I mean, this is really, I think, the key. When you look at the decade prior to the onset of the pandemic, the companies were very richly valued, but deservedly so. They could grow revenue without any incremental hiring, any incremental investment. Everything was just falling to the bottom line to free cash flow. And so you had free cash flow yields, in many cases, that were in excess of 100% when measured relative to book value. So, of course, the valuation should be extremely high in those circumstances. These are like money printing machines. Today, of course, you've seen the decline in free cash flow relative to net income. And I think that as you move into a model that is somewhat different, where you are going to have to accumulate more physical on-balance sheet capital, you have to have a fundamental rethink of the appropriate valuation. And I just don't think that has happened to date. And the big question is also, a lot of the idea was that this CapEx was going to be front-loaded. I'm not so sure that markets think that way anymore. It looks like there's going to, a question of depreciation rates, functional obsolescence, just the product replacement cycles. There could be a lot of maintenance capital spending going forward. And if so, I think that calls for a more fundamental re-rating of many of these formerly asset-light businesses.
Jason, thought-provoking stuff. Thank you, sir. Jason Thomas there of Carlyle. The Nasdaq down by about 0.75%. Experienced some of the things that Jason's talking about when we were over at the World Economic Forum in Davos, that when you ask people about valuations, they just keep defaulting to the technology. The technology is going to be really powerful. It's going to do this, this, and that. And it's really difficult to get them to come back to focus on the valuation story and the kind of details that Jason's going through.
Yeah, and the point that he was just making at the end there with you, this idea that they had been asset light and that the chips that they're buying might have a 3-year cycle. They're going to have to invest more in this. And we saw that with Microsoft. They can't spend enough to keep up with the demand, but they need to keep spending more. So it raises this question about, can you have a transformational technology that's at a valuation that's way too high for what the market currently is considering?
Stocks a little bit softer this morning. We're down 0.4% on the S&P. Coming up next, we'll catch up with Andrew Honhorst of Citi. Looking ahead to Friday's payrolls report, plus Yahira has your morning movers. Oracle rising as clarity comes to its data center funding needs. That stock is up by 5%.
technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
The Middle East and Africa regions are home to some of the biggest deals and fastest growth in the world. Vibrant resources and high-yield investment opportunities abound. I'm Jumana Versace. Join me on Bloomberg Horizon's Middle East and Africa for the stories, newsmakers, and insights shaping the decisions of traders across this exciting region.
You had heightened levels of volatility.
There's still room to maneuver.
We do see opportunities.
It allows you to increase significantly your net income.
Every trading day, only on Bloomberg.
The opening about 60 minutes away. Futures down across the board, recovering slightly. We're down 0.5% on the S&P. On the Nasdaq, we're down by 0.75%. The Russell small caps down by 0.4. With your morning movers, let's cross over to Yahara for more. Hey, Yahara.
Hi, John. Oracle shares have been swinging wildly this morning. All of it stemming from its plans to raise up to $50 billion to fund its AI cloud expansion. At first, that news had sent shares in the red, but they turned positive after both Fitch and Moody's affirmed their credit rating on Oracle. The headlines have been fast and furious. That are reporting that has kicked off an $8-part dollar bond sale, and Oracle moments ago putting out a statement that it plans to sell $20 billion in common stock from time to time. Shares are up 4.25%. Meanwhile, moving on to U.S. rare earth stocks, they are rising in the pre-market. USA Rare Earth up 6% as we report on a planned announcement by President Trump for a $12 billion strategic minerals stockpile. It's being dubbed Project Vault, and it would be the first of its kind stockpile for the U.S. private sector. Of course, all part of an effort to reduce reliance on China for these critical supplies. And we end on Disney. It had earnings. Shares are now down 1.5%, even though the company delivered, its Parks and Cruises division delivered record results in the first quarter. More people are going to the park and they're spending more money. That unit is run by Josh D'Amaro, who we report may become the next CEO as the board closes in on a decision. John?
Yahara, thanks for the update. Appreciate it. Let's turn back to the economy. A busy week on deck, headlined by the payrolls report due on Friday. Bloomberg's Mike McKee has more for us. Good morning, Mike.
Good morning, John. Well, this is the first week we can say this in a long time. All of the data are going to be up to date. We're not looking at the effects of the government shutdown that we had last fall. We're still going to have to wait and see what happens with the government shutdown this time. Today we get ISM manufacturing. We'll see whether or not there is any expansion. The forecast is for contraction still. Tuesday jolts, and it's the December number, not behind there. Wednesday, ADP, ISM services, and don't forget the Treasury refunding. Thursday, jobless claims, and as you mentioned, Friday's big day, January jobs, and we get Michigan sentiment. Right now, in terms of January jobs, and it's early, we will see some changes in these forecasts, but the consensus at the moment is for 65,000 jobs, which would be an improvement. The whisper number, though, Wall Street's a little more pessimistic at the moment, 52,000. No change in unemployment seen and a decline in average hourly earnings. The other thing to keep in mind, guys, is that this is the month in which we get those updated numbers for payrolls and for the overall population. And so we could see a real change in how many jobs were created last year. Chris Waller's already predicting zero, zip, nada, is the way he put it. And that could change the political narrative in Washington quite a bit.
Mike McKee, thank you, sir, with the latest down in Washington, D.C. and what we can expect on Friday. The payrolls report, the estimate's pretty wide. 130 is the high, -10 is the low. Thank you, Santander and Standard Chartered, for those two extremes.
Yeah, and I was reading Steve Englander's note from Standard Chartered about why he has -10, and he's talking about the birth-death model and how it's coming out, and they're going to do all of these revisions lower in terms of the population and how that plays out. What do we do with that number? Will we get that number? How will these look? I mean, honestly, how much weight can we put on a number that we may or may not get on Friday that may or may not disclose something real versus changes in models that are coming once a year?
Steve just published US data quality, more fool's gold than gold standard.
Correct.
So I think that speaks to how Steve feels about the data that comes on Friday and beyond. Andrew Honhorst of Citi says this: the employment data is unlikely to materially change the outlook for the labour market. We expect a solid 135 added in January, and the unemployment rate remaining unchanged at 4.4%. Andrew, that puts you at the top end of the estimates for this coming Friday. Walk us through why you're looking for that, but also looking for 75 basis points of cuts through the year.
Yeah, top end of the estimates in terms of where that payrolls number is going to be, but it goes back to what Lisa was talking about, what you were all talking about, which is, what does this data really tell us about what's going on in the labor market? So we know we have these issues with the birth-death model. I would actually agree with Steve Englander that if we get a big update to that birth-death model, you could get a 0 or a negative number. And I think that's where the underlying pace of job growth is running, somewhere right around 0. And that's what we had Governor Waller talking about in his dissent from the Fed staying on hold last week. So it's a complex job market, is a complicated situation and complicated data. But I would go back to that survey that the Conference Board puts out, and they just ask people, do you think jobs are plentiful or do you think jobs are hard to get? And month after month, people are telling us jobs are becoming harder and harder to get. So I think it is a loosening labor market, lots of statistical issues. Residual seasonality used to be something people would look at me very funny when I said. Now people are all familiar with it. Every year we get stronger jobs data at this time of year. We're building that into our forecast. That's why we have 135,000.
What do you think break-even is? What's the break-even rate?
I think the break-even rate, with the way that the data are adjusted now, it seems like we can run about 50,000 jobs per month, and 50,000 jobs per month as reported by payrolls is leading the unemployment rate to stay stable where it is. But there is a question about that 50,000. Should you be subtracting something like 60,000 from it because those payrolls numbers keep being overstated? We'll get more information about that today or on Friday when we get the new report. So that break even has slowed down. But again, I think the key thing here is, do we call a job market strong if we have essentially 0 increase in labor supply and 0 hiring? I don't think that's a strong labor market.
Can you have a strong economy, though, if you don't have a strong labor market? I mean, this has been sort of a feature of the entire market for a while. The labor market has been sluggish at best, and yet the economy has continued to grow pretty dramatically. So at what point does that become a hamper, potentially, to any kind of further acceleration?
Yeah, I think eventually it does. I mean, there's growth, and then there's whether it's broad-based growth or fairly focused growth. And to the extent that we're getting growth from things that are AI-related, software and data centers, a lot of those kinds of areas of investment spending don't actually generate a lot of new jobs. And so that eventually becomes an issue for the economy. In the short term, you run strong growth and you can have weaker labor market. I think that's what we're seeing right now. But eventually, people don't have the wage income to purchase. And if you look at consumer spending, it's holding up, but it's holding up because the savings rate keeps going down. People are saving less and less because their incomes aren't tracking with that consumption. So eventually it's an issue for the economy.
You still think that the Fed is on track to cut by 75 basis points this year, even with Kevin Warsh potentially being the Fed chair? Why not more, given some of the proclamations that we've heard from certainly President Trump as well as Kevin Warsh, and considering the weakness that you see in the labor market?
Yeah, I think the risks are that we do end up with more cuts than 75 basis points rather than less cuts than 75 basis points. The reason I think 75 makes sense as a base case is, although the labor market is softening and loosening, it's happening very gradually. So if we just project out that gradual loosening of the labor market, the unemployment rate will move up just a bit this year, inflation will come down a bit this year, and that would mean that the Fed should just ease policy rates by a bit this year, back to something closer to neutral, which 50, 75 basis points lower would be neutral. I think that should be the base case. The market has about 50, I have about 75, but what's the risk? The risk is that when you're in an environment where hiring is so weak, if there's any pickup in layoffs, that unemployment rate is going to shoot up, and then we'll get more cuts.
Well, you haven't changed your expectation, even though we have a new nomination for the Fed. So do you think a Kevin Warsh is going to be data dependent, given what you're basing this off as the data that you expect to come out?
Yeah, it's not just Kevin Warsh, and I think that's an important point, that it's the committee as a whole. That committee has been data dependent. I do expect Kevin Warsh as an individual to be data dependent as well. So depending on where that inflation data comes in the second half, and I think that's really important and probably underemphasized. A lot of focus on the labor market right now, and that's appropriate. But those inflation numbers, I think, by the second half are going to look closer to 2% inflation. And that's not just going to give Kevin Warsh the ability to cut interest rates. I think that will give a lot of members of the committee the confidence that they can bring rates lower.
What's the source of that? What's driving us back to 2?
Shelter cooling is where we have the most confidence. I think a lot of economists have that in their forecast now. We just have so many indicators. It's a soft housing sector. The housing sector is soft right now. Prices are soft. Rents are soft. But this loosening labor market should also give us confidence that inflation will come down further. And then finally, that tariff boost that we think is about 50 basis points in CPI and PCE right now, that should be dissipating by the
So let's just go with the shelter story, because when people like you explain the shelter story, it sounds so intuitive. It sounds like common sense. Okay, you've put it that way. I can see where it's going to be several months out in the official data. Why do Federal Reserve officials not share the confidence you have about the disinflationary tailwinds that are already coming down the pipeline?
I think there's a difference between different Fed officials, and different officials will be different places on this. Where I am, and maybe some of the more dovish officials are saying, yeah, we basically can forecast this thing 6 months to a year in advance. We know that it's going to cool down. I think there are other Fed officials that maybe also kind of know that we can forecast that, but think that the way they should behave is if we can, because they think it's important to take a strong stand against inflation. You see 3% right now, and they think we're supposed to react to that 3%, not the forecast of where we're going. I react to the forecast. I think other Fed officials do, but I think that's a difference of opinion in terms of how you conduct monetary policy.
So in other words, this is about appearances. This is about appearing hard on inflation, even if they'll come down on the same side as the doves. In other words, do you agree with Kevin Warsh that people should just talk less and not really give forward guidance?
I do think forward guidance is, we're probably overly used to forward guidance because we were in these strange scenarios where you had to give guidance about keeping policy rates at the lower bound for a long period of time. So we should be moving away from that. In terms of this, is it kind of, optics talking about inflation? It's hard to make an argument that 3% inflation is a lot worse for the economy than 2% inflation. The target is 2%, so there is an optics reason that you want to be at 2%. If central banks were to do it over again, I think most economists would say probably we should have had a range of inflation that would have been acceptable. So I do think it's a lot about optics right now.
This is fascinating, especially because the person who is likely to come in to be the next Fed chair is an inflation hawk, at least traditionally, more than a decade ago, and people are saying people can change in that time. Do you think that he is also potentially going to accept 3% as a new 2% and be more dovish in the approach because it hasn't been a problem? And frankly, if people were to come back, that might be the more appropriate target.
Yeah, I'm not suggesting, and I don't think that Kevin Warsh is going to say that 3% should be the new 2%, that we should be changing the target right now when we've just overshot for multiple years. But I do think this idea that we can't be hypersensitive to his inflation off by, 1/10 of a percentage point here or there. I think the more you kind of immerse yourself in this data and understand what the data are and all the issues in producing it and the different choices that we make, it's hard to get really excited about being off by a few basis points. So I'd like to see them move in that direction, and possibly they will.
To your point, though, Andrew, I think there's a realization on the committee that they can shape the events they influence. And they can basically sit here and say, you know what, we can shape the events we anticipate by saying things like, I'm not worried about inflation, could actually contribute to inflation. Is that ultimately what you're getting at?
Yeah, I think that's exactly the concern. The reason I would be less concerned about that now is because we have all of these indications that we're not in an environment where we have a bunch of upside around inflation. And it is actually the opposite of where we were when Fed officials were saying they weren't that concerned about inflation when everything was supposed to be transitive. We had a tight labor market. We had wages that were accelerating, prices that were accelerating all over the place. All of those things are decelerating now. So I think you can be a lot more confident that we're going to get inflation lower.
Andrew, it's good to see you.
Thank you,
sir. Andrew Honhorst of Citi on the optics over at the Federal Reserve.
I think it's a little cute. I think that he's not wrong, but I do think that there is this feeling that if you act like you're hard on inflation, you can drive down inflation in a de facto way. I don't think any company looks out and says, I'm going to raise prices because they seem less concerned about inflation. I mean, if you think about how it plays out in markets, I'm not sure it's that direct, but it is kind of this funny, potentially influencing the world that they cover.
And that's the game, apparently. Equity futures right now in the S&P, negative by about 0.4%, with an update on stories worldwide. Here's your Bloomberg brief with Vonnie Quinn. Hey, Vonnie.
Hey, John. A partial U.S. government shutdown entering its third day. House Speaker Mike Johnson is hoping for a vote on funding bills today. Minority Leader Hakeem Jeffries saying Democrats want an agreement on their demands for reforms at DHS before they'll vote in favor of the package to reopen the government. Disney earnings beating Wall Street estimates on both the top and bottom lines. The bulk of the company's profits coming from its parks and cruises unit, led by Josh D'Amaro. And sources telling us here at Bloomberg that D'Amaro is a likely successor to CEO Bob Iger. The board is expected to vote on a new CEO in the coming week. Bad Bunny making history at the Grammys, marking the first time the album of the year has gone to a Spanish language work. The Puerto Rican superstar dedicated his acceptance speech to, quote, all the people who had to leave their homeland. Country star Shabuzi, who won his first Grammy, dedicated his award to immigrants. And that is your Bloomberg Brief. John.
Bonnie, thank you. Thank you very much. Up next, we're setting you up for the day ahead. Plus, we'll catch up with Oksana Aronoff of JP Morgan Asset Management, weighing in on the next Fed Chat.
Crises, two essential crises, and for both it's now or never: democracy and climate, and they are absolutely interlinked, and we have to solve them together. We're losing the democratic infrastructure and norms to deal with the climate, and we're losing the climate stability that is essential for a democracy. We have to solve them together. We've never faced a threat like this to our democracy at a time when it's a perfect storm, at a time when we're being told by climate scientists, some of you may be in this room, that we have to cut our emissions, fossil fuel emissions, in half in 5 years now. You know, when I started to realize what was happening, it was 12 years, and we haven't done it.
Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
Watch Bloomberg Tech.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Bringing you the world's business and financial news whenever and wherever it happens. I'm Michael McKee at Mount Everest, and this is Bloomberg.
of the options, it's a pretty strong pick for the president. I know there's some people who question, what these hearings are going to be like when he gets there because of positions he took against quantitative easing after the financial crisis. If the Senate can confirm Tulsi Gabbard to DNI and Kristi Noem to DHS, I don't think it's going to be much of a challenge for them to confirm Kevin Warsh here to the Fed.
That was Mark Shaw. Good fun a little bit earlier on Kevin Warsh and the future of the Federal Reserve. If you're just joining us, a volatile start to the trading week. Things are calming down just a bit going into the opening bell. Equity futures negative by 0.4. On the S&P and the Nasdaq 100 down by 0.7. That's the price action. Your week ahead looks like this. Today, ISM manufacturing data, plus we'll get a little bit of Fed speak. On Tuesday, jobs data and results from AMD, Pfizer and Pepsi. Wednesday, results from Alphabet. Thursday, some central bank decisions and results from Amazon, plus another round of jobless claims. Then Friday, hopefully the big one, hopefully we get some payrolls data this Friday.
Oh, I don't even want to hear this. I mean, honestly, why are we in a shutdown again? Hopefully it'll be over by tomorrow. That's what they say.
And then we wake up, we don't talk about it, and we just move on with life.
Let's do that.
No one really wants to talk about these things,
Well,
do they?
because there's nothing to say. It's Groundhog's Day, literally. And here we are again with the government shutdown.
Should we talk about Kevin Warsh? And who is Kevin Warsh?
Please, yeah.
Another round of that. Literally Groundhog Day.
Literally
who is Kevin
every single
Warsh?
topic. Okay.
Oksana Aronoff of JP Morgan Asset Management with this to say, even in the most dovish scenario, this cutting cycle is closer to the end than the beginning. Oksana joins us now for more. Oksana, good morning.
Good morning.
Does Kevin Warsh move the dial for you and the team at all?
Well, I'm afraid to talk about it now. No. I mean, look, it's important to say that it will be interesting to see how he's going to reconcile his historically, hawkish stand on the Fed balance sheet, on inflation, and Trump's desire to see lower rates. And how he's going to achieve this balancing act, we'll see. Whether he's going to have to compromise on some of those views. But even if you assumed he was going to be the most dovish of doves, as you said there, we are closer to the end than the beginning. And frankly, this cutting cycle achieved very little, if anything at all, in terms of affordability, in terms of really getting long rates significantly lower. And now, of course, all eyes are on whether inflation risks are to the upside. Over 50% of CPI is running at or growing at least 3%. Shelter being a significant dampener, but, and I don't know that a lot of people talk about this, if we were to actually see mortgage rates go lower, what is that going to do to home prices in an ecosystem where there's very, very limited supply? It's going to send prices higher. So it might actually be, have a counterproductive effect in that respect.
I guess there's a bigger question right now, markets too, which is how much does it matter what the Federal Reserve does with interest rates? How interest rate sensitive is both this equity and this credit market? When it comes to credit markets in particular, where some people say it's priced to perfection, how important is it for the Fed to cut rates more aggressively going forward?
It doesn't matter whatsoever as long as the government balance sheet is in the shape that it is in. We're staring down the barrel of tens of billions of dollars more stimulus this year. And of course, and I've been saying this for a long time, the long end of the curve doesn't care what the Fed is doing at the front end of the curve. The long end of the curve is reacting to the fiscal policy. It's reacting to inflation expectations, which have moved up for the next year in terms of what consumers are expecting. It's reacting to supply of treasuries. And so it's very, this cycle is very different for that reason. It hasn't really reacted to Fed policy decision making at the front end of the curve.
Does it give you confidence that we haven't seen more volatility, particularly at the long end of the curve, even with all of the volatility that we see in precious metals and gold and silver, et cetera? I mean, this has actually been one of the havens, frankly, in terms of just price movement.
So it's interesting to me generally for credit that we haven't seen more volatility, or for equities, although equities kind of move in their own ecosystem. We arguably have one of the most volatile administrations. And we are not really seeing that in markets. And I think part of that is the Fed put, right? This sort of implicit expectation that the Fed match up. So this is what the balancing act is going to have to be all about. How do you achieve affordability by simply cutting rates? It hasn't worked so far. And then also, if you believe that the Fed's balance sheet should be smaller and you are concerned about inflation, which inflation risks, when I look out, I really, contrary to your prior speaker here, I think the risks to inflation are skewed to the upside because I struggle to see what is actually bringing it down, whether you look at demographics, whether you look at immigration policy, whether you look at really anything that is supporting or has effect on the inflation number, including the actual, things like specific things like PPI that came out recently, more than double what was expected, right? Inflation risks are actually skewed to the upside, and if he's going to respect that, then you have to at least stand pat on rates. But even if you were to cut them, we've seen that hasn't been effective.
Andrew was talking about shelter. Where do you see fresh catalysts for inflation?
In shelter. So in terms of lower borrowing costs there, that can create actually a higher pricing impetus for shelter. Generally, there are more households. There's, household formation has outstripped supply for many decades now in this country, and that is what's driven prices higher, significantly higher, and that's going to keep prices relatively high. Now, shelter has experienced some softness because mortgage rates are so high, because it has become less affordable, but it's not going to be a reliable sort of, dampener, a consistent dampener to inflation over the long term.
Let's say Chair Walsh is a hawk. Just want to throw this out there. Doesn't that make it more likely long rates fall than rise?
Paradoxically, yes, and I've said this for a long time, that for the Fed to achieve their, supposedly still 2% target, which, by the way, I'm not saying that it's the right target and that there's anything wrong with a 3% target, but it is very meaningful that they haven't changed it so far, right? Paradoxically, for them to achieve it, they need to sound more hawkish than dovish. It's sort of counterproductive what they're doing.
Oksana, good to see you. Oksana Aronoff there of JP Morgan Asset Management, which kind of speaks to one of the things that Andrew said about 5 or 10 minutes ago.
Yeah, that essentially they have to kind of almost tacitly accept a 2 to 3% inflation rate in order to have some of the rate cuts that they're hoping for. Interestingly, though, if he is hawkish even on letting the balance sheet roll off of the Federal Reserve, that would lead to more tightness. That would then lead them to be able to cut rates, but would also bring long-term rates down, but maybe not for the reasons people want.
Bonds are a snooze this morning. Yields are up by about a basis point on 10s. Equities are recovering. We're down by about 1/3 of 1%. Coming up tomorrow, we'll catch up with Chris Verone of Strategas, Victoria Fernandez of Crossmark, Dan Greenhouse of Solus, and Chris Harvey of CIBC from New York City this morning. Good morning. Thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.
World's most powerful investors don't ring a bell. They quietly reshape entire industries. This is the money shaping the world, the dealmaker playbook where power and billions of dollars change hands every day. From private equity and credit to venture capital and M&A, we bring you the inside scoop on the biggest deals and debates, plus exclusive conversations with finance's ultimate insiders. I'm Danny Berger, and this is Bloomberg Deals. Every week, only on Bloomberg Television.
Tariffs, I think, are probably the first time in my career I've had to deal with like a fundamental change in government policy in terms of how we think about how markets work.
The challenge, especially within my supply chain, is now how do you have enough productivity initiatives to offset the increased cost of all the product?
Can you just move your supply chain out of China and into the U.S. or out of Mexico and up to Canada? Is it that easy?
It's not that easy, but we do have flexibility. And we had been, prior to tariffs, prior to any of this, we had been on a journey to diversify our footprint out of China. So probably 2-ish years ago, roughly 65% of our toy and game volume was coming from China. Today, as we entered into 2025, that was around 50%. All we've done is really accelerate the path to get down to roughly, call it 30% by the time we enter into 2027. For us, I mean, if tariffs stay, if tariffs go, it's never good to have so much of your manufacturing base centered on one geography. We think the diversification is good, but it does take a bit of time to get vendors and suppliers up to speed. Quality is a big deal, especially when you're dealing with toys and kids. It's not an instantaneous thing, but it's not also a 5-year, have to build a new plant from scratch.
This is a 15, 16 grams tuna. Then sushi rice is still a little bit warm. So take one, like a very, don't make it too tight. So from now, and very light, like a ball. Put wasabi in the middle. Then my process 1 to 6. 1. This is putting the between the lights air. Then make the 4 fingers curl. Make sushi shape. Then touch this. 2. Then turn. Now that these 2 fingers, top to the bottom, make the sushi shape more beautiful. 3. Then, I'm not, looks like pushing, not pushing. 3, 4, turn, same way, 5, and 6. So this is 1 to 6.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Hazlida Amin in Davos, Switzerland, and this is Bloomberg.
It is M&A Monday, 30 minutes until the start of trading. I'm Matt Miller.
And I'm Danny Berger. Bloomberg Open Interest starts right now.
Coming up, a meltdown in metals sparks a domino effect in stocks as investors size up a Warsh-led Fed.
And then there's the AI news. Oracle plans a $50 billion funding push, while NVIDIA CEO pours some cold water on OpenAI.
And on the earnings front, Disney's outlook disappoints as a potential successor to CEO Bob Iger emerges.
Well, it's a typical start of this week of like inundation with news, and a lot of it is on the AI front. So I'm looking at Oracle, Matt, and we're going to talk to Caroline about this in just a little bit. But Oracle has fallen for 4 straight sessions, the first time it's done that since October of last year. Today, we get a rally pre-market, 4.6%. It's going to raise somewhere between $45 and $50 billion this year through a debt and equity sales to build additional cloud infrastructure. Fitch and Moody's also both reaffirmed their long-term default rating at BBB. So I guess the fact that we have plans from them, an outline, is a good thing, even though they're going to be burning a lot more cash.
Right. I mean, we know also that their rating has been reaffirmed,
Yes.
which I guess calms markets a bit. NVIDIA's CEO says the company's proposed $100 billion investment in OpenAI was never a commitment, but says it could end up being NVIDIA's biggest investment to date. So you can see NVIDIA shares down 1 1/3% as I guess their intent isn't the same as a commitment. Seems like semantics to me.
Yeah, maybe.
Jensen Huang downplayed the commitment over the weekend. Listen to what he had to say.
Sam is closing the round, and we will absolutely be involved.
How much? Can you say how much? Can you say how much?
We will invest a great deal of money. Probably the largest investment we've ever made.
The large?
Yeah.
So is that going to be over 100 billion?
No. Nothing like that.
Joining us now is Bloomberg Tech's He had expressed concern about both the competition it faced and the lack of discipline is the way that they put it. It seems like Jensen Huang is trying to distance himself, saying no, isn't our fate and future.
In that he committed to potentially up to $100 billion to help them build out 10 gigawatts of compute power. But they only got the money as and when they deployed the infrastructure. And they went on to reassert that back in November when we got their earnings, saying sort of the deal, ultimately they reconfigured that there was always a question mark to this deal. It wasn't signed, sealed, and delivered in many ways. 100 billion was likely the overall maximum they'd ever deploy. But now we don't know as to how much they would actually put into an equity investment round into OpenAI rather than just money for infrastructure. And also at the rising time of concern around circular deals, again, we had that narrative when they put money into CoreWeave last week. And I think people have just dialed back from really loving NVIDIA putting money into its potential clients. But you're right, the damning part of the Wall Street Journal reporting was more the lack of discipline narrative, the worry about competition. Of course, Google Gemini doing so well on TPUs, not on NVIDIA chips, is largely the argument that's gone on there. The fact that we're seeing Anthropic do so well. Now, Anthropic's getting money from NVIDIA too, but has largely
been dependent on Amazon's own infrastructure. So all of this comes at a time where we continue to question how good OpenAI is for the 1.4 trillion that they'd thought banded around this amount of money that they were going to be deploying into infrastructure. And again, was that by 2030? Was that longer into the future? And indeed, how will those sorts of deals be structured? So there is a lot of question marks, but I think we'll get to see very soon how much NVIDIA is actually going to invest in the current funding round that's going on.
If you go back to the press release, it says NVIDIA intends to invest $100 billion. What's the point of telling us you intend to do something if you're going to just a few months later tell us that's not a commitment? It doesn't make any sense at all. But maybe that's why Oracle shares are up now, right? Because they say they intend to raise $50 billion to spend this year, and maybe they're not going to be committed to that in a couple months.
Well, I think what's happening with Oracle and what's really interesting about the narrative around the bond sales that are happening today, up to $25 billion worth in an 8-part syndicated deal, is that they're saying we're not going to raise again this year debt. And that's what they're actually being sued for on their previous $18 billion bond offering that they had, because people felt hidden from the idea that actually they were going to be on the hook for selling so much more debt in the future,
Right.
and suddenly you saw those bonds fall out of bed. So this time they're being very clear. It was very sort of unusual to put out this statement on a Sunday, but the fact that they're trying to get ahead of the market, trying to make clear to equity investors, this is what we want you on the hook for. We're going to do equity offerings or equity-like structured deals that go up to anywhere $25 billion. If they are going to be doing up to $50 billion is the total, they're then going to be issuing this debt as of today, but then they're done for 2026. And this is, again, as Oracle's trying to say and vindicate why they've got $95 billion of debt out there already, why they're the #1 issuer other than financials out there at the moment when you're looking at how much investment grade debt they have and whether they can cling on to investment grade rating. And this seems to be giving some peace to investors that, yes, they are really focused on keeping an investment grade for now.
Yeah, a massive amount of debt for a non-bank company. Caroline Hyde will be covering this on Bloomberg Tech. She co-hosts that program with Ed Ludlow. Kicks off at 11 a.m. Let's turn to Disney right now. It is trading 2% lower in the pre-market, even after it beat Wall Street estimates, with the bulk of profits coming from the parks and cruises unit led by Josh D'Amaro, a candidate to succeed Bob Iger, whose star now looks much brighter. The outlook, though, disappointed. Let's bring in Bloomberg's Geetha Ranganathan, Bloomberg Intelligence media analyst. Geetha, what's the concern here? Because the parks business looks so strong, and so I guess we expect D'Amaro to succeed Iger.
Yes, we do. He has been the front runner for the CEO job along with Dana Walden. But, Matt, we've really seen how parks has become such an important part of the business. So even though it contributes only about 38 to 39% of total company revenue, it is 60% of profits. And as you kind of look forward to the future with all the investments that they're making, we're looking at like $60 billion in investment over, another 8 to 10 years. Parks is definitely going to be the main bread and butter for this company. There's a lot of attention. They are the largest theme park operator in the world. Remember, they bring in about 150 million global visitors every year. So this is really the monster, when it comes to theme parks. And it only makes sense that, Josh D'Amaro would lead, I think, in many ways. In terms of guidance, I think the fiscal second quarter guidance was a little bit light, but I think Disney has said this time and time again, that this is really, fiscal 2026 is really going to be a second half weighted, earnings story. So I think a little bit disappointing, but it wasn't a complete shock.
Does putting D'Amaro at the top, though, Geetha, and just based on these earnings, change Disney's priorities, specifically when it comes to things like sports? I mean, falling 23% with all the higher rights fees and all the money that they're coughing up to try to get live sporting games. Do you think that this is a market that maybe pushes back against Disney with some of that cash burn and maybe looks to a potential new CEO in the parks division as a growing part of the business?
Absolutely, Danny. I think, a few years ago, I think the market completely underappreciated the value of the parks. I think just after COVID, and we've kind of seen this whole resurgence, in parks profitability, especially, they've undertaken so many new initiatives. They've really kind of boosted everything across the board, and we're seeing, quarter after quarter, even though some quarters we're seeing, attendance come in a little bit light, profits are still really strong, and that's really what counts. And yet, I think there's been kind of a little bit of a shift. Obviously, Disney used to be this huge TV network company. That is being de-emphasized a little bit. Sports, I think, will continue to be a huge part of the portfolio. But then as you kind of piece out everything, in terms of where the real profits are going to come, especially as we map out things over the next decade or so, it is most certainly going to be the theme park and the cruise business.
Geetha, thank you so much for that update after Disney earnings falling nearly 3%. Geetha Raghunathan from Bloomberg Intelligence. Let's turn to the turmoil in this market, and it is metals. Gold and silver, they're trying to claw back some losses after an earlier broad sell-off, but they're still down sharply this morning. Gold down 3.5%, silver almost down 4%. Oil is also plunging. There are signs of easing tensions between the U.S. and Iran. Bloomberg macro strategist Michael Ball joins us around the desk. Mike, you could ask all these questions about why this is happening. Is it because of Kevin Warsh? But does the size and speed of the sell-off tell us something about the nature of these markets and its correlation across other markets?
Yeah, I think it does. And I think it tells us that it became very frothy, full of speculation. And this was across the whole globe. Last week we were actually looking closely at some of the futures activity in the Chinese markets about gold and silver. We've seen it here in the U.S. for a couple of weeks, and weaker hands were coming in, they were more leveraged, and as positioning kind of built, stops also built, and once we started triggering some of these stops, everyone rushed for the exit at the same time, and liquidity dried up. And that wasn't just in silver and gold, that was across metals. We saw platinum, palladium, copper, some of the favorites of this year so far, basically give up year-to-date gains.
Yeah, we shouldn't lose sight of the fact that we're still at extremely high levels, right? For gold, I mean, yes, we're down, but we're still higher than we were at some points in January. And the dollar also hasn't really climbed that quickly. At 1190, I think, at the Bloomberg Dollar Index right now, and we were at 1200 just a couple of weeks ago. So talk to us about the dollar and how that plays into this.
Yeah, it's funny enough, you had a little bit of a capitulation in weaker dollar last week too, which shook off a lot of weak hands as well, as the dollar shorts were becoming very popular again. This happened out of Japan, and then it kind of went global. Warsh sort of put some of that to ease because he's seen as more neutral as far as policy lean, meaning he's not hawkish, he's not dovish. There's a lot of confusion actually about what he wants to lean into, and he's going to have to make the case for that. But overall, the worst fears had kind of stopped. And again, positioning is very crowded. It's crowded in a lot of these momentum trades, and the dollar short was becoming like that into sort of the last week. And then when we had a couple of catalysts, and lo and behold, everyone had to sort of change positioning.
All right, Michael Ball writes for the Bloomberg MLive team. You can check out his work and the work of that team. Follow the markets in real time by typing MLIV Go on your Bloomberg terminal. Let's look at futures right now in terms of equity indexes here. S&P futures down about 1/3% at 69.42. NASDAQ futures off more at 0.6% the loss. And we're looking at, I guess, the small caps also trading down. So it looks like we're going to have a open to the week.
Yeah, what a great start to February. How wonderful.
To the month, good point.
To the month, it's horrible and cold and snowy outside and everything is selling off. Maybe some good news, and that's going to be coming up. Fifth Third just completed its merger with Comerica. Welcome back, M&A Mondays. It becomes the 9th largest bank in the U.S. Fifth Third CEO Tim Spence will be joining us next to discuss. Stay with us on Open Interest.
It was definitely not a merger.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering.
We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
have you ever thought about, or would you make a movie for a streaming service? Would you make a Netflix movie?
Man, that's a great question.
I mean, I'm waiting for one where I ask and you go, that was a shitty question.
Yeah. I mean, you know, you good at your job, bro. Like, this is actually the first time anybody's ever asked me that. You know, I'm not here to say what I would and wouldn't do in the future. You know, but the theatrical experience is one that means a great deal to me. It means a great deal to us. I feel a certain responsibility. Like if Fruitville had happened a calendar year later, it probably would have come out on streaming. You know, I've been fortunate enough that everything that I've written and directed has been a theatrical release. So I feel a duty to try to protect that. You know, but that's where I'm at today.
Bringing you up to the minute global news whenever and wherever it happens. I'm Anne-Marie Hordern in Davos, Switzerland, and this is Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Let's get to high interest now. Look at what's making headlines around the world. U.S. rare earths and, critical minerals in general stocks are higher after President Trump unveiled a $12 billion strategic minerals stockpile aimed at reducing reliance on China. The initiative, called Project Vault, will store materials like gallium and cobalt for automakers, tech firms, and aerospace companies to protect against supply shocks. Elon Musk is in advanced talks to combine SpaceX with his artificial intelligence company XAO. An announcement could come as soon as this week, though talks remain fluid. The deal would unite rockets, satellites, and AI, advancing Musk's vision of space-based data centers. By the way, this also wouldn't be a merger. It's totally an acquisition of XAI by SpaceX. Devon Energy is buying rival Coterra Energy in an all-stock deal, creating a U.S. shale giant valued at about $58 billion. The tie-up will strengthen its scale in the Permian Basin, letting the company better compete with rivals like ExxonMobil and Diamondback Energy. The combined company will keep the Devon name, and the Devon CEO will stay on at the helm. That's a key as to who the buyer is.
Yeah, tie-up is cool. Merger, not cool. Let me just take notes to make sure I don't run afoul of Matt Miller's linguistic rules. Let's stick with deals. Speaking of which, Fifth Third has completed its deal to buy Comerica today. That creates the 9th largest U.S. bank with approximately $294 billion in assets. Let's bring in Fifth Third Chairman, CEO, and President Tim Spence. Tim, good morning to you. Thanks for joining us. Congratulations. This deal now completing. What does success look like in the early days of this tie-up?
Yeah, good morning, Danny and Matt. I do have to say, by the way, it may be a bleak morning for precious metals around the world, but it's a very bright morning in the Midwest and across the Sun Belt in the U.S. as a result of this merger. Milestone number one was just getting to legal day one, as we did this morning, as you mentioned. I was thrilled with the responsiveness of the regulators, the fact that we got OCC approval in 45 days and Federal Reserve approval in 65 days. Set us up to get open. We actually converted Comerica's capital markets platform last night. So Comerica is trading on Fifth Third's platform as of this morning. And Comericans all got a one-notch upgrade in terms of their debt rating, which will be very valuable in letters of credit. And as it relates to our ability to gather corporate deposits and otherwise. Next big milestone for us is getting the groups from both companies together to operate as one team and then out into the market on offense. So I'm very, very excited to be here this morning and for both of our companies to have the bright future that we do.
I love your focus on the physical branch is not dead at Fifth Third. And indeed, you're going to, I think, open at like 150 in Texas. You've got a ton in Michigan. And I wonder how you avoid overlap there, because you clearly don't want to alienate customers by closing the branch that they bank in, but you can't have two on the same block, right? So what do you do?
Yeah, we ironically, several of the branches that we will close in Michigan actually share the same parking lot. So they're in the same strip center with shared parking. We have just over 70 branches that are slated for closure in Michigan. They all are essentially within a sight line of one another. So customers will not have to worry about being inconvenienced, but all that will happen after we do the systems conversion this fall. So the expectation for customers this morning should be that they get up, and if they need support, they go to the same place that they would have gone to previously. They talk to the same person, and then there will be high quality products and services for Comerica customers, a big step up in terms of the customer facing technology. And then for Comerica customers, 60% more branches in Michigan, and for Fifth Third customers, 40% more branches after we get through the conversion on Labor Day.
Tim, I guess, as a customer, it wouldn't matter if I'm going to the branch on Broad and Main or the branch on Main and Broad, but what does matter is that I keep my banker. How do you ensure that your most important employees stay on?
Yeah, I think job number one is to make sure that they are confident that they can serve their clients better today than they would have been previously. And that, frankly, is probably the part of the merger here that has been least understood. We talked last fall at one of the investor conferences about the fact that we think there are $500 million in revenue synergies. Those are not coming from pricing. They're coming from broader products and services. So Comerica colleagues have been accustomed to working within the limitations of an $80 billion balance sheet. They have a significantly larger balance sheet to draw from today. They will have access to the J.D. Power award-winning mobile application that Fifth Third offers its customers, a broad range of services across equipment leasing, asset-based lending, and commercial payments in particular, along with the bigger capital markets platform. And then Fifth Third customers will have the ability to draw on a lot of the specialty verticals that Comerica operated in the middle market, like environmental services, dealer services, tech and life sciences. So that's it. They have to believe that they can serve their clients well, and that, in fact, they have the ability to be more productive on our platform, which I am absolutely certain they will be.
Hey, Tim, more broadly, there's a lot of really good stuff happening in the banking sector right now, easing regulation, as you talked about, the more adept speed and ease of doing mergers, which is great for regional banks. There are all these pockets, though, that people tend to worry about, and we got a big one last year in the way of Tricolor. I know Fifth Third did have a small exposure, writing off about some $170 million in bad loans, but that experience more generally, has it changed your approach to markets at all? Has it changed some due diligence? Are you rethinking auto lending or warehousing going forward?
Yeah, I mean, that's a great question. I think I look forward to January every year because in addition to the earnings script and the performance reviews, I have to write our annual letter. And it's an opportunity to step back and not just think about what you learned in a given year, but to think about the progress you are or aren't making across a broader sweep. So one of the things that has been fun for me to reflect on as we bring Fifth Third and Comerica together is if you look at the bank in 2016, it was like $142 billion in assets. It had about a 10.5% return on tangible common equity. And by the end of 2026, we're going to have roughly double both those things. So really strong growth in terms of top line revenue and the size of the balance sheet, and a near doubling in profitability. The other thing that you step back and look at is, say, as a larger company, that is dealing with either more sophisticated credits or a broader range of markets, have we thought the right way about concentration limits, about the decisions that we make in terms of lending? Fifth Third has been in the asset-based finance business for a lot of years, has had really wonderful experience, and banks, what I think of as being the who's who of clients across the categories there. Tricolor obviously did not perform that way, and whenever you experience a fraud of that magnitude, you always step back and try to figure out what you could have done differently. Was it client selection? Were there things that we could do in terms of monitoring to get a better sense for early warning? And I did talk a little bit about this in the aftermath last fall, but again, the big focus for us is just in making sure that we do the things we need to do to monitor collateral, because you can't have a secured loan deliver an unsecured loss without it being painful, which of course it was.
Hey, Tim, we always really appreciate your time. Thank you again for joining us, and congratulations on this deal. Come back again soon, Fifth Third Chairman, CEO, and President Tim Spence. By the way, don't miss the debut of Bloomberg Deals if you hadn't heard of it. It happens this week. It's my new show tracking the power players, major moves, and capital flows shaping global markets. Maybe, Tim, we'll stop by at some point. Catch it Wednesday, February 4th, 12 p.m. New York time. You're watching Open Interest.
to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Up-to-the-minute political news whenever and wherever it happens. I'm Tyler Kendall in Washington, and this is Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything. Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg.
The trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Only on Bloomberg. A check on futures ahead of the opening bell, and it is a tough start to February after a tough end to January. NASDAQ 100 futures leading the declines, with NVIDIA falling this morning after questions around its commitment to OpenAI. Jensen Huang saying, we won't invest more than $100 billion. That was simply a letter of intent. But it is gold and silver that continue to plunge. Maybe that's what's weighing on markets. They're both down at least 4%. That's the case for gold. Silver down 5.33%. Less than 4 minutes until the opening bell, we begin the trading day with Citi's Stuart Kaiser. That's coming up next.
Nobu-san, would you say, when you look at your career, that the pivotal moment was actually that meeting with Robert De Niro? It took him 4 years to convince you to open a restaurant near him. You eventually did, and that started a partnership that has lasted through the decade.
You know, I met him 1988 after my first restaurant opened. He asked me to come to open a restaurant in New York. And beginning, I didn't know what he did.
You didn't know he was an actor?
No, I don't know. What he doing? Because I never watched the movies. You know, I was traveling the business. But of course, after, you know, people, hey, Nobu, so you must know him. And then I understand.
How is he as a partner?
He's for me, and a great partner. He understands to my concept. He support me 100%. But he's a very smart people. Sometimes so strange idea, but it's good idea. So, example, Nobu Hotels idea come from him. He said, "Hey Nobu, so we have a lot of new restaurants coming in somebody's hotel." For him, doesn't make any sense. Then we start Nobu Hotel in Las Vegas 11 years ago. Now it's a big success. So next step is the residence.
Astonishing day for US technology.
It's shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
Bringing you up to them in the news whenever and wherever it happens. I'm Sherian in Seoul, and this is Bloomberg.
We are moments away from the start of trading on this Monday, February 2nd. This is Bloomberg Open Interest. I'm Matt Miller, looking at futures that are lower across the board as the metals rally collapsed this morning, reverberating across stocks. We'll see if this holds, because there's a lot of fairly decent news out, and there are a lot of deals getting closed. Let's take a look at the bell ringers here. Compass International Holdings ringing the bell, the New York Stock Exchange, and they're in a good mood because this is a stock that's really on the comeback. If you look at the 5-year chart, it's not so great, but over the last year, they're up like 80%. Over the last 2 years, 200%. So really starting to make a dent in the drops that they had post-COVID. WD stands for Western Digital, and I believe they're another one of these companies that's dropped their name in favor of their initials. Maybe they were worried about their Eastern counterparts, because it is a global memory chip maker. They brought, I think, everybody to the NASDAQ market site to ring the bell. What do you think about WD?
There's too many WDs. It's like WD-40, Women's Wear Daily. Too many WDs. It's not unique.
When I first looked up, I thought it was weapons of mass destruction.
Yeah, that's also a bad one.
There's no N.
I don't know. It's like this world is getting like smaller and more gray and less colorful, and I think we should be making names longer and more intricate.
Agreed.
I think that's the way to go.
We are on the same page, DB.
I love when that happens. Yeah. Although you did just call me DB, which is doing the thing we said we wouldn't just do anyway, some stocks to watch this morning. A tale of two tech companies and similar stories. Oracle plans to raise $45 billion to $50 billion this year through a debt and equity sales to build additional cloud infrastructure. They also get reaffirmed on their guidance by Fitch and Moody's. So the story for them is, yay, that's good, because we're getting some structure, some outline to the type of spending that you want to do. When it comes to NVIDIA, shares are down 2%. Jensen Huang saying that their proposed $100 billion investment was just that, to OpenAI. It was never a commitment, but says it could end up being NVIDIA's biggest investment to date. Now, there's also a Wall Street Journal report that Jensen Huang apparently was skeptical on the spending and some of what he thought might be wasted OpenAI, and so maybe it's just trying to pull back a little bit.
Yeah, seems like he bit off a little bit more than he could chew there. But we'll find out in the coming months and years. I'm sure they'll invest tens of billions of dollars, if not 100 in total. Disney earnings beat estimates, but analysts don't seem at all impressed with the company's outlook. The share's down 7.5% in the early trade. The CEO, Bob Iger, says he's bullish on the experiences division. That means the parks and boats, which brought in a bulk of the profit. I think Geetha Ranganathan told us earlier, 60% of the profits come from the parks business. So we may see the guy that leads that lead the whole company when Iger steps down for a second time. Let's talk about the market, though, more broadly with Citi head of U.S. equity trading, Stuart Kaiser. He joins us here on set. And Stuart, You know, the slide that we saw in gold and silver at the end of last week continued in size at the beginning of this week. Is that, you think, what's spooking equity investors this morning at the bell?
Yeah, it does seem to be. I mean, the end of last week, you had not only gold and silver, but like retail favorite stocks also getting treated pretty unfriendly, you know, to end the month. So it does seem like kind of core positions are under a little bit of pressure. Gold and silver specifically, there is some discussion that if new Fed Chair Warsh wants to shrink the balance sheet, that means less dollars in circulation, which means potential kind of downward pressure on these metal stocks. But I think for now, you just have to look at this as, excuse me, as some market leadership kind of coming under some pressure to end the month after what had been a very strong month, to be fair. And when you make that much money that quick and you're a PM, your tolerance for downside is pretty limited, and you may just be seeing some profit taking here into early February.
Profit taking, maybe someone will jump in to buy the dip, and maybe it will be retail, because as you were hinting at, retail has gotten so involved in this trade, but it's also gotten incredibly involved in the equity trade too. The share of trading by retail investors has ballooned. Is this not a warning sign for markets when you have this broader participation that maybe hands are a little bit flimsy, or paper, as the kids say?
You know, it could be, but I would say the pullback in retail trading activity kind of started late October, and those retail favorite stocks did quite well until really this last week. So, you know, I think some debate about whether retail being a participant adds volatility or not, because they have been, you know, super supportive. But it does seem like really since October, we went from about 15% of total equity trading volume down to about 10% for retail, and that decline didn't hurt the markets at all. So I think it's easy now to say, oh, it must be retail's fault. It does seem a little bit more broader than that, because gold and silver, retail, I think, was a pretty late adopter of that trade. That has been very much an institutional trade, I would say, until the last kind of few months when gold kind of went hyperbolic. So again, I don't want to blame retail for it, but I think it is the case that we've seen a pullback in retail activity to end the month. We've seen a pullback in institutional activity. You've got a new Fed chair, and those things seem to have conspired to attack the favorite trades.
What do you advise clients in terms of to do in terms of diversification or hedging? Because it seems like the gold trade was kind of like an exit plan, like getting a house in a foreign jurisdiction with a bank account outside of the U.S., right? That's at least what the wealthy investors I talked to said they were buying gold for.
I think that's what they said they were buying gold for. But when you talk to people about gold, the logic was gold goes up in all cases. So it didn't feel like as much a hedge as it felt like a directional view, a way to kind of be short the U.S. dollar without being long any other currencies, et cetera. I mean, our view is still pretty positive U.S. equities. We like being long that kind of cyclicals part of the market. And, you know, what are the risks here, or at least tactically? I think it's the unemployment rate, which our economists expect to stay flat at 4.4%. And it is tremendously high expectations about the stimulus that's going to hit the U.S. economy and what those tax refunds are going to look like. So if you took that together, labor market and tax refunds, if you're hedging this market, you really want to be hedging the consumer side of the market, because that's where the positivity is, and I think that's where you need the good news to play out. So I think if you're hedging retailers and U.S. consumer spending.
It's interesting to hear you say that, because it used to just be tech where all the optimism was, but it feels like we keep getting reality checks. An interesting one today in the divergence between the performance of Oracle and that of NVIDIA. Oracle gave us details, so that's great, but maybe NVIDIA wants to back off of the OpenAI ecosystem, and that's a problem. How are you viewing just the general sector when you have the circular financing, maybe there's a little bit of nerves in it? How volatile is the tech trade, and do you buy the dips, or do you kind of step out and say, if you've bought here, that's enough, stay back otherwise?
You know, it's funny, it's actually a really interesting trade right now, because if you look at last week, you actually had tech kind of net itself out, right? Tech hardware was up, media was up, semis were up, software got hit. In that sense, like, it actually reduces volatility, because you kind of have these offsets going on in the market. One thing is perfectly clear, people are really long this sector. So if you had a headline or a news development that had people de-risk and de-gross, you would have a lot of downside pressure on tech, and that's why it's become so expensive to hedge in triple Qs and kind of the tech space. But I think what you're seeing today with NVIDIA, Oracle, like, one's up, one down. It's become a very sort of idiosyncratic risk story. You need to pick the right stocks. On Oracle and NVIDIA specifically today, my guess is both those moves are probably a little bit of a fade. You know, the last time this happened with Oracle, where they announced kind of AI revenues and debt issuance, the stock stock came up and it kind of ultimately reversed. And, Jensen saying, hey, we might do 100 billion, we might not. I mean, they're going to spend and they're going to keep spending.
Do you start to pay attention to debt levels even at these big hyperscalers? Okay, Oracle's not a Mag 7 stock, but we have been saying they're massive companies, so who cares if they borrow 25 billion? But now it's 50 billion, and it adds to 100 billion that they already have out. So
it's on the radar. I think just to your point, Mag 7 are all AA rated or above credits, incredibly strong balance sheet.
True, Oracle's a triple B.
Yeah, they can find, to your point, Oracle's a triple B, and there's a lot of stocks that are triple B or below that have committed to a lot of spending. So I think what the market has kind of done is bifurcated that market out. They're treating Mag 7 with negative net debt on balance sheets separately than they're treating a company that has leverage. And you've seen that clearly in Oracle credit spread. So, the term we've used is this AI spending trade is getting an audit right now, and the audit is telling you if you have leverage on balance sheet and you're committing to spend, you better have a way to demonstrate to investors that there's some monetization or some return on that investment. If not, you're gonna kind of be punished in the credit market.
Hey, Stuart, such a pleasure to have you on. As
Thank
always,
you.
that is Citi's Stuart Kaiser. About 9 minutes into your trading day, let's get a check on your equity market, because we are having a push-pull, I guess, between NVIDIA and Oracle. What is winning out? It is, I guess, Oracle at the moment. We're actually higher, even though the future session was lower. If you look at look at the breadth. What is the breadth? It's too small for me to see at the moment. Let me walk on up to this.
309 up?
Oh, it's good. It's good. Wow, how can you see that, Matt? That's really impressive. 304, 5, 2, 1 stocks up, 200 are down, so the breadth is better. Looking at what's leading us, it is Amazon. They're going to be reporting earnings on Thursday, followed shortly after by Visa, Micron, AMD, which also has earnings this week too, MasterCard, so some of those card companies doing better after having a rough start, a rough January after some of the proposed policies from the president. On the downside, you have NVIDIA. Again, they, or at least Jensen Huang, is rethinking what we thought was an $100 billion commitment, but they're like, no, it's not a commitment. It was just kind of a letter of intent that we're not going to invest up to that amount. Microsoft, those shares falling after getting clobbered last week on their earnings and their plans to spend much more. Meta down 1.1%. We also heard from them from earnings too. Disney also falling off the back of their earnings. It was all led by Parks. Sports down about a third, so that was pretty painful. We should get a new CEO from them shortly too. Looking at the sectors, energy is down very sharply. The price of oil also down sharply. I think it's down like 5% in this morning's trade with the U.S. and Iran. Better relations, at least things cooling off the most heated levels. Communication services down with Meta down. Tech, surprisingly, is only down 0.1%, but it's really only NVIDIA that's down. Amazon was up, for example. At the top of the pile, materials, consumer staples, and healthcare. So a little bit of a safety kind of trade there, Matt, but this market, little changed at the moment.
All right, very interesting to see that flip, because we had seen at the very beginning of the session an inverse in terms of the breadth. So now we're to the upside. Coming up, NVIDIA's $100 billion investment intent in OpenAI wasn't really a commitment, Jensen Huang says. Could that be because of Amazon? Bloomberg Intelligence analyst Mandeep Singh thinks so. He joins us to explain next. This is Open Interest.
Rodriguez. And I'm Jason Kelly. And we're back with another season of The Deal. With athletes and entrepreneurs who are changing the game on and off the field. Jerry Jones.
Some good-looking trophies.
1-1 is 3 in sports, not 2. And it's because that 3 is imagination. That 3 is putting yourself in a way, having yourself hit the home run.
Erica Ayers-Badon.
I'm a high-energy board member. I'm very passionate. I have a lot of opinions.
Robin Arzone.
I want to light fires in people's lives, and that is still one of my core mandates for all of my businesses.
Justin Tuck.
I tell all of my friends that play in leagues now, make these relationships now while you're hot. Don't wait till you're the 12th year in and you're just hanging on.
Stay tuned. You won't want to miss it.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
The trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Only on Bloomberg.
Used to be, one would say, what's that got to do with the price of tea in China, when they wanted to poke holes in the relevance of something? Now, though, if you're in tune with how events around the world affect each other, it becomes clear that the current going rate of tea in China has a lot to do with a lot of things, not just tea things either, but tariffs, franchises, and IPOs. How much?
We have an attempt to rally on our hands. We are basically unchanged on the S&P, slightly positive. The Nasdaq up by 0.2%, a turnaround from the future session and from last week, so maybe February will start on the front foot. Time now for your top calls, the analyst action that we are watching. First up, Morgan Stanley is downgrading Humana to a sell, warning that rising Medicare policy pressure leaves the company more exposed than its peers. The firm warns that weaker rates signal may force Humana to submit more conservative plans this year that could make its offering less attractive. Shares down more than 2%. Next up, BTIG has upgraded McDonald's. They say the company is entering the early stages of a recovery with its core low-income customer. The firm expects higher disposable income, larger tax refunds, and larger taxes lower taxes on tips and over time to drive increased spending. All of that, they say, will create a meaningful tailwind for the fast food industry. Shares up 1.33%. Finally, William Blair, they upgrade Palantir ahead of earnings, saying that momentum remains strong as government use deepens and enterprise customers expand workflows. They see recent execution as evidence that Palantir is outpacing its weaker software peers, supporting continued growth and margin strength. Palantir reports after the bell today. Matt, those shares up just under 2%.
All right, looking forward to that release for sure. Let's get back to NVIDIA, though. The CEO is lowering expectations around his $100 billion investment intent in OpenAI. Mandeep Singh of Bloomberg Intelligence says it could be a result of Amazon's $50 billion investment in OpenAI. So I guess, taking the pressure off a little bit. Mandeep joins us here at the desk. And, you know, it's interesting. I went back to the original $100 billion investment and looked at the press release. They said they intend to do it. How is that not a commitment?
Well, I mean, it's a play between, the exact language that they use in that release, but clearly the intent was there, and, the 10 gigawatt capacity addition is what they focused on in terms of the 100 billion commitment. And now I think things are changing in the sense that OpenAI clearly is looking to raise as much as 50 billion from Amazon in this latest round. So the fact that Amazon is developing its own chips, which they want OpenAI to use for both training and inferencing, conflicts with what NVIDIA wants OpenAI to do. So now you're seeing that play where NVIDIA doesn't want to be involved where Amazon or Google is involved. And I think that's what you're seeing.
What did you make of that Wall Street Journal report that Jensen Huang was also concerned about a lack of discipline at OpenAI and concerned about competition?
Yeah, I think that kind of alludes to the lack of discipline where you pick a partner, first in Microsoft, then in NVIDIA, and now you're saying you're going to Amazon. So, you're pretty much going to everyone for your funding needs, and you've got grand ambitions of your own. But in terms of developing an ecosystem, this is not ideal, and I think that's what's going on here.
By the way, SoftBank also, right, sold its NVIDIA stake and now is using that money to invest in OpenAI. Is OpenAI the right horse to bet on?
I mean, in terms of frontier models, they still are in that top 3 race, when you think about OpenAI, Anthropic, and Google Gemini, and then there's everyone else. So from that perspective, yes, they have that frontier model lead, but the other 2 have caught up. For a while, it was just OpenAI. Now we are talking about Gemini and Anthropic being neck and neck. So from that perspective, this is not a monopoly situation where...
How often do they make changes, Mandeep? Because for a while, and just anecdotally, right, I was using heavily OpenAI, ChatGPT, then I went to Gemini for a while because ChatGPT seemed to diminish, and now I've gone back because it seems far better. I mean, how often do they make changes to their models?
They do train them, at least once in 6 months, and then obviously they're releasing new versions of their models as well. So from that perspective, these models are increasing in capability and intelligence, but what Anthropic has shown is you are honing in on specialization here. So Coding Agent was a great example. Same thing with Gemini, with image generation. So all these models are trying to develop sort of a lead in a particular area as opposed to, focusing on all things at the same time.
Mandeep, what do you make of the reaction to Oracle today? Because I thought this was supposed to be the poster child of excessive spending. And they're going to be spending more. They lay out their plans up to $50 billion. I think their free cash flow isn't supposed to go positive again until 2030. Why are we like, oh, that's great news? Congrats, Oracle.
Well, so there was a lot of cynicism around, Oracle's guide for the next 4 years, including, they were expected to add $44 billion in AI infrastructure revenue just in 2027. So compare that to all the cloud guys, what we saw with Azure and what we'll see with Google Cloud. That was a big step up. And so that's where the market thought this is not possible. Now that Oracle is raising, capital on their own to build the infrastructure, which will come online in 2027, now you've got, some visibility as to how that will happen. Because previously, you had that OpenAI backlog without knowing, does Oracle have the infrastructure to serve that backlog? And I think now you're sort of seeing how Oracle is going about it.
Mandeep, thanks so much for joining us this morning. Oracle shares up just under 1%, losing some of their steam. That's Mandeep Singh from Bloomberg Intelligence. Coming up, a deal in the works. SpaceX is in advanced talks to combine with xAI as tie-ups between Musk's empire deepen. That's coming up next. This is Bloomberg.
up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at Japan's Akasaka Palace in Tokyo, and this is Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
Now, Mandeep Singh of Bloomberg Intelligence is still with us around the table, too. Liana, I know there had been some questions as to whether SpaceX combines with Tesla or what xAI going with Tesla. Why this deal in this form? Why is this what Elon Musk is eyeing?
It seems like this is what's been gaining traction over the weekend and late last week, that it's going to be xAI and SpaceX, the two private companies, or, well, there's more private companies in Musk's portfolio, but the two biggest private companies would merge. It's going to be some more financial engineering. You might remember last year, X and xAI came under one umbrella, so this just, furthers that consolidation among these private companies in his wheelhouse.
I want to bring back Mandeep Singh from Bloomberg Intelligence, because I have long heard from market participants that they expect all these companies to combine in order to drive Tesla's market cap up to $8.5 trillion. That way Musk can get his $1 trillion pay package. Is this just a test run? Does Musk put these two companies together before he combines them eventually all with Tesla?
I mean, right now, I think xAI needs a lot of money. When you compare them to the other foundational model players, they are investing heavily upfront to, develop the model for inferencing as well, serving the model traffic. xAI has to raise more money. And so from that perspective, they already lost $11 billion. That was their cash burn for 2025. How do you convince investors to invest in xAI ahead of OpenAI or Gemini or, Anthropic? And so from that perspective, combining, SpaceX and xAI makes more sense, because that makes it more palatable as an entity to invest in. And so that, for me, is the rationale, because there's no doubt that xAI needs more money. Otherwise, they would trail behind these three frontier models.
Well, just on that point, Liana, I know you wrote in your story, too, that part of the impetus of this is putting data centers in space. And I have to say, we had a space executive on who was like, we're going to put data centers on the moon. And I thought it was the most insane thing I'd ever heard. I mean, does this get it closer to reality? Does this help in some nature?
I've been more focused on the SpaceX IPO. That's a little more realistic, but I think some filings came out where, Musk is laying the groundwork for potentially these data centers in space. Maybe Mandeep would know more about the Grok chips and how that would work, but definitely there's so much demand for power generation that'll be needed here on Earth and in space.
How does it change the IPO then, if these two combine?
I'd say, I mentioned before, there's some financial engineering here. It's just a cleaner, if this is one company, it would definitely make for a longer IPO prospectus. But we'll see. If this goes out this year, it'll be one of the most high profile and biggest IPOs we've seen.
What's with the, Mandeep, space centers, data centers, I should say, in space? Because I saw on the Telegraph this morning, the British tabloid,
I'm aware of it, thank you.
that Rolls-Royce had been planning to put a mini nuclear reactor on the moon.
By the way, isn't it just nearly like a miracle of science we can even land on the moon at all, let alone put data centers on it?
Look, that's where, it is still a science experiment, and now these companies are talking about, adding, building gigawatt data centers. There's no way you'll be able to build a gigawatt data center. Yes, it may save you some money with cooling, but that doesn't mean, everything else is kind of solved for when it comes to building a large-sized data center. And, these cost $50 billion on Earth to build. Imagine how much the cost will be in space. So maybe Elon Musk knows better on that front.
The future is here, and it's terrifying, and I hate it.
I love it.
Data centers on the moon.
it?
It's so crazy to me.
Oh, it's so much fun.
Yeah.
And a lot of mergers and acquisitions as well, which is great for you.
Yeah, funny
and for your new
that.
show.
I'm so excited. Liana is going to be joining me for it. Bloomberg Deals premieres this Wednesday. Tune in for it, 12 p.m. We're going to be tracking all the power players' major moves and capital flows. We'll get Mandeep on there to talk about tech deals. That's this Wednesday. Stay with us. This is Open Interest.
are in such an incredibly exciting moment with AI. It is really the most profound technology of our lifetimes, and I think it has the potential to help us rethink literally everything. The potential for economic impact, societal benefit is honestly boundless. When we think about the economic impact for Europe in particular, it's around a 1.2 trillion euro estimate of the productivity growth that can be unlocked. This platform shift that we are living through, I think, is going to create untold amounts of value for the world, but also for the businesses and for economies, which is why I'm incredibly optimistic in this moment for Europe, but also for the whole world.
How do you think about job losses or safety for some of the AI tools?
You know, I hear the anxiety, and I understand the anxiety about jobs. I think that we are certainly going to live through a massive transition about how people learn to work alongside these tools. I mean, the reality is I do think there'll be some number of jobs that are displaced. I think it is a smaller number maybe than some anticipate. We estimate it's around 7%. And I think what's important is that we have programs that help those 7% transition into new fields of work. I think what is more is that most of us are going to learn to work alongside these tools. So we estimate about 2/3 of us. If you think about the tasks you do in your daily life, when you look at every industry, there are administrative tasks that are happening everywhere, and that's what AI is most helpful in improving.
We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics, and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
CBS News on the Hour, your home for original reporting.
I'm Deborah Rodriguez. A portion of the government will remain closed until at least tomorrow after a partial shutdown that began Saturday. House Speaker Mike Johnson tells Fox.
We'll get all this done by Tuesday, I'm convinced. We do have to do it we have a rule process, which will be probably on our own.
Correspondent Nicole Killian is on Capitol Hill.
The House Rules Committee is set to meet to take up this legislation. The Speaker really wanted to try to fast-track this bill, but according to our sources, the Speaker had a conversation with Leader Jeffries over the weekend where it was conveyed that House Democrats would not put up extra votes to fast-track this measure.
They say they won't support any measure that doesn't include major immigration enforcement changes. People in the Southeast are struggling to dig out from yet another winter storm. This time, the Carolina coast took the biggest hit with up to 1.5 feet of snow and powerful winds. CBS meteorologist Rob Marciano.
Unusual and historic snow across parts of North Carolina, and the cold pretty drastic across parts of South Florida. West Palm Beach getting down to below freezing again this morning. 10 to 20 degree temperatures and wind chills in Charlotte and places down on the coastal plain.
The main thoroughfare from Gaza to Egypt, the Rafah crossing, reopened today for the first time in almost 2 years. Linda Gradstein reports from Jerusalem.
Israeli officials said the reopening today was limited, with Israel requiring security checks for Palestinians both entering and exiting Gaza. An Egyptian official said that only 50 Palestinians will cross in each direction the first day, and that will gradually increase. Both Israel and Egypt will require a list of names of those who want to cross and prior approval.
Savannah Guthrie was missing from NBC's Today Show this morning. Police say her 84-year-old mother is missing in Arizona.
Investigators say 84-year-old Nancy Guthrie was last seen Saturday night near her home west of Tucson. Pima County, Arizona Sheriff Chris Nanos.
We will continue to search as we are right now with our survey, our air assets. We use drones and our airplane or our helicopter.
Nanos says they haven't ruled out foul play, and homicide detectives have been looking for clues at her home. He He says Guthrie has no cognitive issues, but is mobility impaired. In a written statement, Savannah Guthrie has thanked viewers for their thoughts, prayers, and support. Peter King, CBS News.
If you drive a Ford pickup, this might affect you. The National Highway Traffic Safety Administration says it's expanded an investigation into transmission issues on 1.3 million F-150s. The problem, reports of trucks downshifting unexpectedly, model years 2015 through 17. This is CBS News. While President Trump pushes for a 10% cap on credit card interest rates, you can do something now to lower them on your own.
Thomas Nitze with the nonprofit credit counseling agency Money Management International says in many cases, all you have to do is ask.
A Lending Tree survey found that about 3/4 of people who asked their creditor for a lower interest rate got one, and that on average they shaved off 6 percentage points, which is, significant if you're talking about a lot of debt over a long period of time.
You may have more leverage if you have good credit or you've been loyal with your credit card issuer. You can also transfer your balances to cards with 0% introductory rates. Michael Wallace, CBS News.
Pennsylvania's prognosticating groundhog, Punxsutawney Phil, emerged from his burrow this morning.
There is a shadow here on my ground. 6 more weeks of winter abound.
According to NOAA, Phil's only accurate 35% of the time. Deborah Rodriguez, CBS News.
This is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney.
How do you think the Fed is looking at tariffs, the uncertainty of tariffs?
Let's take a look at the sectors and how they perform.
A lot of investors getting whipsawed every day by news events.
Breaking market headlines and corporate news from across the globe.
Could we see a market disruption, a market event?
Are people just too exuberant out there?
You see some so-called low-quality stocks driving this short-term rally.
Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio, YouTube, and Bloomberg Originals.
Good Monday morning from the Bloomberg Interactive Broker Studio in New York City. We're streaming live on YouTube as well. Head over to youtube.com and search Bloomberg Podcast. That's where you'll find us here. Scarlett Fu and Paul Sweeney. This is the Bloomberg Intelligence Program. Let's get right to some economic data. ISM manufacturing data came out. Boy, this looks pretty darn good, right? 52.6. The consensus was 48.5. Anything over at 50 means the manufacturing economy is growing. That seems pretty good to me. Let's go to somebody who knows this stuff here. Susan Spence, she is the chair for ISM Manufacturing PMI at the Institute for Supply Management. Susan, do I trend this number out a little bit? I actually got a number that's above 50 for once.
Yes, good morning. Thanks for having me. We did take a big leap. I will give you some highlights and then something from our panelists' comments that may be an explanation. We have been wanting to see an improvement. About a 4.7 point increase in manufacturing PMI. This is the third month the production index is in expansion, which is a great sign, but it's the first month in a long time for new orders and backlog. And so I've been saying every month, when we have several months of expansion or growing new orders and backlog as a result, I will feel much better about it not being just an uptick. So big leaps there. New export orders also an expansion, 3.4. That one's been suffering. So let me get right to a couple of points that the panelists brought up. A number of them said post-holiday restocking. is pretty typical. A few of them said they believe their customers are hitting a window where if there are more tariffs coming, they want to get their orders in. And customer inventory index at 38.7 is the lowest point since June of 22. So we've been saying every month, if you have low customer inventory, it's good because the trigger point has got to be happening soon. The question that we all have, and prices, by the way, still are still increasing. Employment is not in expansion yet. So my belief is that if we get a couple of more months of new orders, then maybe our confidence comes back that our customers are ordering. It's all about what they're going to do.
Right. And of course,
sorry, go ahead.
No, 1 month does not a trend make. Based on the commentary that you've gotten from panelists, what is your sense of how things are shaping up for February, for March, for the rest of the first quarter?
So in our forecast in December, the panelists were quite optimistic, which could make you scratch your head a bit given all that's going on. This month in particular, the demand sentiment, typically it's for every positive comment, we've had 2 or 3 negative. It is turned around. For every, there are 2 positive comments for every 1. So they are optimistic, and this is the first month that they're seeing it maybe come to fruition. I do think it's going to be wildly impacted, but that, by what happens with additional tariffs, the Supreme Court ruling. So when the customers are feeling confident that there's a little more steadiness and continuity, we believe the ordering could come back. But we'll take this one. We're happy with it. And along with these great numbers, the percent of manufacturing sector in expansion versus contraction has turned around as well. I believe we're only at about 20% of manufacturing sector in contraction and only 12 in strong contraction. So big changes. Let's just hope these numbers hold and customers are confident and want to do business with the U.S.
All right, we'll take the W, as they say, take the win. Susan Spence, Chair for ISM Manufacturing PMIs at the Institute for Supply Management. To get a reset here of this market, we can do that with John Tucker and a Bloomberg Business Flash.
All right, guys, this Bloomberg Business Flash being brought to you by IBKR. Financial advisors switch to Interactive Brokers for lowest cost global trading and turnkey custody solutions. No ticket charges, no conflicts of your interests. Learn more at ibkr.com/RIA. Let me give you the instant reaction to the ISM manufacturing report. Of course, as Susan and you guys just mentioned, coming in higher than expectations. You're seeing it in yields. They're higher. The 2-year, which is more policy reactive, up 4 basis points. That's at 356. The 10-year yield up almost 4 basis points. That is at 427 right now. And the dollar DXY, that is up 0.5%. Dow Jones Industrial Average, 276 points higher right now. That's up 0.6%. S&P 500 pushing higher, up 29 points. It is up 0.4% right now. And the NASDAQ 100 up 165 points. That's a rise of 0.6%. Well, solid results from Disney, but the company delivering an outlook that analysts see as kind of disappointing. The projections were tempered on cruise launch costs and also some of the pre-opening expenses for the World of Frozen in Paris. Another attraction I'm going to miss.
Wait, on the cruise ship, or this is something separate?
Well, the cruise ship, well, they're in the same division, but the cruise ships,
got it.
launching them, dry docking them, all that's expensive.
Absolutely.
Then opening up the World of Frozen in Paris is
sounds
expensive
pricey.
too. So it's one of the largest oil and natural gas deals in years. Shale companies pushing to consolidate in the Permian Basin, among other things, because a lot of the best drilling sites, they're gone. Devon Energy agreeing to acquire rival shale driller Coterra Energy for $21.4 billion. This is an all-stock transaction. Coterra shares down 2.8% right now. Barclays analyst Tom O'Malley raising the firm's price target on SanDisk to $750 from $385. SanDisk, the best performing stock right now in the S&P 500. It was up close to 8%. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash.
You know what I noticed sitting on the beach in Aruba and seeing the cruise ships at dock? They emit a lot of pollution. I was just sitting there looking at that, and it's like they had 3 big ships sitting there and just stuff spewing out of the stacks.
And for
that can't be
I
good.
guess they use the same fuel as other tankers. That stuff, bunker fuel,
Ooh.
and that's like big, thick, gooey.
You don't
They're
want to
like,
be
you know.
in that line of
No, I
mission.
hadn't thought about it, but yeah. So
you were observing this while you were hanging out,
on the beach with a
on the
Balashi
beach,
in my
yeah.
hand. Yeah.
Mhm.
That's how I roll down in Aruba. So, JT, thank you so much. We appreciate that. Scarlett Fu, Paul Sweeney, we're live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube as well. Let's see some stocks on the move this morning. We can do that by checking in with Bloomberg's Matthew Griffin. Matt, what are you looking at these days?
Well, Paul, maybe one that you were just talking about that is worth even digging a little deeper into is Disney, ticker DIS. That stock is now down more than 7% today after the company reported a quarterly beat, but gave that kind of tepid outlook. And maybe the reason that investors are looking so closely at this wording, modest growth in the current quarter for the Parks and Cruises division, is because that division has become the profit engine for Disney. You dig under the hood of that quarterly beat, and the bulk of the profit was delivered by that unit. Barclays says this unit, the attendance there is key to the valuation of the stock. So that's potentially why you have this really strong impact after some of those costs, as well as what the company calls visitation headwinds from international tourists at U.S. parks.
All right, we'll keep an eye on that one. Of course, we're also keeping an eye on whether they announce a successor finally to Bob Iger.
This week, I guess,
it's a long time coming. All right, what's next for you?
Yes, I'm also keeping an eye among decliners today on Coinbase, the crypto exchange. Their shares are down more than 4% following a continued slide in the price of Bitcoin over the weekend to close to the lowest level since President Donald Trump took office. If you look at the business model of a crypto exchange, they generate huge amounts of revenue from crypto trading, of course. And so when the prices slide, that means that each transaction is less valuable. It also means that traders just have a lower incentive to dive into this market. This continues a problem that has plagued Coinbase in recent months. Their shares down, ticker COIN, down 43% in the 3 months ending January. Our colleagues Olga Karif and Monique Malaima have a great story on the Bloomberg about this, and a lot of that related to these falling trading volumes as well.
All right, give me one more here.
If another one I'm looking at, this time in gainers, is MP Materials, ticker MP. They're a producer of rare earth elements, up about 3.5% this morning. On news that the U.S. is set to launch a strategic critical minerals stockpile. This will be called Project Vault, and according to senior White House officials, it will have $12 billion in seed money to stockpile critical minerals. The U.S. has been working to reduce reliance on rare earths and other metals from countries like China. That's given a boost to MP, continuing this morning.
All right, Bloomberg's Matt Griffin, thanks so much. Appreciate that. For more conversations like this, subscribe to our Stock Movers Reports. Listen for 5-minute audio reports on the biggest winners and losers in the stock market. Subscribe to Stock Movers on Apple Podcasts, Spotify, or anywhere you listen. You want my cynical take on the cautious guidance on Disney?
Always.
We can get a new CEO named probably this week. Let's set the bar low for him, number one. Number two, if I'm the new CEO, I'm saying, hey, let's give a cautious guidance, because when I do sign my deal, say Thursday of this week, I'm going to get my options grant. I'd rather have a lower stock price.
Oh, good. Yeah.
Yep.
That makes a lot of sense. And right now they're reporting.
That's exactly how
that is cynical.
That is a cynical Wall Street view. Let's drive the stock down.
And that's probably what most people on Wall Street are expecting as well. So you have to take this cautious outlook with a grain of salt. And of course, we are looking for some kind of announcement. Right now, it looks like the CEO of the Parks Division is kind of on tap to be the new CEO.
Yep. And we talked to Geetha Ranganathan. We'll do that later in this show. And she was pretty positive on this gentleman, this executive. So we'll see how that
Didn't
plays
the
out.
previous CEO who didn't work out also come from the Parks Division?
Yes. But it's the biggest profit generator of the company now. Like when I first started covering Disney, it was maybe 20% of 15% of operating profit. Now it's north of 60% of operating profit. It's not necessarily because that grew so quickly. It's that ESPN and the other cable networks declined so much. Yeah, so it's a little bit different.
But ESPN still throws off a lot of cash. I mean, it is a cash generator.
It does, but just not as much. And it's not a growth story. So we saw Comcast spin off its cable networks. Warner Brothers Discovery is
Trying to do something with
trying to
its.
do something there. And then, so the question for the Walt Disney Company is, do you guys do the same thing?
Right.
Well,
they're trying to monetize best they can with ESPN Plus, but
Yeah,
it's
and their streaming
no
service.
longer the crown jewel of the Disney empire.
yeah, it's, and these, as John Tucker was saying, these cruise ships, they're $1 billion a piece. So I mean, it's, if you're, and they're putting out like 4 or 5 of these over the next number of years. So,
Yeah, absolutely.
it's a big gig. for
If
them.
you take up cruising and you become a cruiser, like you might be doing this in your future with grandkids and stuff.
Exactly. You never know. I could become a cruiser like Charlie Pellet, you know. S&P 36 points higher. The Dow up 300 at 0.6%. The NASDAQ up 167. This is Bloomberg.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. A really good view for manufacturing. ISM blowing away every expectation. So it printed at the highest level since August of 2022. This is an expansionary territory. It's helping lift stocks and also pushing yields higher. I mean, no reason for Fed cuts, evidence here. And the prices paid component largely unchanged in the Institute for Supply Management Manufacturing Index. S&P 500, 38 points higher, up 0.6%. The Dow Jones Industrial Average up 340 points. That's a rise of 0.7%. Providing some of the lift there, Caterpillar shares, they're up over 3%. You have Visa shares up 3%, the Dow, and then Amazon.com. That is up 2.5%, all helping push the Dow higher right now. The NASDAQ 100 up 228 points, and that is a rise of 0.9%. After their earnings report, just discussing that, but Disney shares among the movers, and they are down close to 7%. And then Oracle with its spend on AI infrastructure, more clarity on how they're going to do that. Those share among the most active right now, 2.8% higher. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash. I don't know who to throw back to because you're pointing at each other.
We're pointing. We have no idea. We're just winging it.
You know, Scarlett.
Part of our charm.
Okay. Take it away, Scarlett.
All right. Thank you so much for that Bloomberg Business Flash. We're looking at the first day of trading here in February, and it looks like gains for equities at the moment, the S&P 500 up 0.5%. These are all fairly modest moves, certainly when you compare it to gold, which has traded more and more like a meme stock. Yep. Or a growth stock of late, right? I mean, it's just been all over the place, especially over the past couple of weeks with it soaring and then the tumbling, and now I don't know where we're at. Let's bring in Brian Van Kronkite. He is Senior Portfolio Manager at Allspring Global Investments. Brian, how do you think about the stampede into gold? Because a couple of people have pointed out it's not a good sign for the U.S. economy, for the global growth story, when there are that many people piling into a safe haven like gold.
Hi, good morning. It's good to be with you. Look, gold's gotten a lot of attention, a lot of excitement for good reason. I think there's two things that can drive it, like anything. There's fundamentals, and then there's sentiment. And a lot of the sentiment's been driven by probably a retail trade, probably a FOMO trade. And when that gets to extremes, any small thing can cause it to react like we saw on Friday and over the weekend. And so we need to bifurcate our views. What is fundamental and what is speculation? But the fundamental drivers are still there. There's good reason to understand that not just gold and precious metals, but some of the more industrial metals have higher value and higher purpose going forward, whether it's around dollar concerns and geopolitical concerns, which drive central bank activity, or whether it's around some of the build-outs in technology, defense, that will require more industrial metals. So I think the fundamental reasons supporting precious metals and industrial metals are very strong. I think the speculative top we saw over the course of the last week is a warning sign not to be chasing these things, but rather to be investing in these opportunities longer term.
Brian, in the equity space here, I think kind of very late October, early November last year, we actually began to see a little bit of a rotation, maybe out of some of the big tech sectors, maybe getting some broadening out here into some other more value-oriented sectors, maybe even small and mid-cap stocks. Are you guys seeing that? Are you participating in that? How are you playing that?
Yeah, we absolutely are seeing it. We drew that line in the sand October 15th, right around the time when Oracle stock began to fade, the CDS spreads there began to widen. There was a lot more uncertainty around what was happening with the AI build-out, and that was the moment we went from what I thought of lower quality, a little bit more speculative market where we had non-earners, we had lower ROIC companies, especially down cap in the small cap and mid cap universe. That was driving the market for the 6 months off the April lows. October 15th, things began to change. The character began to change, and we're seeing things like earnings quality factor go from underperforming to outperforming. And so that's going to be really supportive of fundamental managers like ourselves who are looking for companies that possess competitive advantages, demonstrate profitability, and can grow in the future by investing their capital wisely. And so that shift is happening. We think it will be one of the main drivers of returns in 2026 and truly differentiate what I would call more fundamental active managers from what was really a more speculative beta rally driven off the bottom off of April 8th through October 15th.
I'm so glad you bring up that idea about what's happening with the AI build-out, because Oracle is planning to sell up to $25 billion of investment-grade credit, and we know that this year hundreds of billions of dollars of issuance are projected. Credit investors, Brian, like to say credit leads the other asset classes. I wonder if that's how you think about it as we continue to see these AI-related companies tap the debt market to fund their big projects. And the stock market has already started to discern between different aspects of the AI trade. Are credit spreads and CDS prices, is that going to be the determinant for how equity investors kind of think about things?
Well, I hope so. Let me rephrase your point about how credit markets drive things. I've always believed, and our team invests behind the idea that balance sheets lead income statements. And so you first need to fund your balance sheet either through cash flow or through credit markets. But how you choose to use that will determine your future income statement, your revenue growth profile, your margin profile, your earnings per share profile. And so we are absolutely focused on how companies use that capital to create future value. And that's why the market's getting uncertain about certain elements of this build out, the circular financing concerns. Because they want to understand and be confident that one, you can access capital, but two, that you're going to use that capital wisely and create high ROEs and high ROICs off of that. And some of the ideas around these bookings and these big backlog numbers, that sounds great, but then you got to go and make it real. And it felt like for a minute there, and maybe we still are seeing it, that these larger cap companies felt like they were on a Shark Tank episode where they're announcing big agreements and they're shaking hands, but the real work hasn't been done yet. Can they actually go out there and close those deals? Can they get the financing? And so Oracle being able to go out and raise money is a positive sign. It shows they're getting to the next level, but there's more companies that need to do that. But at the end of the day, what we need to see happen are these companies use that capital wisely and demonstrate that it's leading to growth in revenue, growth in margin, and growth in earnings, and that will drive the winners and losers going forward.
Let's talk individual names. Teradyne, what does Teradyne do, and why do you guys like it?
So Teradyne does test and packaging for semiconductors, and historically they were a key leader in semis that were in the consumer handsets, the PCs, autos, industrials, and that we've seen a bunch of cyclical or rolling recessions for that category, and some of the income statement impacts were pretty negative for them on a relative basis. And right in the heart of it all, in Q1 of this year, they started talking about big investments to get in front of this GPU, TPU TAM. And that was the opportunity for us to say, hey, they're using their balance sheet wisely, they're investing their capital to move into a big opportunity while we still have the legacy business that's going to recover over time. And so as we produce more and more semis, as we go through a refresh cycle for everything electronic, which we'll need to do, if we're gonna go from a cognitive AI build out to a kinetic or a physical AI utilization, we're gonna update a lot of things, and we're gonna need more of what Teradyne does. So that's an important part of it. We're going to get into earnings tonight with Teradyne. I wouldn't be surprised if we saw the stock move back a little bit or have a little bit of a moment of reprieve. But longer term, we want to own this business because we think they're going to be a key contributor and a key beneficiary of the semiconductor manufacturing expansion phase that's going to happen over the course of the next 18 to 24 months.
All right.
Yeah, been a winner. Boy, this thing's more than doubled over the last year.
It's worked out pretty well. Yep. Brian Van Conkrite is Senior Portfolio Manager at Allspring Global Investments. Thank you so much. You look at commodities today. I mentioned gold, how it's been all over the place. It's now currently down about 0.9%. But the big mover in commodities right now, oil. Oil prices down more than 4%, almost 5%, with Brent just above $66 a barrel and WTI at $62 a barrel. Let's bring in Mike McGlone. He is our senior commodity strategist for Bloomberg Intelligence, joining us from Miami. Mike, when it comes to oil plunging, there are some easing geopolitical risks that are kind of forming the backdrop. But I wonder how much of this has to do with a broader commodity sell-off that we see in gold, in silver, in copper, and now in oil.
Well, I think you nailed it, Scarlett, and I'm glad you started with oil. The problem with oil is it ended Friday, WTI, around $65. 65 was basically last year's almost median mode, and it was a down year. It's a bear market. It's oversupplied, and oil traders love when it bounces on potential supply disruptions in the Middle East, even though the price maker has shifted to the Western Hemisphere, led by the U.S., and I think it's just part of that bear market to head lower. So oil might have peaked for the year. Unless there's some kind of supply disruption, you got to get to that low price cure typically to offset the excesses of supply and demand. So that's a bear market that's bounced, rolled over. Copper is a bear market, but it's a bull market. It's bounced. It looks like it's rolling over. Now the metals, silver, most notably the devil's metals, looks like it might have put in a peak for decades. It's just how it works. The point is when prices shoot up this much exponentially, everybody focuses on the fundamentals, they shift, supply comes on, demand declines, and the price usually peaks for a while.
All right, so we had this, in addition, we had this huge run up in the last several weeks and months, and then obviously a big pullback on Friday, continuing today here. How do these markets typically trade in the precious metals space, Mike, after a multi-week run up?
Well, that's the key thing about this one, Paul. The typical is, if you look at any type of historical precedents, the only time we've gone this high in, let's say, precious metals relative to like a 60-month moving average was the peak in 1979 and 80, and those highs lasted for decades. The key thing about silver is just last week it got to the highest ever versus copper and crude oil. So I think we're putting in peaks forever. Now, you know, I like how you've reminded me in the past I've been long and bullish gold forever. No more. I think that market's done and over. I think all the metals have peaked. And the key thing that I'm really worried about is you've seen all this volatility in commodities and precious metals and cryptos, yet volatility in the stock market's so subdued. To me, that's the biggest risk as we go into the rest of the year, is volatility in the stock market just kind of normalizes a little bit. It's just way too low.
So if you think we've seen the peak in these precious metals prices, it goes downhill from here, or we're going to see big swings that will eventually take us down? I'm just wondering how it all shakes out.
You got to make it as painful as possible, typically, Scarlett. So I think, let's look at gold. Probably stuck between 4,000 and 5,000 for an elongated period. I don't think you're going to see silver be able to sustain above $100 an ounce, and easily goes back to 50. That's the old highs. And then you look at things like copper. There's really not a lot of demand potential from China, yet copper's been going up. It got to around 620 this year. Right now it's around 580. I think 6 is pretty good resistance. And the bottom line for all these kind of commodities, most notably anything but gold, because they're all industrial, is that S&P 500 probably has to stay above $7,000, or they're all going to go down. And that's the key thing, is there's so much predictive volatility that hasn't trickled over yet. That's what we have to worry about. And that's why I think in terms of commodities, we probably reached peaks already. And that oftentimes happens in January. You get too much enthusiasm, you put in highs, and then you roll over.
Just before we let you go, 30 seconds on oil here, Mike. We've got WTI crude oil off about 4.5% here today.
I think this year you're going to see a 40 handle. And Paul, and I think you're probably going to see the average price of gasoline drop towards 2. Also, remember, midterms are coming up. What does President Trump need? He needs lower yields, lower energy prices, lower inflation.
And higher stock market prices.
Yes.
Let's not forget about that one. Mike McGlone, thank you so much. Mike McGlone is our senior commodity strategist with Bloomberg Intelligence, joining us from Miami. Pretty remarkable, this move into precious metals. And yes, a lot of it is driven by Chinese speculators who may be sitting this one out right now, or getting squeezed at the moment. But there has been this overall fundamental drive into gold through ETFs, through central bank buying. Tether, a big buyer of gold as well. These crypto companies broadening out their bases as well.
Yep, absolutely. We'll keep an eye on all that market movement here. Again, gold trading off by another 4% here today, $4,684 per ounce there. We'll keep an eye on that. Bitcoin getting a lift here, up 3%, 2.8%. Still $78,000 print. Weren't we just well north of 100 several weeks ago?
October.
Yeah, absolutely. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with his Bloomberg Business Flash. Stocks and yields pushing higher after the latest manufacturing index. This is from the ISM, indicating expansion in manufacturing. You have information technology best performing of the 11 major industry groups in the S&P 500, and that's home to SanDisk. Look at this puppy, up over 14%. The price target raised by analysts at Barclays from $385 a share to $750. Right now, energy, the worst performing of the major industry groups. That's because you have oil prices. They are pushing lower. WTI, this is American crude, down close to 5%. This all tumbling after President said Washington is talking with Iran. Tesla's European sales slump carried over into the new year. Registrations plummeting in two of the region's leading markets for battery electric cars. French sales, they fell 42% last month, just 661 cars. Norway registrations plunged 88%. Demand for Tesla slumping across much of the continent, in part reflecting backlash against Elon Musk. They're also facing more competition, in particular from China. Meantime, Elon Musk moving quickly to consolidate his empire. We're learning that SpaceX said to be in advanced talks to combine with XAI. They could announce an agreement as soon as this week. SpaceX has also discussed the feasibility of a tie-up with Tesla. Tesla shares right now down to just about 2%. Overall, S&P 500 up 36, the Dow up 395 points, and the NASDAQ up 166 points. You see this one from the New York Post? The hedge fund manager who's been sued by his own mother.
Yeah, I knew this dude back in the day.
Back in the day. Well, he's being sued by mom for an unpaid mortgage he took out on her house. He declared himself bankrupt. This is Jason Ader, the former activist investor. A decade earlier, he usually appeared a lot on CNBC. You'd see him. He helped unseat Marissa Mayer as the CEO of Yahoo. He's filed for personal bankruptcy. Says he owes roughly $2 million in debts and admitted in court filings in a court-ordered call with the creditors last week. He also listed as his assets over $200,000 and along with two of his hamsters or guinea pigs.
Guinea pigs, okay.
Pardon me.
That's a difference.
Yeah, that really does make a difference to the bottom line. We check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash, Paul and Scarlett.
All right. Thank you so much, John Tucker. I'm going to be reading this New York Post article. It's a long one.
Yeah, it's a good one.
Yeah, and also has,
It's like you got to slow down and take a look at this one.
He has separate companies that owns the apartment that he currently lives in. So there's lots of different things to kind of parse through
But
here.
I knew him when he was a top gaming analyst, covered all the casino companies when he worked at Bear Stearns back in the 90s.
So he would get you hooked up with CEOs
All the management, yeah, he was good.
All right, well, check it out. Jason Ader, going through some financial issues at the moment. Let's talk about the media companies because Disney has just reported results, and the company reported record revenue in the last quarter, which jumped 6% to a record $10 billion. But its outlook for this quarter, not so great. Geetha Ranganathan is our U.S. media analyst here at Bloomberg Intelligence. And Geetha, how do you square this idea that the forecast it's given is kind of tepid, saying that it expects international tourists to perhaps not show up at its different parks when revenue did very well and the quarter ended? Is this a case of Disney lowering expectations for a new CEO that it plans to name pretty soon?
Could very well be, Scarlett. I mean, this is your classic case of, when good is, not good enough, I guess. But yeah, they absolutely, I think, performed very well in the quarter that they just reported. They have been citing some headwinds when it comes to international visitation at domestic parks, but I think they are, as you just mentioned, setting the bar a little bit lower. not coming out, not raising guidance for the full year, even though they had a really strong fiscal first quarter. Remember, we do expect, I mean, we think that there will be a lot of international visitation this year just because of the World Cup. And, you know, who knows, maybe there could be some tailwinds there for Disney too. But other than that, if you just look across the board, I mean, you look at the parks overall, yes, there has been some slowdown in attendance here and there, but they are undertaking investments across the board. So even in this quarter alone, we're going to see this big opening of World of Frozen, which will almost double the size of Disneyland Paris. That's a huge investment. Again, yeah, we're going to see some pre-opening costs, which is why we're seeing that tepid outlook in the fiscal second quarter. But I think if you look at the long-term thesis, that is still very, very much intact, Scarlett.
And Geetha, looks like we're going to get a new CEO for Disney. Tell us how that may take place and who this person may be.
Yeah, so there have been, you know, two front runners for the job, Paul. It's been internal candidates, Josh D'Amaro, who heads the Parks division, and Dana Walden, who came to Disney from Fox and who heads up all of content. Now, as you know, Dana Walden, she has a huge presence in Hollywood. I mean, stars absolutely love her. She's got a great presence within the creative community. But I think, you know, there has been obviously rumors that Josh D'Amaro is in the leading position right now. And I think that just really reflects how the company's, you know, earnings position has completely changed. I mean, a few years ago, as you just pointed out, you know, a while ago, this was really a TV networks company, and that has completely changed now with this being really the biggest theme park operator in the world, attracting about 150 million global visitors each year, and only poised to get stronger and stronger. So they're already making about 60% of company profits comes from just the theme parks division alone. And as we kind of look forward, Paul, I mean, you look at all of the new cruise ships, they're planning to basically double, triple capacity in the next 3 to 4 years. You look at all of the park expansions, you know, park profit could very well be 3/4 of, you know, total company profits in the next few years' time.
What is your confidence, Geetha, that they're going to get the succession right this time around? Because not so long ago, they appointed Bob Chapek, who also headed up the Parks division, to succeed Bob Iger. And that lasted for no more than a year, was it? I don't know, whatever it was, it didn't last very long. Bob Iger ended up coming back. Why is it different this time around?
I think it's different this time around because the company is in, you know, I think they finally got their priorities straight. I think at that point, Disney was really trying to still figure out what it was. Was it a TV network company? Was it a Disney Plus streaming company? Was it really a theme parks company? Was it a film studio? So I think there were just so many different, you know, they had so many different balls up in the air. But I think right now, and streaming, obviously, they were kind of in the early innings of streaming, chasing subscribers at all costs. And that's the game that kind of Bob Chapek played, but didn't play very well because he was not very, you know, obviously not very well versed with the content part of the business, ended up really overpaying in terms of content costs. We saw Disney pay something like $32 billion in content costs, which led to about, I think, $4 billion in losses for the streaming unit alone. They've come down from $32 billion in content costs to $23 billion under Bob Iger. So that was a lot of, you know, the right sizing of costs, really righting the ship, you know, course correction, all of that happened. So I think definitely the company is in much, much better shape right now. And again, this is now, I think people who were kind of underappreciating the theme park portion of the business now really look at this as mainly a parks company. And yes, they do have streaming, and yes, we can see some upside from streaming and films, but this is really a theme park operator.
Oftentimes when the board picks a CEO, the person who did not get the role leaves the company. What's the risk here that Dana Walden, again, as you mentioned, so widely respected and important, that she would leave the Walt Disney Company?
Yeah, definitely possible. But they do have a deep bench. I mean, along with Dana Walden, Alan Bergman also heads, you know, the content. So he's been overseeing some of the film and TV businesses as well. So, you know, obviously there is the risk of her leaving, but at the same time, I think they do have a deep bench that could, you know, fill her shoes, hopefully.
All right, Geetha, thanks so much. Appreciate it as always. Geetha Ranganathan, she covers all the media companies for Bloomberg Intelligence. Disney put up some solid numbers this morning, had the conference call. The stock's trading off by about 5.8% here today, reflecting maybe some tepid guidance here. Who knows if that's tied to the naming of a new CEO, which could come as soon as this week. The board is meeting this week. That has been reported. So it's a question of will they come to a decision and when will they be ready to announce it?
Right. Just for background, in 2020, when Bob Iger stepped down the first time, Bob Chapek was announced as the CEO about 2 weeks before that shareholder meeting. So, you know, we could be waiting until March, but, you know, I think this is something that they want to definitely telegraph sooner rather than later.
I think so. And this, you know, hopefully it could go better this time because it's been 10 years the succession drama has played out for the Walt Disney Company. You just don't see that very often. This is Bloomberg.
This is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio.
All right, Scarlett Fu, Paul Sweeney live here in our Bloomberg Interactive Broker Studio in New York City, streaming live on YouTube as well. Head over to youtube.com, search Bloomberg Podcast, and that's where you'll find us. The big global pharma companies reporting earnings. We got a couple down, a couple more to go. Sam Fazeli joins us. He's the Director of Research for Global Industries. Have no idea what that means. I know him as the Senior Pharmaceuticals Analyst at Bloomberg Intelligence. He's over there in London ostensibly, but he's always traveling around the world, you know, checking out all the latest drugs and that kind of stuff. That's how those folks get smart. Hey, Sam, Sanofi, Roche, I know I'm pronouncing it incorrectly. They reported some results here. What did you see from some of those big pharma companies?
Yeah, thanks, Paul. I think the most interesting of the everything so far, that there are three companies, so Sanofi, Roche, and Johnson & Johnson, who've reported so far, was the fact that nobody really seemed to be saying much about. I mean, people ask about MFN and the impact of MFN, but numbers were in line and growth is as expected. So somehow these companies are managing it. I mean, you know, we're going to have to wait and see what happens to the European countries, drug sales, etc., as they come on. But no, nothing in there. And the one thing that specifically stood out in the we talked about Johnson & Johnson last time, was Sanofi, where they called out the vaccine sales in the US. Remember, they sell traditional vaccines, not mRNA. So it's not like it could be something that people don't like. And they're still calling for a down year in 2026, which is interesting, in that we have another company, Moderna, that does make mRNA vaccines, and they're saying that they're looking for an up year in 2026. So there's some differences there that I think we need to be ironed out between the companies, and and it's not a good thing that we're seeing less vaccine use in the U.S.
Right. We need to figure out if this is a company-specific issue or something that tells us about the take-up in the U.S. Can they make up, these vaccine makers, can they make up that potential loss of business in the U.S. in other parts of the world?
Well, that's the thought potentially for Moderna. I mean, Sanofi, the volume of vaccines that are sold the rest of the world, the prices are not anywhere near as strong as they are in the U.S., so they can maybe work on the margins. But I think there's vaccine hesitancy across the board. I mean, why do we have quite a few European countries who've lost their measles elimination status too? Not just a U.S. problem.
Sam, this most favored nations status that President Trump is talking about, what are the companies saying? Are they saying, hey, this is real, this is going to happen? And are they quantifying the potential costs? Where are we in that whole process?
I mean, the cost is potentially coming from them repatriating or moving some more investments into the U.S. What exactly that number is, time will show. A lot of these companies give big numbers, 50 billion, 55 billion over the next 5 years, but that includes their standard R&D, a lot of which is actually already spent in the U.S. So what that incremental increase of manufacturing, et cetera, in the U.S. is, I don't know. And I think you might have seen in numbers recently that came out, manufacturing headcount isn't going up. In fact, it shrunk. So unless pharma is such a small part of the overall manufacturing numbers, but coming to the latest numbers that we saw that came out last week, it didn't go up. So something's not quite working out here. And maybe it's just going to take a year, 2 years before these sites are operational, before we see those numbers go up.
Yeah, it feels like there's a lot of room to be vague in those big commitments, right? We know this administration likes big numbers. So if you can kind of include everything under the sun, all the better. So let's talk a little bit, Sam, about Eli Lilly, which will be reporting earnings in 2 days on Wednesday. The outlook right now is for a pretty broad guidance for the full year. Walk us through the different things that Eli Lilly needs to contend with as it offers up guidance.
Yeah, it's not, by the way, it's not just Lilly. Both Lilly and Novo are reporting on the same day. That makes it more fun for us. In fact, Wednesday is an awful day for large pharma reporting.
Or fun,
if I'm not wrong, it's 6, 7. Well, awful in terms of you need everybody on the desk to be listening to these calls. So, I mean, there's a few things that we're looking for both of them, frankly. And remember, Novo is the first one that's launched a oral drug that's out there, oral Wegovy. And the prescription volumes for that you can check out on the terminal are going one of the strongest obesity launches that we've had in, I think maybe even ever. So that's looking pretty strong. Therefore, timing of orforglipron that's coming from Lilly, I think that's expected in 2Q, maybe a little update on that. When exactly in 2Q, everyone wants to know. Early 2Q is the current date. We're also looking to see how these deals that they've done with slightly lower prices, you might have seen those with the Medicare prices, etc. Are they beginning to show an increased volume? The theory is if price comes down, volume should go up, right? Because this is an insatiable market. And then lastly, one of the tough things to keep an eye on is ex-US. We have prescription data for US pharmacies, but ex-US is much harder to follow. So people are going to be looking to see how these obesity drugs are doing outside of the United States. That's the key thing.
All right, Sam, great stuff as always. Sam Fazeli, folks, Director of Research for Global Industries and Senior Pharma Analyst. He's one of the best out there. He's been doing it for decades, covering big pharma companies, the biotech. He understands the science behind it, which you have to do. That's why he got a PhD in something I have no idea, but it's science related. And that's why he is one of the best. Yes, that's got to be like a semester in and of itself when you go to get these PhD programs, how to pronounce all these names. So just getting a lowdown on the big pharma and the biotech space here. Looking at the markets, we have some green on this screen here. The S&P up about 0.4%. For our listeners in the U.S., a reminder, you can listen to us via satellite radio on Sirius XM Channel 121. Access the world's only global audio business network, coast to coast, 24 hours a day. Bloomberg Radio on Sirius XM Channel 121 is presented by Golden Crest Metals. Stay tuned for the latest market news and industry research. The next hour of Bloomberg Intelligence starts in just moments. We've got green on the screen. Let's take a look at the gold. Gold off $275. That's 5.6%. $4,600 an ounce for gold.
This is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney.
Concern about rising prices spooking investors.
What does renewables investment look like in the U.S.?
More tariff talk coming out of this administration.
Breaking market headlines and corporate news from across the globe.
The president wants lower interest rates. He wants a rate cut cycle.
How do you broaden out the AI play?
Are people just looking for something to worry about when it comes to China?
Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio, YouTube, and Bloomberg Originals.
Good Monday morning, good first trading day of February. This is Bloomberg Intelligence with Paul Sweeney and Scarlett Fu, broadcasting live from the Bloomberg Interactive Broker Studio, streaming live on YouTube. On our agenda today, we have a sell-off in commodities, precious metals, industrial metals, oil, a government mineral stockpile that the president wants to put in place, and of course, earnings. So we're going to check in with Joe Doe. He's our economic statecraft reporter on this president's $12 billion mineral stockpile that he has planned. Dennis Lockhart, he is the former Atlanta Fed president, will be joining us as well to discuss President Trump's new pick for the Fed chair, Kevin Warsh. And James Abate, he is managing director and head of fundamental strategies at Horizon Investments, will join us to give us his take on the markets. Nathan Dean, our senior policy analyst, will be joining us to talk about a funding deal passing the Senate, even as a short U.S. shutdown looms. We'll see if they can get that squared away pretty quickly. First, though, let's bring in Charlie Pella for our Bloomberg Business Flash. Hi, Charlie.
Thank you very much. Well, good morning. Lots going on today, and we got you covered here at Bloomberg. The Dow, the S&P, NASDAQ all pushing higher now, with the S&P up 28.69.67. That is a gain of 0.4% as we kick off the trading month of February with an advance for the U.S. equity market. Also this morning, solid factory data bolstering optimism about corporate America. Losses in gold and silver, however, are continuing. S&P right now up 0.4%. We're holding close to session highs, with the Dow up 415, up 0.9, and NASDAQ, meanwhile, up 108 for the NASDAQ Composite Index. That is a gain of 0.5%. The Russell 2000 Index back to outperforming compared to the S&P, up 1.1%. Again, the S&P up 0.4, but the Bloomberg Mag 7 Index down 0.2%. 10-year 4.27%, with the 2-year 3.56%. Gold now down 5.8%. More correctly, down another 5.8%, 46.12 where we stand. Silver, what a ride there, 75.88 the ounce, 75.88 on silver, down 11% now. Brent crude down 4.7%, 66.06 a barrel, and West Texas Intermediate crude down 4.9%, 62.01. Bottom line here, stocks pushing higher. Shares of the Walt Disney Company are gaining after earnings. Disney did report sales and profit that beat estimates. Actually, they're lower. We've got Disney concerns about the outlook there. The Walt Disney Company now down by 4.8%. A whole lot on the markets coming up in just a moment with our Norma Melinda. So again, recapping here, S&P up 27, up 0.4, but the key takeaway, gold, silver falling, Disney falling as well, down 4.8%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Yeah, try that silver. Just wow. I mean, 34% just in the last couple of days. It's just extraordinary there.
It's unbelievable. Briefly, can I tell you my silver story?
Go.
Back in the 80s, and we could probably go back on the Bloomberg, I picked up an ounce of silver for $5. But you guys are market savvy. When you see gold and silver surging, as we saw just a couple of weeks ago, I had this ounce of silver that I've been lugging around forever, right? It's an ounce. How does one unload a single ounce of silver? What do you do? right? I went. So
You went to the Diamond District.
No, that is probably what I should have done. However, I went to a pawn shop and said, "What will you give me?" Now, initially, this is when silver was at 110. They would give me 10 below spot. What would they give me? Wound up being roughly $86 the ounce. I felt ripped off at the time, but I had no alternative. But you look at where silver is now. Yeah. I'm a genius. 78. It's unbelievable. So I'm very happy with that trade.
Yeah, you got the Hunt brothers, and you got Charlie Pellet in this
well done, Charlie.
market. Very good. All right, let's take, we got Scarlett Field and Paul Sweeney live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube as well. Let's take a look at some of the stocks on the move today. We can do that with Bloomberg's Nora Melinda. Nora, what are you looking at?
Well, let's take a look at Tyson Foods. This is ticker TSN. We're seeing shares that were earlier lower, down as much as 3.8% for their worst day since May, but we are seeing a reversal. Shares up about 0.8% right now. This is after the company's first quarter profits benefited from higher beef pricing as well as healthy chicken demand. So we did have the beef business reporting $143 million adjusted operating loss in the quarter, but the chicken segment continued to see year-over-year growth. So clearly it's trickling out well for the street.
You just had to make more chickens.
Exactly. That's what it seems like.
I said that like a year and a half, 2 years ago. It worked. Now it's not working with the beef prices. It takes a while to make more cows. I understand.
Yeah.
I was talking to some ranchers and he said, your thing's not going to work.
The cycle is a lot longer,
Yes.
right?
Yeah.
I mean, I moved my mic because I was trying to gesticulate with my hands just how long it can take.
Make more cows. Get the ranchers out
More
there.
of the story.
All right, what else?
Also looking at shares of Disney, this is ticker DIS. We're seeing shares lower by about 4.7% right now as we speak. This is all about the outlook that a lot of analysts and investors are scrutinizing. They're seeing the outlook as tepid, especially as we know that the company is still preparing to for a new CEO. So we're also seeing that Disney is expecting challenges attracting international tourists to its domestic parks in this second quarter. But it also did warn of ongoing increased costs for sports rights. So clearly all of this is really weighing on shares. So we're seeing Barclays also saying that the key to valuation recovery will be attendance recovery in parks and operating leverage for streaming. So we are seeing shares slumping as much as 8%, now pairing a bit, but earlier dropping for its lowest level since November.
All right,
I'm sticking with my kitchen sink strategy, which is just dumping everything before they name the new CEO.
Right, low bar.
Low the bar for the new CEO.
And you know, it's a clean slate.
Yep.
And then he kind of sets the agenda. He sets the tone.
The
going forward.
Yep.
All right, last one.
Last stop, looking at shares of Oracle, ticker ORCL. We're seeing shares up by about 2.4%. This is after the news that the company plans to raise as much as $50 billion this year to build out cloud infrastructure capacity. So you're certainly seeing Wall Street rallying behind this stock. I mean, if you take a look at year-to-date, though, we are seeing shares down by about 14%. But in terms of today, we are seeing the stock in the green.
All right, good stuff. Thank you so much, Nora Melinda, Bloomberg Television Markets correspondent. And for more conversations like this, subscribe to our Stock Movers Reports. Listen for 5-minute audio reports on the biggest winners and losers in the stock market. Subscribe to Stock Movers on Apple Podcasts, Spotify, or anywhere you listen. The president is on a mission. He is now looking to build a minerals stockpile, Paul. This is on top of, you know, we already have the strategic oil reserve.
Yep.
But this is so that U.S. companies don't run out of ways to make sure that they have access to crucial minerals.
Okay, that makes sense. Project Vault, right?
Project Vault. So let's bring in Joe Doe. He is our economic statecraft reporter on this developing story. Joe, what can you tell us about Project Vault? What do we know? What do we not know?
What we know is that the administration is looking to launch a private sector critical minerals stockpile or strategic stockpile that would have rare earths, other critical minerals, or at least critical in the eyes of the United States government, that could be on hand in the case of a national emergency for private sector companies. Some of the OEMs that are partnered with this, according to the reporting that we have out today, include Stellantis, GM, Boeing, just to give listeners an example of the types of companies that in the case of an emergency would need things like gallium, things like cobalt. And I think an important thing to note is this is different from the strategic stockpile that is maintained by the Defense Department for defense purposes.
Joe, $12 billion seems like a big number to me. Is it big? Will it do anything material in terms of this broader critical minerals market?
You know, in the course of just the conversations that I've had, it does sound like a big number, but listen, I've covered metals for over a decade at Bloomberg, and there are a number of people telling me, you know, that $12 billion will get spent fairly quickly. Again, it depends on how large the stockpile is. It also depends on like which minerals they're going to really target. Is it going to be a bunch of rare earths like dysprosium, or is it going to include the more major metals like copper or lithium, or something a little bit less major but still more major than a rare earth like cobalt? So these are, to your point just a moment ago, like what do we not know? Those are really critical things that at this stage we don't know.
Yeah, so some big gaping questions, but the headline certainly is there, $12 billion. One thing I learned from your reporting, Joe, is that the U.S. already operates a national stockpile of critical minerals to serve the defense industrial base. How different would a stockpile for civilian needs be?
So I think the main thing is it would be in the event of a national emergency, right? And I think that's kind of an important part here. So it would be like if suddenly the automotive industry had learned that there were some sort of supply shortage or export controls, for example. Export controls, something we've discussed quite a bit over the past year, on materials they need to make electric motors or other equipment inside an automobile. They would be able to go to the stockpile and say, listen, Project Volt, we need to buy these specific materials from you right now because there's a shortage of them and we need them to keep operations functioning. That's an example of how this might work. Instead of like the Pentagon coming in and saying there's a shortage of materials in the event of a war or something like that and saying we need to tap the strategic stockpile. It's been in place under the Pentagon now for ages. This would be specific to private sector companies coming in and saying, we've got a problem. We don't want to shut down plants in the United States, and we need the stockpile of the raw materials that you have right now to keep them open.
All right, Joe, thanks so much for joining us. Appreciate it. As always, Joe Doe, he's economic statecraft reporter on President Trump about to launch a strategic critical mineral stockpile. Going to see that with $12 billion. So we're off and running there. So we'll keep an eye on that, how that plays out. But then some significant money, it sounds like, certainly to start off. Let's get back to Fed talk. That was certainly the topic last week. President Donald Trump naming Kevin Warsh to be the next chair of the Federal Reserve, succeeding Jerome Powell when his term ends. I'm going to get some more thoughts on this. We can do that with Dennis Lockhart, former Atlanta Fed president, joining us via Zoom from Atlanta. Dennis, thanks for joining us here. What did you think of the appointment of Mr. Warsh by President Trump?
I think he's an excellent nominee. He'll be a fine chair if confirmed. He really checks off all the boxes, I think. He's got policymaking experience, particularly experience during the great financial crisis of 2008, which I think is invaluable. Very good experience at the Fed. He knows how the Fed works internally and will be able to navigate that institution's internal pressures and such. He's got Wall Street experience, financial markets experience, even a touch of academic experience, having taught at Stanford and being associated with people at the Hoover Institute. So I think he's just got an excellent background, and I'm confident he's going to be a good chair.
At the same time, I think about his previous stances, and for most of his career, he sounded more like an inflation hawk. Certainly, right after the financial crisis, he was definitely talking a lot about the prospect of inflation. His tune has changed a bit here. Certainly, economic conditions have changed as well. What is your confidence in his dovishness right now when it comes to inflation?
Well, I think you're pointing out that his long-term image or profile is that of somewhat hawkish, both regarding rates and also the use of the balance sheet. At the same time, in recent years, he has aligned himself a bit more with the Trump administration and the White House. So it does raise the question of which Kevin Warsh is going to show up in May. and I really can't tell. I think he understands that the policy-making decisions are based on data, and I think he'll make his decisions based on his assessment of where the economy is and where it's going. He's not an ideologue. I think he's very pragmatic. So I'm not sure we can imagine in advance exactly what positions he's going to take.
Dennis, what do you think Jerome Powell will do once his term ends? Most Fed chairs, they kind of ride off into the sunset, but he has the opportunity to stay. Any idea what he might do?
I really don't. My best guess is that he will leave on schedule. I think he'll probably, once Kevin Warsh is confirmed, which is, by the way, a problematic process now, because, but let's assume for the moment that Kevin Warsh is confirmed. I think they'll have a number of conversations, and I think that will probably lead Powell to be confident that he can leave as scheduled. But I really don't know. There are reasons if the Department of Justice case or investigation continues, why I could imagine he might want to stay around. If he's concerned about Fed independence, then he may stay around. So my short answer is I don't really know. He deserves a rest, however. He's been under tremendous pressure.
How do you expect Kevin Warsh to sound if he does make any comments about monetary policy between now and when his confirmation hearing takes place? What's the message that you think he will be trying to deliver?
Well, I do think he will try to reassure those who are concerned about Fed independence, and he'll do that delicately, obviously, because if you're too strident about that, it's going to really be in the face of the president and the White House. At the same time, I think he'll probably repeat some of what he said, where he has a belief that partly because of structural changes in the economy, the advent of AI and such, that rates can go lower. And that will be music to the ears of the White House.
Dennis, what do you think the data is telling this Fed Reserve right now about interest rates?
I think the data are saying that it's a good idea to wait for a while and see how the economy evolves, see if there is a negative breakout either in employment or in inflation, and then react to that. I don't think the data call for any near-term action.
So is your call for no change to interest rates until June, perhaps? I mean, if Kevin Warsh gets confirmed, he probably would start around June.
That's right. I think that's a very plausible forecast for policy, that we won't see any further rate cuts through the end of Powell's tenure in the position, and the earliest would be this summer.
Very good. Dennis, thanks so much for joining us. Always appreciate getting a few minutes of your time. That's Dennis Lockhart, former Atlanta Fed president, joining us from Atlanta via that Zoom thing. So we'll see how that plays out. Again, we'll hear that confirmation hearing. It's going to be, I'm not sure what the timing is with that, because, I mean, Senator Tom Tillis has said, we're not doing anything on this confirmation
until
list.
the DOJ criminal complaint against a
so I
Fed
guess
chair
at
right
some
now
point,
is solved.
You know, to the extent President Trump wants to drop it, I guess it's a phone call, and then it would be dropped. I don't know how that plays out. I don't know the timing, but it sounds like it
All
might
good
be
questions.
it might be a little sticky there over the next several days. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 11:21 on Wall Street. We do check markets all day long here at Bloomberg. Stocks higher in this Bloomberg Business Flash is brought to you by Gold and Crest Metals. Inflation, tariffs, and volatility have some investors turning to gold for stability. To get a free gold and silver info guide and learn how to add metals to your IRA or 401k tax and penalty free, go to goldencrestmetals.com/guide. That's goldencrestmetals.com/guide. Wall Street kicking off the trading month of February. Groundhog Day, the Dow, the S&P, NASDAQ, all advancing. S&P right now up 36 at 69.75. Solid factory data bolstering optimism about corporate America. S&P right now up by about 0.5%. We got the Dow up 446, up by 0.9, and NASDAQ higher by 0.6%. On an update from much of the market, the Mag 7 index now down by 0.1%. Russell 2000 index cannot ignore that move today, outperforming again, up 1.2%. 10-year 4.27%. Gold down 3.9%, 47.02 the ounce. Silver with a $79 handle now, down 7.1%. And West Texas Intermediate crude 61.89 a barrel, down by 5.9%. Well, Wall Street continues to digest the Kevin Warsh nomination for Fed Chair. Dennis Lockhart is a former president of the Atlanta Fed. He was a guest moments ago, right here on Bloomberg Intelligence.
His long-term image or profile is that of somewhat hawkish, both regarding rates and also the use of the balance sheet. At the same time, in recent years, he has aligned himself a bit more with the Trump administration and the White House. So it does raise the question of which Kevin Warsh is going to show up in May.
Dennis Lockhart, formerly of the Atlanta Fed, now CEO of Navigation Capital, again recapping S&P up 0.5. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie Pellet, thank you so much. We appreciate that. Scarlett Fu and Paul Sweeney live here in our Bloomberg Interactive Broker studio and streaming live on YouTube as well. Looking at the EA function for the S&P 500, that is earnings analysis. About 170 companies out of the S&P 500 have reported earnings here. So making our way. It's another busy week here coming up this week as well. James Abate joins us, Managing Director and Head of Fundamental Strategies at Horizon Investments. James, what have you made so far of this earnings season, and what do you think this market really needs to see from corporate America in terms of earnings to keep this thing going?
Well, I think if you look at earnings results thus far, I'd have to say they're quite positive. The one industry where we have nearly a complete picture so far is banking, and uniformly, we see healthy net interest margins and contained credit exposure. In other areas, those where there's been maybe a multi-year slowdown and even Q4 was somewhat soft, we see companies in those basic industries like packaging, steel, et cetera, talking about the start of this year being much improved. I mean, relatedly today, we saw the ISM Manufacturing Index turning positive at 52.6. That's its highest reading since August 2022, and that confirms to us this trend of improvement in outlook. Moreover, our thesis for 2026 was that we'll see the potential from what we were calling coiled operating leverage be the catalyst for earnings to explode higher on any semblance of cyclical growth, allowing a lot of these cyclical companies to deliver growth rates and earnings for 2026 that may surprise investors. Moving to technology, which is on top of everyone's mind, the continuing growth is hard to ignore, and we've seen it broadening out from just being about AI to now seeing improvements in analog semiconductors and other areas. And with regard to AI specifically, the CapEx guidance from Microsoft and Meta tells you that the CapEx spending boom remains at full throttle for 2026. Just looking at Meta alone, their CapEx spending budget of $130 billion represents a big increase from 2025.
So those are all good news if you're bullish on the stock market. But what I also noticed during this earnings season is a lot of companies cutting jobs. And that kind of continues to be a theme as they really focus on expenses, managing that expense line to ensure that their profit margins stay, kind of where they are. How do you see that playing out in terms of consumer spending and what that means for consumer companies that will be reporting at the tail end of the season?
Well, we're seeing this no hire, no fire type of environment, and companies, at least in terms of their commentary, are talking about AI being the engine to allow them to have their productivity growth to offset the need to hire more employees. You know, anecdotally, when we're looking at some of these case studies now coming out of pharmaceutical, chemical, and other companies talking about their AI implementations, you know, drastically cutting down their research and development time, it's finally starting to crystallize the return on investment argument for AI. So, you know, we're seeing other companies like in the infrastructure-related industrial space, like ABB in Europe and GE Vernova here in the United States, confirm the trend in order books being positive. So I think when you look at the overall consumer, it hangs in there. What you're seeing is a displacement away of jobs from, let's call white collar, maybe towards blue collar. And the fact is, a lot of these blue collar jobs are going to pay more money, you know, than some of these white collar jobs. So I don't think it's going to be negative. And overall, I think it'll help keep the inflation down.
James, beginning late October, early November last year, we saw a little bit of a rotation out of some of the big tech names into some more value plays, small and mid cap as well. How do you view that here in 2026?
I think that trend continues because our thesis for 2026 has been that despite valuations being stretched and the Federal Reserve, in our opinion, not going to be the influencing factor that most others think it might be this year, we think markets are going to be relatively solid because you're going to see broad-based profit growth offsetting what we think might be a potential de-rating on the PE multiple on the overall market. And that's an environment which historically has benefited cyclical, smaller companies and value stocks in general.
James, thanks so much for joining us. We always appreciate getting a few minutes of your time. James Abate. He is Managing Director and Head of Fundamental Strategies at Horizon Investments. Well, over the weekend, the Senate passed a government spending package to avert a long U.S. government shutdown as the White House negotiates with Democrats on new limits on immigration raids. Let's see what the status there is. We go to Nathan Hager, Senior Policy Analyst for Bloomberg Intelligence. He's based in Washington, D.C. If anybody can fix it, he can. Nathan, where are we in trying to get this government reopened?
So, you know, the government, I think, will be reopened by tomorrow, but it's going to be a day of political drama. I think something that the Washington watchers are probably going to be watching with their popcorn at the ready. Later today, the House Rules Committee is going to be meeting, and this is where Speaker Mike Johnson is going to have somewhat of a little bit of a hiccup here, because really to get this forward, he's going to need every single Republican on board. The Democrats aren't really giving him much of a lifeline here, and he's not going to get it. There are going to be Republicans saying, look, if the Senate is altering this bill, I want to be able to alter this bill as well. So it's going to take some arm wringing. It's going to take some, you know, a little bit of political pressure here. But ultimately, this bill should pass, which will then fund the rest of the government, the majority of the government, through the rest of the fiscal year, minus the Department of Homeland Security. That would go to a 2-week continuing resolution, and then we would have another partial government shutdown threat in about 2 weeks related to DHS.
Nathan, I'm mistaken to refer to you as the great Nathan Hager, also Bloomberg News in Washington. I just get you guys, you smart guys, mixed up. Nathan Dean's joining us here.
We're filled with talent named Nathan from Washington, D.C. That's what it kind of comes down to. So where does this leave the president? Does he have a role to play here, Nathan?
Yeah, you know, it'll be really interesting to see what role, if any, he plays, because President Trump has largely been hands-off from Congress since passage of the One Big Beautiful Bill. You often don't hear him up there on Capitol Hill saying to leaders, you know, pass my legislative agenda. You know, much of his focus has been on executive orders and also geopolitical, just traveling around the world. Now, this isn't an arrangement that he negotiated or that the White House negotiated, and it will be interesting to see what, if any, role he plays, because right now I think he's just delegating that to Speaker Johnson. And so, you know, always there's going to be this threat out there that if you don't vote the way that President Trump votes, he's going to actually make something difficult for you in the midterms. I think that's going to be largely enough for this debate. But as we get further and further with this DHS extension, that's where I think President Trump is probably going to have more of a role to play.
Nathan, if I'm the Democrats and I want to get some reforms to Homeland Security, the ICE agents, is this not like maximum leverage? If you're going to ever get anything done, it's going to be right now. Is that how the Democrats are viewing it?
Yeah, I think you're perfectly right on that one because, look, you know, the polling suggests that the American populace is not in tune with President Trump's immigration strategy. I mean, just over the weekend, we saw this, you know, state Senate race in Texas that had a 31-point swing from a Trump 17 district to a Democrat 14 district. Democrats look at that polling and they look at Virginia and New Jersey and they say, look, you know, we have a good message here, and that is we are not on board with the Trump agenda. So they are going to push. But when it comes to DHS in particular, there's a couple of things to keep in mind here. ICE was funded under the One Big Beautiful Bill for about $75 billion through fiscal year 2029. So there's not much here that, you know, Congress can do to really, you know, claw back that funding unless you get a bipartisan agreement. And there's also going to be funding under DHS for things like FEMA, Coast Guard, and also the transportation, the TSA. You know, the Democrats are also going to be looking at FEMA and TSA, and they're saying, let's not rock the boat here. Let's take that 31-point position that we got in Texas and see if we can actually extend that to other areas across the United States before the midterms. Let's not do anything here to get the American people upset with us. So that's why I think this DHS issue is going to be resolved, but without, you know, much changes to the ICE funding levels.
Nathan, you and your team put together a report talking about industry policy risks and how they're going to rise in the second half as the president really leans into the bully pulpit. And it seems like every kind of company has faced their version of this. Most recently, I'm thinking about the banks with the president's push to limit credit card interest rates to 10%. What sector has he not picked on yet and that you're looking for him to say something on?
Well, you know, it's really interesting to tell because it changes almost on a weekly basis depending on the news cycle. I mean, obviously, he's very positive about energy, not clean or, you know, wind or solar, but, you know, just the oil and gas industry. You know, that's something that, you know, we're interested to see where that plays out when it comes to Venezuela in particular. Just a couple of weeks ago, you know, he had this meeting with the oil and gas industry and said essentially, and I'm paraphrasing here, saying, look, we want you to go into Venezuela. And several of those companies were like, well, we need a national guarantee or a security guarantee that we're not going to be nationalized in the future by a future Venezuelan, you know, administration. And that really hasn't been resolved here. And so I think as that process continues to play out, there could be some headline risk here if those energy companies outside of Chevron don't want to go into Venezuela. And President Trump said, look, my policy is you go into Chevron and you'll see a statement on Truth Social saying, I'm sorry, you're going to go into Venezuela. I think there's some headline risk for that industry in particular.
All right, Nathan, thanks so much for joining us. Appreciate it as always. Nathan Dean, Senior Policy Analyst at Bloomberg Intelligence. He's down there in Washington, D.C. Could get this government open as early as tomorrow, but it could drag on for a number of days. Again, it just feels like that negotiation as it relates to ICE tactics, maybe not the funding, but the tactics they employ, that's something that maybe the Democrats feel like now's the time to use their leverage.
It's a golden opportunity for them, if for no other reason because the headlines have been so appalling in terms of all the drama that's happened, and the violence.
And the polling seems to be squarely in the Democrats' camp at this point as it relates to the ICE and their tactics. So maybe they'll be able to negotiate something. But again, it's all geared towards getting the government reopened here. I'll tell you, the market's feeling just fine here. The S&P's up 37 points. That's 0.5%.
Government shutdown doesn't really move the markets anymore.
No, it doesn't. I mean, we've become so inured to it, I think, that it's just like, what's next? Yeah, exactly. NASDAQ up 150.6%. And the small cap stock's up more, up a little over 1%. 10-year Treasury yields 4.27%. That's about 3.5 basis points higher this year.
Headlines and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 11:40 on Wall Street. Yes, we do check markets all day long here at Bloomberg with the Dow, the S&P, NASDAQ, all advancing very close to session highs on the S&P right now, up 35, 69.74. That is a gain of 0.5%. The Dow up 0.9, NASDAQ up by 0.6%. This on the first trading day of the brand new month, February already. We've got Wall Street kicking off with gains as solid factory data bolstered optimism about corporate America. Those losses in gold and silver, they do continue. We'll tell you about that in a moment. The S&P right now up 0.5, NASDAQ up 0.6. The Mag 7 index down now by 0.2%. Right now we have got Tesla, Meta, Microsoft leading our index lower. There are 7 members, of course, 3 higher, 4 lower right now. 10-year 4.26%. Gold down 4.3%. 46.80 the ounce. Silver down almost 8% now at 78.64 the ounce. At a big retreat for crude today, 61.86 a barrel, down now by 5.1%. Bitcoin at 78,805. Bitcoin up by 3.1%. Disney reported sales and profit that beat estimates in the first quarter of its fiscal year, but the outlook certainly weighing on the stock right now. Disney is down 4.4%. Geetha Raghunathan is a senior U.S. media analyst for Bloomberg Intelligence, and she was a guest this morning on surveillance.
You know, a lot of the concern around the theme parks was this whole slowdown in leisure travel that we'd been seeing from, towards the end of last year. So we saw attendance actually in fiscal fourth quarter for Disney drop by about 4%. But then if you look at fiscal first quarter, that kind of recovered nicely, up 1%.
Geetha Raghunathan of Bloomberg Intelligence interviewed this morning on surveillance. Again, Disney shares, they're tumbling now by 4.7%. Recapping, S&P up 0.5. Both gold and silver are continuing their sell-off. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, thank you so much, Charlie Pellet, with our Bloomberg Business Flash. It is earnings season, and Paul, you gave a stat earlier. It was 170 companies have reported in the S&P 500. The banks are all done.
Yep.
Most of the Mag 7 is done, but we still have a couple of stray names reporting this week. And then, of course, NVIDIA's not till much later. But all the spending on AI continues.
Yes, it does.
And Oracle is the latest one. I mean, it's been in the headlines for a while now, but we're learning that it wants to raise up to $50 billion in debt and equity this year. That's a tremendous number here for Oracle. So we needed to bring in Mandeep Singh. He's our global tech research head here at Bloomberg Intelligence. And Oracle raising up to $50 billion, a big chunk of that, up to $25 billion of it will be through debt, is really eye-opening given that its credit has not traded as well, meaning the spreads have widened and credit default swaps on Oracle have also blown out a little bit. They've come back in certainly, but there are a lot of questions over the financial health of a company like Oracle versus, say, a company like Microsoft.
Yeah, look, I mean, Oracle had given a revenue guide for the next 4 years. So what they said was, we have an $18 billion cloud business that's going to go to $150 billion plus over the next 4 years. Wow. The problem that the street had was there wasn't really explanation of how they would, raise the funding, build the infrastructure, and how that revenue would come about, because it was all attached to OpenAI, the $300 billion backlog, which is essentially $60 billion per year just from one company.
Yeah.
So now what they're saying is, okay, we have visibility to how we are going to build the initial tranche of that AI infrastructure and data centers we need for the 2027 target, which is essentially $44 billion in revenue that they want to have by 2027. So for that to happen, they need to invest, up to $50 billion plus. So I compare them to the CapEx that Meta and Google and Amazon will be making this year, which is all in excess of $100 billion.
Yep.
Where does Oracle stack up? So far, the consensus was they would be below $50 billion in CapEx. Then how do you add $44 billion in revenue when Microsoft is not adding $44 billion in cloud revenue in 2027? And that's where I think they are making that upfront investments you need, which all these companies are making.
Yep.
Yes, you have to do it through debt, and you're already over-levered, to your point that their CDS spreads had widened. And that's where, they're using a combination of equity issuance and debt to raise that money, set up the AI data centers, which in turn will translate into $44 billion in cloud revenue by 2027. So that's where, if you believe their plan is going to be successful, which cloud demand is the one thing you know with AI, whether or not they are, big applications, nobody knows, but everyone will be consuming compute on the cloud. That's kind of the part of the business that's visible.
All right, tech investors that you've been dealing with for years, they've been used to funding big CapEx, big R&D out of internal cash. Yeah. Now, that's changed. They need to go to the capital markets, whether it's the debt capital markets, equity capital markets. This is something new for your investors. How are they digesting it?
They are. That's why, there was a panic around Oracle, and you saw that 40% drawdown, because you're right, in the case of Microsoft, Meta, Google, they generate up to $100 billion in free cash flow in a year. So with an Oracle, which generates about $20 billion in free cash flow, how do you make a $50 billion plus CapEx investment? And that's where, the gap needs to be bridged. And I think they're just maybe thinking too big in terms of how they want to ramp up that cloud business. And, right now they are 4% of the overall cloud market share pie. Based on the numbers that they have given in terms of the guidance, they would be 15-20% of overall cloud market, which is growing, by the way, 30-40% plus and expanding at that growth rate. So that's where I think there was some skepticism around what is it that Oracle can accomplish, given they don't have the free cash flow to fund this build out. And it'll be interesting to see how the bond trades when they, issue this. And there are a lot of unknowns still when it comes to the Oracle story.
Like I said, tremendous numbers here for Oracle. Another story we're following, Mandeep, is Elon Musk said to be in advanced talks to combine SpaceX with xAI, his startup AI company. What does this mean for SpaceX's planned IPO later on this year?
Well, so I tie it to, the funding needs for building your AI large language model infrastructure and then rolling it out to millions of users. Same thing with xAI. When you compare xAI Grok to, let's say, Gemini or, OpenAI ChatGPT, xAI, even though they are a frontier model, their user base is like 20, 30 million compared to OpenAI, which is 900 million. So one, they have a much smaller customer base when it comes to the traffic that they are serving. And these companies have to constantly invest in training their large language model because, the three frontier models, OpenAI, Anthropic, Gemini, are going forward in terms of, the capabilities that they're adding. So xAI doesn't have a choice but to keep investing. Problem is, because of their smaller user base, no one wants to keep, funding xAI with another 10 billion round or 20 billion when they don't have free cash flow either. So it's the same problem that Oracle has, and they don't even have, that user base. So that's where combining xAI with SpaceX does make sense because SpaceX is a much bigger entity. At least they have EBITDA margins of around 50%, even though it's a very high fixed cost business. So the ROIC is much lower for some like an entity like SpaceX, but combining it makes it more palatable for anybody who is putting money in that combined entity and saying, okay, at least you've got two entities where I'm ready to put some money as opposed to just xAI.
And SpaceX also has visibility. I mean, it's got these projects with the government, so it can project out what it sees.
Do we have any sense when that IPO might happen? Because they're suggesting this year.
They are suggesting, even OpenAI and Anthropic want to go public this year. So this year could be huge in terms of, IPOs.
And by the way, the underwriters can't write research on these companies, but who can?
Yes.
Bloomberg Intelligence
will be
can.
ahead.
And so what happens is we write the definitive research report on these big IPO companies.
They already have primers on OpenAI and Anthropic.
Absolutely, there you go.
Because we're not trying to win business from these companies.
Exactly right. So that is a huge advantage for Bloomberg Intelligence. We get to put out the research there before any of the street to help investors kind of make these investments on these big IPOs. Mandeep Singh, thank you so much. We appreciate it. Mandeep Singh, Global Tech Research Head. He was in Davos. What he was doing in Davos, other than you supposed to go there to talk about AI.
No, he did show us a picture though of him and Rishi Sunak, the former UK Prime Minister.
He was there. So anyway, he was there to talk AI, but all people wanted to talk about was like Greenland. So there you go. This is Bloomberg.
listening to Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio.
All right, Scarlett Fu, Paul Sweeney, live here in our Bloomberg Interactive Broker Studio in New York City. We are streaming live on YouTube as well, so check us out there. Well, folks, the experts continue to tell us we're in the early innings of this AI story here, and a lot of investors continue to look for ways to play it, as do we. Fortunately, here in Bloomberg Intelligence, we got a lot of technology analysts who cover all parts of the tech stack, and that includes Woo Jin Ho, Senior Technology Analyst for Bloomberg Intelligence. Talk about the global communications and networking equipment space, what to look for in 2026. Wooj, thanks so much for joining us here. When your conversations with investors, and they say, Wooj, in your space, in the communication space, the networking equipment space, what's the best way to play AI? How do you kind of shape that conversation?
Yeah, hey, thanks, Paul. So it's fairly straightforward, right? It's a fairly concentrated space. The AI networking space is expected to grow 91% on the switching hardware alone to $21 billion, right? The way to play it is fairly straightforward. It's 3 C's, an A, and an N, right? That's my new networking FANG. Cisco, Celestica, Corning, and Ciena, so 4 C's, Arista, and NVIDIA, right? And those are going to be the leading beneficiaries for the networking space in AI.
So give us a sense of kind of how investors should think about the investment cycle for AI. I mean, I'm going to say we're 2-3 years into it. I'm just not sure. How do you guys think about the duration here?
Yeah, you know, it's quite odd, right? Because, you know, some of us say it's 2-3 years into it. Michael Dell had this interesting quote a couple of weeks ago saying, what inning are we? And his response was, we're just entering the stadium.
Wow.
Right?
Yep.
So he still thinks it's early on in terms of the investment phase. You just had Mandeep on, and he was talking about the Oracle investment. And look, $50 billion is a massive amount of money, and it's all going into the AI infrastructure space. And networking is going to be one of the leading beneficiaries of it.
So how are the networking equipment companies that you follow, how are they financing some of their CapEx? Because again, I think most of us grew up when technology companies had so much cash flow that they could self-fund their R&D, their CapEx, that type of stuff. Now many of them need to come to the capital markets.
Yeah, fortunate for the networking guys, it's a low CapEx type of business, right? We're talking about sub 10% of their cash flow to CapEx, or 10% CapEx ratio to sales. So it is a fairly self-funded business, and it's also high margin business as well. As long as the hyperscale cloud providers, as well as the tier 2 cloud providers like the neo clouds are funded, they'll be able to buy the networking gear.
So how do you, I mean, it's interesting here, you think about the tech space and its hardware, its software, it's the networking equipment here. Who's kind of driving this AI thing? Are your networking and communications companies, are they kind of dependent upon, I don't know, what the hyperscalers are doing or what the chip makers are doing? Who's kind of leading this?
So at the end of the day, it's how quickly and how fast and how large of the investments that the hyperscalers are making on the AI side. I will tell you, as these language models grow and the scale of these compute investments grow, you actually need a lot more networking. And networking is, if you think about it as the arteries and the veins of a human body, networking is probably at the center of that right now. And that's why you're having a lot of investment on the networking front.
How are they dealing with, again, these networking companies? I think of these big global companies. Is the manufacturing dispersed around the globe? Is there a pressure to bring it to the U.S.? How are they dealing with some of the changes we've seen in global logistics, whether it's tariffs or just, most favored nation status, those types of things?
Yep, no, that's a fantastic question, Paul. I will tell you, there's a couple of things, right? When we had the tariff situation, number one, and also the COVID situation a few years back, the companies have actually done a good job rearranging the supply chain. A lot of manufacturing is happening out of Mexico. There's some manufacturing that's happening in Taiwan as well as in Canada. So we're bypassing some of the tariff situation, and quite frankly, tariffs have become a non-story for the majority of my networking guys. And on top of that, the DRAM story is inconsequential for the networking names as well.
How are the stocks performing here? We've seen so many parts of the tech space just rip. How have your stocks been doing?
I will tell you, if if you looked at the Celestica 2 years back, you're seeing a 10-time performer to where it is right now. It has slowed down because I think people are starting to catch up to the name. Arista, it's a double from 2 to 3 years back. And Cisco, I mean, we've finally got back to its 2001 highs because the business has actually stabilized. Yeah, so the stocks in itself have done well. The multiples have actually gotten a little bit rich.
Yeah, it's interesting. I'm just looking at Sienna. That's a name I know just from back in the day.
Yes.
200% over the past 12 months. Even I can make money with that. All right, Wooj, thanks so much for joining us there. Woo Jin Ho, Senior Technology Analyst for Bloomberg Intelligence. He's part of our global tech team that spans the globe. They're there in Asia, they're in North America, they're in Europe. They have them everywhere, part of the supply chain. That's where BI has all its tech people there. So that's good stuff. We get great global perspective. For our listeners in the U.S., a reminder, you can listen to us via satellite radio on SiriusXM Channel 121. Access the world's only global audio business network, coast to coast, 24 hours a day. Bloomberg Radio on SiriusXM Channel 121 is presented by Golden Crest Metals. Stay tuned for the latest market news and industry research. Your top stories and global business headlines are coming up in just moments. With the S&P up 40 points, the Dow up 445 points, the NASDAQ up 157 points. Movement green all across the space. 10-year Treasury yields are higher too, 4.27%. This is Bloomberg. Good morning.
This is CBS News on the Hour, your home for original reporting.
I'm Cammie McCormick. The House is returning to work today in Washington as the partial government shutdown continues. Funding lapsed for the Defense Department and Homeland Security, as well as State and Treasury. The Senate has passed a funding package, but Nicole Killian reports it must be approved by the House.
This measure has to clear a key hurdle in the Rules Committee, which is meeting later today, where really any one member, particularly on the Republican side, could put the brakes on this. But Speaker Mike Johnson is hopeful that this can move forward. He has indicated that a vote on the House floor could come as soon as Tuesday.
President Trump says the Kennedy Center in Washington will close for 2 years for construction, revitalization, and what he called complete rebuilding. He says it will shut down for that work July 4th. Correspondent Nancy Cordes reports there are a lot of questions about what's being done.
The president said that all the financing has been lined up, and we do know that Congress has already allocated about $250 million for deferred maintenance to the Kennedy Center. But is it going to cost more than that? We simply don't know right now.
Authorities in Arizona are searching for the 84-year-old mother of Today Show host Savannah Guthrie. Nancy Guthrie was reported missing over the weekend. She was last seen at her home in the Tucson area. Pima County Sheriff Chris Nanos.
We saw some things at the home that were concerning to us. We believe now, after we processed that crime scene, that we do in fact have a crime scene, that we do in fact have a crime. And we're asking the community's help.
The Trump administration's launching a $12 billion critical and rare earth minerals stockpile. Stacey Lynn has that.
The White House says the initiative is called Project Vault. It's designed to counter China's dominance of key minerals used in defense, clean energy, and advanced technology, and to limit Beijing's leverage in trade negotiations. The stockpile would be financed by a $10 billion loan from the Export-Import Bank, along with more than $1 billion in private investment.
Jeff Gilbert reports a safety investigation into some Ford pickup trucks is being upgraded.
The government's been looking into reports of sudden downshifts and even wheel lockups in 1.3 million F-150 pickups. Now they're reviewing additional technical data involving the 2015 through 17 model year trucks. Suspicion is pointing to electrical connections in the vehicles, but it's still too early to tell if this will mean a recall.
Checking the numbers on Wall Street at this hour, stocks are higher. The Dow Jones Industrial's up 476 points. This is CBS News. Looking ahead to Valentine's Day, CBS News correspondent Stephen Kaufman reports it'll cost you
an expected record of $29.1 billion, the anticipated spending for Valentine's Day, according to a survey from the National Retail Federation.
That's $200 per person that they're planning to spend on gifts for significant others, family, friends, even pets.
Federation Vice President Catherine Collins has candy tops the gift list, followed by greeting cards and flowers.
We did see more people planning to give jewelry this year, though.
Also, evenings out. Stephen Kaufman, CBS News.
A new study published in Nature Neoscience suggests babies are able to distinguish between different objects as young as 2 months. That's earlier than scientists previously thought. The findings may help doctors and researchers better understand cognitive development in infancy. I'm Cammie McCormick, CBS News.
Live from Washington, D.C., this is Balance of Power with Joe Matthew.
The shutdown enters day 3. Welcome to the Monday edition as Washington wakes up to a funding lapse for Treasury, Defense, Health, Labor, and yes, Homeland Security. That's how we got here, and it may not be as easy as some think to reopen these agencies. We'll discuss with Nathan Dean at Bloomberg Intelligence. He's running the odds. Mike McGlone joins as Bitcoin falls out of bed, and Bloomberg economic statecraft reporter Joe Doe is going to be here to walk us through President Trump's Project Vault to launch a strategic mineral stockpile. Our political panel is ready. Jeannie Shanzano and Rick Davis, and we start, as always, on Wall Street. Charlie Pellet has his view on the markets from world headquarters in New York. Hey, Charlie.
Well, hello there, Joe Matthew. Back to work Monday, start of a brand new trading week. Gains across the board today for the Dow, the S&P, and NASDAQ. S&P up 0.7%. This morning, solid factory data bolstering optimism about corporate America. Losses in gold and silver continue, however. The Dow up 1%, higher by 483. Could see a record close on the S&P today because that's where we stand at a record now at 69.84. That is a gain of just about 0.6%. NASDAQ up 0.7, but the Bloomberg Mag 7 index slumping by under 0.1%. The 10-year 4.26%, but the 2-year 3.55%. Gold down another 4%, 46.99 the ounce. Silver with a $79 handle now, down 6.7%, and a big retreat for crude down 5.1%, 61.85 for a barrel of WTI. Investors, meanwhile, continue to debate and discuss President Trump's pick of Kevin Warsh to head the Fed. Oksana Aronoff is head of market strategy at JP Morgan Investment Management, and she was interviewed on Bloomberg Open Entrance.
It's important to say that it will be interesting to see how he's going to reconcile his historically, hawkish stand on the Fed balance sheet, on inflation, and Trump's desire to see lower rates.
Oksana Aronoff of JP Morgan Investment Management interviewed on Bloomberg Open Interest. As we have been reporting, President Trump launching a strategic critical minerals stockpile with $12 billion in seed money, a bid to insulate manufacturers from supply shocks as the U.S. works to slash its reliance on Chinese rare earths and other minerals. Those companies involved right now, they are all advancing. USA Rare Earth up by 4%. Critical Minerals Corp trading higher by 1.2%. United States Antimony up by 9.5%. And shares of Nio Corp Developments up by 8.3%. Yes, a topic we'll have a whole lot more coming up right here on Balance of Power. Again, recapping stocks higher. S&P up 0.6%. Back to work Monday. And we turn it back to Washington. Once again, your host here is Joe Matthew.
Okay, Charlie, it seems like Wall Street's seen this movie before. Government shuts down and we rally, I guess with some exceptions. Charlie, good to see you. He'll be back in about 15 minutes with his read on the markets. The Monday trade as we start pushing the rock once again here in Washington. Although if you were looking at the president's Truth Social feed, it's like last week never ended. One day just kind of blends into the next. Thanks for being with us on the Monday edition. Producer James at the helm. We're back in Washington live on Bloomberg Radio, streaming live on YouTube as well. Search Bloomberg Business News Live if you want to find us on YouTube. Coolest thing we've got going. You can pause it, back it up. You need to walk out of the room, whatever. We're always on YouTube for you here, even though we're on the radio. We dare face you in the camera. And we'll welcome our global television audience to the conversation 1 hour from now. Rick and Jeannie are back together off the weekend, and boy, here we are in Snow Creek, Washington. Doesn't matter if you're in Washington or Florida right now, you're freezing cold. And watching all these people out there with pickaxes again this morning trying to free their vehicles in Washington, my God, it's a miracle we're going to get the House of Representatives back in town, and that is what we need to do. There's a good chunk of the government's closed, right? We went through this end of last week. Hopefully you were with us as we broadcast live from the Senate in what was a very important vote. The thing is, it might not be duplicated in the House. And so we've got a good swath of the government closed here. Yeah, Homeland Security, but it was tied to a bunch of others, including defense, kind of a big deal. Labor, health, stuff that you kind of need after a while. And there's a 2-week CR if the House, if everything goes perfect, a 2-week CR to figure out the way forward with Homeland Security. And not everybody's on the same page. The first order of business, though, for Mike Johnson's to get a spending bill on the floor tomorrow. He says he's got the votes. We're all pretty sure it's not as simple as that. And he discussed this on Meet the Press yesterday morning on NBC. Here's Mike Johnson.
There's a lot of details in this. We could get deep in the weeds, but we will do that over the next 2 weeks. And I hope that Democrats will be in good faith, as Republicans are, to try to bring some order. I think even Tom Homan has acknowledged both of those things are acceptable and what he was intending to do already. So I think we're on the path to get agreement, and I really hope that everybody will come to the table in good faith. That's what's going to be required here.
Well, that is going to be required, and it might not happen. Ask people on the Freedom Caucus are not very happy about this. That's more than 30 votes alone. Anna Paulina Luna could single-handedly derail this thing, threatening to shut down the government because the Senate will not pass a voter ID law. There are all kinds of factions in the House that are going to give Mike Johnson lots to stay up awake thinking about tonight. And it begins in a Rules Committee hearing, 4 p.m. Eastern Time. When we come back on the late edition, this will be a live ball. And I'm glad to say he's back from a freezing cold Orlando to join us in freezing cold Washington, America's dad. You got the family home safe and sound, I'm sure. Nathan Dean at Bloomberg Intelligence. How are you?
Good. No, thanks.
You did this freezing at Disney thing.
Yeah, people had blankets. It was great. Like waiting in line, people had blankets over themselves.
What is going on?
But my kids were like, "Can we have hot chocolate?" Like every hour, they were like, "Can we have
hot chocolate?" Like, yeah. Do you go? I mean, are people waiting in lines like normal, or did that cut down on the lines? I'm guessing
none of the locals were there. It was just all of us who had flown in from elsewhere, and we're like, it's 6 degrees back home. We can do this.
So it was still a warm up, I guess.
Yeah, but it wasn't much of a warm up. Florida's still cold.
Wow, amazing. Are they spraying down the oranges down there? Should I be buying frozen orange juice futures like trading places?
I think that's a good question from Mike McGlone from Miami when
Actually,
he comes on.
Should get, he's going to be on here just a little bit. We have to talk about Bitcoin. So, yeah, we got to talk about what's happening here because we thought this was fixed. Last week, it seemed like everybody was on the same page. Well, maybe the week before that. Then Minneapolis happened. Then it got to be a little more complicated. Once the president posted, though, that he had a deal with Democrats, it seemed like the fix was in place. Now, suddenly, it's looking a lot more complicated. I did my best to set the table for all of this. Are you running odds on reopening? What do we even call this right now?
No, we're not running odds just because the general consensus, which we believe in, is that the government is going to reopen tomorrow. Or Wednesday or sometime this week. I do. Because look, I don't see where, the House, look, let me back up. Yep. This deal was between the White House and the Senate. It got through the Senate. Senate goes to jam, the House on this.
Right.
House says, look, we're not going to bring back people until Monday. And now people are giving back. And lawmakers in the House are saying, rightfully so, they're like, look, well, if the Senate gets to change the deal, I get to change the deal. And this is just, we've seen time and time again that House lawmakers come back and they say, look, I want to vote on this. I want to vote on that.
Yep.
And ultimately, at the end of the day, when, we'll have one of those House Rules Committees that are going to be it's going to be great for us Washington watchers.
So they're going to beat each other up tonight.
They're going to beat each other up tonight. But I think at the end of the day, because of what happened in Texas this weekend in that state Senate seat, where it went from a 17-plus district to a 14-plus Dem district,
yes.
The Republicans are looking at this and saying, look, we need to get back to core messaging. And the Democrats are looking and saying, look, we are actually doing well at the moment right now. Let's not change things or actually alter that narrative.
Mm-hmm.
That's why I think leadership on both parties are going to let their folks come through and they'll raise objections. But ultimately, I think the House is going to pass this. And then we'll fight this again in 2 weeks with the DHS over this partial government shutdown.
Is that what we call this? I keep hearing it's a super short shutdown. It's a short shutdown. It's a mini shutdown. Look, if we keep getting CRs on Homeland Security, I don't know what we're going to call this thing, but you're referring to Christian Menifee, right, in Texas. Texas Democrat cut Mike Johnson's margin of error to a single vote. You still think he can get this through, though, with the Freedom Caucus, Anna Paulina Luna, all the rest?
Well, I don't think he's, look, we're going to have to talk about the Hastert rule.
Yep.
You know, the Hastert rule says is that you don't bring something to the floor unless the majority of your caucus supports it. He's going to have to break that. You know, because, well, maybe not break it, but he's going to have to actually deal with a lot of Republican lawmakers saying, I'm not going to support this. Okay. Now you need Democrats. The Democrats are looking at this and they're saying, look, we're not going to give you a lifeline on this. We're going to make you squirm. Right. But then ultimately you did see statements from like Representative Hoyer, Representative Clyburn, sort of saying, look, we need to deal with this because let's also just take ICE out of the equation of DHS. What else do you have? Well, you have FEMA. You have the Coast Guard, and you have the TSA. As somebody who just flew through an airport yesterday, you know, when I told my wife that there was a government shutdown, the first thing in her mind was, you know, is TSA going to be operating? Yeah. And so, you know, the American people...
Are they working without paychecks right now? Or they'd have to wait another couple of weeks. But technically, their pay is impacted by
That's right. Right now, I mean, they would get their next paycheck, miss their first paycheck in 2 weeks, or whenever the paycheck is. But where I'm going with this is that, you know, it's an election year. And Congress is, one of the big messages that we're telling our clients right now is we have a Congress that is a governing Congress. Now, look, we can have arguments of what the definition of governing is,
we can.
But it's transitioning to a campaigning Congress. And as you know, a campaigning Congress in election year is a much different beast. And they're transitioning right now. And so as we move through this shutdown, they're going to be thinking more and more about the midterms, and that is going to change behavior to the fact of getting deals done. So the point is that if you're on the Democratic side, you don't alter this trajectory of what the momentum is, and on the Republican side, you're trying to stop this momentum and get back to messaging.
Two important things here. I mentioned Christian Menifee. This is the representative-elect, is on an airplane right now coming to Washington. First stop is here on this set, on the way to being sworn in. We're going to have a conversation with the Democrat from Texas in just about 45 minutes from now here. Second one, you saw this coming. BLS, no jobs report Friday.
Yep.
This is official now. Does the market start to care again?
Well, look, anytime you're going to tell a market, when it comes to a government shutdown, most market impacts, they really aren't there. Even for contractors, they're not really there.
Yeah.
But for reports, they are there. And as we saw in the shutdown last year, a lot of traders were not happy about this lack of data out there. And this is just another consequence of a shutdown. Now, I think looking forward, though, the good news is that I still think a government is going to reopen this week, and that would fund us through the rest of the fiscal year. That would take us through September 30th. There's not going to be a shutdown. I'll just say it right now. I don't think that there's going to be there's probably a 10% chance of a shutdown 1 month before the election, which means that if you're looking at jobs data and you're looking at reports, you at least have enough data, I think, to get you through the rest of this year.
Okay, that's helpful. Then we get the 2-week CR to figure out Homeland Security. John Thune says might need another one and another one after that. Or is this 2-week time period simply too aggressive?
I think it is. I think Senator Thune is probably right.
Yep.
I think you probably are going to need another continuing
Dems will
resolution.
love that.
Well, I mean, look, the question is that how much leverage do the Democrats have right now? And look, they are united. But $75 billion worth of ICE funding came from the One Big Beautiful Bill, and they can see through fiscal year 2029.
There you go.
This is an argument about other things.
Great story on the terminal, by the way. They're spending that money on warehouses around the country that'll be turned into detention centers for those apprehended by ICE. It's a great story on the terminal. In the meantime, we have Nathan Dean to point the way. Welcome back to town. I'm glad everybody's warm. It is freezing here in the Capitol. It's not just you. I'm Joe Matthew. We'll turn to Bitcoin next with Mike McGlone.
It's 12:21 on Wall Street. We do check markets all day long here at Bloomberg. Friday's jobs report now delayed. A BLS spokesperson says the Bureau of Labor Statistics will not be releasing the January jobs report as scheduled on Friday due to the partial government shutdown. Also, this headline now from the Bloomberg Professional Service. The U.S. is going to be lowering India's reciprocal tariff rate to 18% from 25%. Stocks are higher after this morning's factory data. Also, the gold sell-off is continuing but easing. Right now, we've got the S&P up 44 to 69.83. If we close there, that's a record, up 0.6%. The Dow up 476, up by 1%. Nasdaq pushing higher, up 173, gain there of 0.7%. Our Mag 7 index lower, little change, down under 0.1%, with the 10-year currently yielding 4.26%. Spot gold is now down 4.4%, 46.75 on spot gold. Silver continuing its decline, down 7.3%. Spot silver at 78.96 the ounce, trading below 80. And West Texas Intermediate crude easing today, down 5.4%, 61.69 for a barrel of WTI. Bitcoin, meanwhile, up 3.5%, still below 80,000, 79,100 on Bitcoin. Our Mike McGlone will have a whole lot more on silver, gold, and also on Bitcoin in just a moment. Elon Musk is in advanced talks to combine SpaceX with XAI. That, according to sources. Tesla shares, they're trading lower right now. We do have Tesla down by 1.7%. And China has banned concealed door handles on EVs. First country in the world to outlaw a design popularized by Tesla that is now facing global regulatory scrutiny. Recapping, S&P up 0.6%. Metals lower. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie Pellet, thank you so much. Live from New York. Charlie will have much more in about 20 minutes' time as we track the Monday trade here. And so far, so good. Even Bitcoin's coming back to life after a wild weekend. I wonder how much the spy chic lost last weekend. Did you hear about this story in the Wall Street Journal? This is a wild one. It came up on Sunday morning, but there's so much news that, no one will remember it tomorrow. They say it's unprecedented. Todd Blanche said, well, it's what the Biden family was doing the whole time they were in office. 4 days before Donald Trump's inauguration, lieutenants to an Abu Dhabi royal secretly signed a deal, I read, with the Trump family to purchase a 49% stake in their cryptocurrency venture for $500 million. This is World Liberty Financial, the Trump family operation. It was signed by Eric Trump, backed by Sheikh Tahnoon bin Zayed Al Nahyan, who's been pushing the U.S. for access to artificial intelligence chips. He got thousands of them. NVIDIA chips. An investment marked a foreign government official taking a major ownership stake in an incoming president's company. Fascinating stuff as we watch Bitcoin tumble. Maybe it was Melania coin he was most invested in. I don't know. Bitcoin is coming back to life, though. As I mentioned, it's up 3.5%. To see the 7 handle over the weekend, I reached out immediately to producer James to see if he was buying. He said, hold on, I'm watching the technical levels. We'll wait to speak with Mike McGlone, who joins us now, by the way, because we need to talk about Bitcoin and what's happening in the precious metal space here. And maybe he's going to tell us they're all intertwined. Mike is Bloomberg Intelligence Senior Commodities Strategist. Miami Mike, as we call him. It's cracked the 50-degree mark in Miami, and so I congratulate you, Mike McGlone. This thing fell out of bed over the weekend, and I'm trying to figure out why. Was there a margin call? What was going on in the background?
Oh, hey, Joe, what we have in Miami now is iguanas falling out of trees. It feels just like Bitcoin. The thing is, Bitcoin's an enduring bear market. It peaked in October, right around when the NASDAQ peaked, and it's still heading lower. It's not just Bitcoin, it's the whole space. So on the day, if you compare it from Friday, it's still down about 5%. Ethereum, the number 2, is down over 10%. So we're seeing stuff on the screen that's from Sunday, but it took it out over the weekend. The key thing is, when President Trump got elected, it put in that up too much peak in cryptos, too much enthusiasm, and now you see what's happening. Before, when you entered the space, you were getting away from the system. You had something independent and different. Now, if you're a pension fund, endowment, or family office, typically who don't lean to the right, politically, you're basically supporting the president and the administration if you're investing in this space, and it's just a bear market. The key thing to remember is there's an overwhelming supply of cryptocurrencies. In 2009, there was one, and now there's about 28 million. So I think it's going to be an enduring bear market. I think Bitcoin's going to 50,000, and I think it's very unlikely this year to stay like a new high above 98. But 50,000 is not too significant because the last 5 years or so is basically the main pivot, and we seem to be just reverting back to the mean.
Wow, 50,000. Call Michael Saylor. Okay, so we got a ways to go in that world. Mike, how did technicals work, or don't they, with Bitcoin the way they do with stocks or other commodities? I mean, we've given up the 200, the 50, the 21, and it doesn't seem to matter. It's a broken chart. What does that tell you?
Well, the technicals are so important because from a futures guy, there's always a basis. For instance, if you trade a bond future, they focus on bonds. If you trade a crude oil future, it's focused on crude oil. There's no basis in Bitcoin and cryptos. It's just a number on a screen. Yeah. And you mentioned Michael Saylor. He really was a great indicator for me. He accelerated my bullishness in 2020 when he got bullish around 10,000. But it went up 10x, and he doubled down. He double-dogged the market gods, and now it's going back down. I saw him at a conference in Miami a few months ago, and he said their quote was he puts money he can't afford to lose into Bitcoin, and that reiterated my view it's going to drop to zero from 100,000, ultimately go to 10,000.
To zero. Oh my God, James, don't tell anybody about this conversation. We'll never survive on Twitter. Hey, well, so let's, they call Bitcoin digital gold. How about real gold? The decoupling here has been a story for some time, but gold has been falling back quite a bit here. It's down 1% right now, but a lot of folks were projecting 5,000. What's driving gold and silver, Mike?
Gold and the metals feel very similar to Bitcoin and cryptos last year. They went up too much, and now they're going down. I think by this time next year, and potentially now, we've probably peaked in silver, peaked in gold, peaked in copper. We went up way too much in the first month of the year, and now they're tilting over. Yeah. Gold is just way too expensive versus most commodities. And silver, particularly the devil's metals, probably peaked around 100. And that's things you can call me on later, but it's just the signals you learn in markets is when the pylon happens, and if you've been bullish forever, you get out. And to me, this is the risk as we do a normal autocorrelation back towards means. And silver means around 50. Gold probably means around 4,000.
Did you call it the devil's metal? Is that a thing?
Silver its nickname is the devil's metal, and I don't think I have to reiterate that because you saw what it did last week. That's why it's called the devil's metal. It goes up a lot, it goes down a lot, and it makes you lose your hair.
Get your hands cut off. Wow, it's always great to talk to Mike McGlone. The devil's metal. What a world! I mean, these guys in the metal space. It's just I love this stuff. But hold on, maybe not metals. How about minerals? This is a big headline and a big scoop. By Joe Doe and Jen DeLuey. Trump launches $12 billion minerals stockpile to counter China. You've heard of the Strategic Petroleum Reserve. This is kind of like a strategic minerals reserve, although we're calling it a stockpile. And there's going to be seed money, $12 billion, to insulate manufacturers from supply shocks. It's even got a name, Project Vault. Joe Doe joins us right now with more on this. Joe, I want to start with the dumb questions first. So forgive me in advance, because we hear a lot about rare earths. We hear a lot about critical minerals. Now we hear a lot about basic minerals or basic materials. How do we qualify what's going to go into this stockpile? What should we call it?
So I think the best way to look at it, based on the reporting that we've gathered from sources over the weekend, is that it's a strategic stockpile of critical minerals. Now, the umbrella of critical minerals has expanded quite substantially this year versus, say, last year. We're somewhere near like 56 total critical minerals in the eyes of the United States Geological Survey. That's up from something in the 30s from their report back in 2022. Rare earths are the ones that a lot of people talk about a lot lately, especially because that's a focus of Donald Trump's, because China is the dominant producer and processor of these things. But our understanding is that they are willing to buy critical minerals generally based on the direction that they're getting from these OEMs that are partnering up with the project, which we also mentioned on our story.
Yes. So you point out things like gallium, like cobalt, that are used in everything from our phones to actual weapons in defense programs, jet engines, and so forth. This is about national security, but not just weaponry, I guess is the point here, right? They could be used for any number of things.
Yeah, I think the bottom line, what is new about this is it is specifically being created for private industry. So it's a stockpile for U.S. companies to be able to tap in the event of a national emergency. We've had a strategic stockpile that's been monitored by the Pentagon now for decades. Many people know about this one, and that is for the event of, all-out war or other defense and national security situations. This one is the idea that at some point you have a shortage of supply of minerals that are critical or raw materials that are critical for industrial or other type of companies, right? The example I've given before is, say suddenly there's a choke point on a mineral needed for the automotive industry. The automotive industry like GM or Stellantis, two companies that we have reported are partnered with this new Project Vault, would be able to go to the vault and say, listen, we need X amount of whatever it is for electric motors or for whatever other components in the car, and we need it now because there's a shortage globally.
Really cool. Right, understood. The companies that are involved here are majors. They're household names, whether it's General Motors, Stellantis, Corning. I see GE Vernova, even Alphabet is on here. When I see a Boeing, that's for making jet engines. That's not going to be for a weapons program, is what you're saying, right? This delineates between the two?
As we understand it, yeah, it would be specific to something that Boeing would need for commercial purposes. But again, Joe, I want to stress there's still a lot of detail that needs to be expressed to the marketplace here, right? Like, there's a lot of conversation. I've heard a lot of people asking, well, what's this and what's that? And I think we do have to wait for some sort of official announcement from the administration to fully understand more of the details. Because, Joe, what you're asking are the things that the marketplace really does want to know about. These details do matter.
Fascinating. $12 billion seed money, as you call it, in our remaining moment, Joe. Is that just the beginning? How big could this get in terms of valuation?
I don't know, Joe. I think that's the number they're throwing out now. That's the number that they believe will be useful enough to fill up the stockpile that they want. But I guess we'd have to see after that.
Congratulate you on great reporting. This is fascinating and could be a big market mover in the end. Includes a private injection here, $1.67 billion with a $10 billion loan from the U.S. Export-Import Bank. It's one of the most important stories on the terminal today. Joe, thank you so much for helping us understand a little bit more. I suspect that we'll do this again as we do add more details to the story here at Bloomberg. I'm Joe Matthew in Washington. We'll assemble our political panel next. We've got some moving parts today. This is going to be an interesting couple of days in the news flow, and the story that we're talking about with government funding, for instance, could change a lot when the Rules Committee gets in a room up on Capitol Hill today, less than 4 hours from now. This is not a sure thing. A good chunk of the government's closed. We'll play it to Rick and Jeannie next.
5:40 on Wall Street. We do check markets all day long here at Bloomberg. Friday's jobs report now delayed. A BLS spokesperson says the Bureau of Labor Statistics will not be releasing the January jobs report as scheduled on Friday because of the partial government shutdown. We've got the Dow, the S&P, NASDAQ all advancing. Stocks kicking off the trading month of February with gains. A solid factory data this morning bolstered optimism about corporate America. S&P 500 now at a record 69.86, up 47, up by about 0.7%. The Dow up 486, up by 1%. NASDAQ up 187 now, up by 0.8%. Our Mag 7 index just turning positive. The 10-year at 4.26%, with the 2-year 3.55%. Spot gold is down 4.5% now at $46.70 the ounce, while West Texas Intermediate crude oil down 5.1%, $61.87 the barrel. Silver, by the way, now plunging by 7.1%. Bitcoin rallying 3.3%, 78,900 on Bitcoin. So no jobs report this coming Friday, but what about the broader economic backdrop? Joe Davis is head of investment strategy at Vanguard. He was a guest this morning on Surveillance.
We are prepared to see in some months a modest negative non-farm payroll. That's that break even with the supply having come down. So that I think could be some market nervousness. You could see a Federal Reserve easing into that in between now and the summer. But if you're bold enough to look past that, we see some firming in the labor market.
Joe Davis of Vanguard. After earnings, Tyson Foods up 0.3%. First quarter profit benefited from higher beef pricing and healthy chicken demand. Also coming up after the close of trading, Palantir Technologies, PLTR on the ticker, up now by 2%. Again, recapping, stocks higher. The Dow, the S&P, NASDAQ, they're all advancing. S&P 500 index up now by just about 0.6%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcast. I'm Charlie Pellet. That Joe Matthew is a Bloomberg Business Flash.
All right, Charlie. Happy Groundhog Day, by the way. I know you're loving this winter like we all are. The worst winter of our lives. Snowcrete, they're calling it here in Washington, D.C. I saw more guys out there with pickaxes this morning. This is serious, man. This is how nature thins the herd. We're all lucky to get here to work, I suppose. And, of course, on this Groundhog Day, we learn it's not nearly over. Then again, we also learn that, as Mike McKee taught us this morning, pointing us to National Weather Service data, Punxsutawney Phil is a fraud. Of the 19 groundhogs, it's not like he's the most famous one, but there's all kinds of local groundhogs out there. For me in Massachusetts, it was Miss G, who we always thought was pretty accurate, hanging out there at the state groundhog at the Mass Autobahns Drumlin Farm Wildlife Sanctuary. But no, in this case, Punxsutawney is letting a lot of people down. Of the 19 groundhogs around the country who purport to forecast the length of winter, Phil is tied for 17th. Did you know that? An accuracy rate of 35%, but we go back every year anyway and pretend to be Bill Murray. So who is the most accurate of the groundhogs? Staten Island Chuck. Yes, indeed. New York. Q. Nicole Maliatakis has been the most reliable foreteller of the weather. That's right, CC. It's local. New York. All roads lead to New York City. The President of the United States now not celebrating Groundhog Day, but still reeling from the Grammy Awards, having taken to Truth Social to declare the Grammy Awards the worst, virtually unwatchable, he says. CBS is lucky not to have this garbage litter their airwaves any longer. That was the last one last night, CBS. The host, he says, Trevor Noah, whoever he may be, is almost as bad as Jimmy Kimmel at the low ratings Academy Awards. Noah said incorrectly about me that Donald Trump and Bill Clinton spent time on Epstein Island. Wrong. I can't speak for Bill, but I have never been to Epstein Island, nor anywhere close. And until tonight's false and defamatory statement, I've never been accused of being there. So he's going to sue him. I'm just going to fast forward to the punchline here. Looks like he says, I'll be sending my lawyers to sue this poor, pathetic, talentless dope of an MC and suing him for plenty. He says, ask little George Slopadopoulos and others how that all worked out. We're not going to do our whole panel on this, but I am curious what happens when pop culture turns against an elected official. And it's not all pop culture, but you certainly saw it on display last night at the Grammys, and you probably shouldn't be surprised. Ice out is what everyone was saying, right? You saw all the pins on the red carpet. The Bad Bunny, whomever it was talking. Billie Eilish had something to say about this administration or ICE enforcement or whatever. And it was on Front Street. It's one thing to have the cold open on SNL every Saturday. This was a major network broadcast, and it sounds like the president watched all of it. Bloomberg Politics contributors Rick Davis and Jeannie Shanzano join on this and more. Jeannie is our Democratic analyst and democracy visiting fellow at Harvard Kennedy School's Ash Center. Rick Davis, the man with the snowblower, our Republican strategist and partner at Stone Court Capital. I hope you both survive, and this has been one heck of a winter, and I guess we got through another weekend. Jeannie, I don't know if you watched the awards last night. Rick, I don't know if you're a Grammys guy, but I'll always remember that celebrity ad that you guys put together on the McCain campaign. Does it matter? Does it help or hurt Donald Trump to have the Grammys turn against him?
Well, the Grammys represent kind of a populist thing, right? It's what normal people watch. And they're not really political. They're not tuning in to see some kind of a campaign ad. They're tuning in to be entertained. And so when entertainment crosses that blood-brain barrier to, political commentary, sometimes it works and sometimes it doesn't. And in this case, because it's so, a big news item, you can't tune on to anything without hearing about what's going on in Minneapolis, the government shutdown because of ICE. It's everywhere. So it doesn't surprise me that the Grammys would bust into that act and that these actors, all of whom have their own point of view, would weigh in. Myself, I think, actors in Hollywood should stay on the West Coast. And, most voters aren't influenced by them, but the Democratic Party is. And so sometimes it's a plus because we're talking about it today and it's driving that narrative.
Yeah.
Sometimes it's a big flop.
Well, that's interesting, Jeannie. That he wanted to have an alternate sort of halftime show for the Super Bowl because Bad Bunny is going to be doing that. And he's not going to be there, but he'll certainly be watching that as well. How much of a liability or not is this for Donald Trump? You could say it helps him because maybe the base loves this.
Joe, I was going to test you by asking you for Bad Bunny's real name, but I won't do that. I'm certainly not going to do it to Rick. I know better than that. It's going to be a whole week of Bad Bunny, right? We've got him last night at the Grammys, and then we're going right into the Super Bowl. The big question is, what does he do with the Super Bowl, if anything? And I think it's fascinating what a switch the NFL has taken from the Colin Kaepernick days to now booking Bad Bunny, of course. So it's going to be all Bad Bunny this week, in addition to Punxsutawney Phil. But you know why this matters? Because Donald Trump can't keep his eyes off of it. I think the most fascinating thing to me was the man is almost 80 years old. I'm impressed he's up at 1 a.m. finishing the Grammys and messaging about it. I was very impressed by that. And he's got a big problem on his hands. It's the ice out and pins. And, these are very, very popular singers and acts that are there from around the world. And they have a huge, huge megaphone. He knows that. And the messages they are sending are echoing what we are seeing in places like Texas over the weekend at the very much quieter polls, where people are saying you overreached on immigration. This is not who we are. ICE out, essentially. So it's a problem for Donald Trump, and we know it. And since it's Groundhog Day, his only sort of message was, hey, I'll just sue, which is what he usually does.
He's going to sue, indeed. I guess this alternate halftime show is happening. We're just not sure who's going to be there, right? They announced this in the latest week. It'll be on X and Rumble. It'll be on Real